Good morning. It is 9 a.m. on Wednesday, December 22nd. We here at Yahoo Finance Live getting into the Christmas spirit, jam into some Christmas tunes before we came to air this morning. I'm Julie Hyman. That is Brian Sazi. Let's take a look at futures here this morning. He's still jamming. Even as we see futures pull back a little bit after the bounce yesterday, it's not being sustained. NASDAQ futures indicating a drop of about 0.25% at the open. That's the worst of the three major averages. So just mild declines here this morning. This, as we are seeing COVID fatigue. There are signs of hope and data coming out of the decreasing rate of cases in South Africa, even as it remains tough to get tested here in the United States. The biggest bull, John Stolfus of Oppenheimer, has the highest 2022 target for the S&P 500. He'll join us to discuss why coming up. And BlackBerry turned a profit and beat sales estimates in the latest quarter. We will break down those numbers a little bit later on. Stock, though, is trading lower. We'll explore why. But first this morning, we do have to check in on the latest COVID headlines, and there are many indeed to choose from. Maybe we should start by looking at the glass as a little bit half full, right? That we are seeing some data start to come out of South Africa. Not only that we are already perhaps seeing cases peak there and start to come down, but that this latest variant does indeed have a lower risk of hospitalization. Our Anjali Kamlani, as always, is tracking all the headlines for us. And Anjali, I'm trying to take the good news where I can.
We all are, Julie. Unfortunately, what I would say is that take it with a grain of salt. So let's dig into what just got released. We got a new study, non-peer reviewed yet, from the National Institute for Communicable Diseases of South Africa. And what they found is that the Omicron variant was 80% less likely to result in hospitalization and compared to all other strains, and 70% less likely for severe disease when compared to Delta alone. It was about the same for other strains, though. So that all, it sounds really good, but the big caveat there that the authors noted was that they relied largely on the fact that most of South Africa saw a huge Delta wave in July. So there's likely some immunity and protection there in addition to the vaccination. So that could be skewing results. We're also waiting for studies to come out of the UK to kind of help add to this body of knowledge. So this is really, really early stuff. But again, what we've been seeing so far has largely been good news, especially for those who have been vaccinated.
Indeed, and especially boosted. Also, some good news on the treatment front, right? Because it looks like the FDA is poised to approve those two treatment options from Pfizer and Merck, even as the testing area is lagging a little bit. But let's talk about that treatment news first of all.
Yeah, absolutely. So Bloomberg reported that while we are waiting for, of course, those two approvals for the Merck and Pfizer pills today, that the U.S. government has already gone ahead and is ready for purchases and to release those pills. We know that we've seen on social media, Pfizer has already talked about the fact that these pills have in fact been ready for shipment already and started to be released to certain places really in advance. So you can kind of tell how ready they are to get this to the finish line quickly. As it stands right now, we can expect upon approval 400,000 courses of Merck and 65 courses of the Pfizer pill. So as you can see, Merck has a leg up on this. In addition, by the end of January, about 3 million Merck courses and 250,000 Pfizer courses are expected for the U.S. government. Meanwhile, on the testing front, of course, everyone knows that the struggle to get their hands on rapid tests, while we also see some delays in turnaround times for PCRs, those rapid tests are in such high demand and such short supply that some of the biggest retailers have actually put caps on purchases. Right now, CVS reporting a 6-limit cap in stores and online. Walgreens, 4 testing kits online only. Stores can set their own limits, and Walmart, 8 online maximum, and the stores vary there. So really, just a sign of the times right now, what we're expecting into the holiday season.
And of course, that's if you can even find any of those tests, which at a lot of Walgreens and CVS and Walmart and anywhere you can't. All right, thanks, Anjali. Appreciate it. Saz, as we look at the market reaction, the sort of back and forth here, I'm reminded, of course, that we're getting very close to the holidays. And so the closer we get, the thinner volume gets, the more people are away already. So that's just something as the backdrop for this sort of seesaw in the markets in reaction to these Omicron headlines to keep in mind. But there is also the idea of how it continues to hit corporate America. And I think one of the latest examples is the Consumer Electronics Show, which had been planning on a sort of hybrid in-person virtual approach. Now looks like it's going to be largely, if not entirely, hybrid, because a lot of companies have been pulling out.
Yeah, we see Meta or Facebook pulling out. They were announcing that too as well. T-Mobile, our friends there, CEO Mike Sievert was supposed to give the keynote address at CES. They have pulled out. He will not give that address. You see some of the other names up there that have scaled back those attending. I mean, but Google, some other companies will, of course, still have a presence there, Julie. But again, this is just really the past 2 weeks. We've seen a lot of events canceled. We've covered the sports angle. Sports events been canceled. Concerts. You had the JP Morgan Healthcare Conference that has been shelved as well in terms of in person. So this is a new reality we're living in going into the new year.
Yeah, and I think there remains a lot of confusion on the part of regular Americans and the part of everyone, really. And that is contributing to some of the confusion in markets as well. We're going to, by the way, talk to Dr. Amesh Adalja of the Johns Hopkins Center for Health Security a little bit later on. But I think there have been a lot of questions over the past few days about the communication coming from the federal government, not just the administration, but the CDC and even Dr. Fauci himself, who has been making some new comments about the necessity or lack thereof of quarantining if one is vaccinated, even though we know that the Omicron variant has been spreading even among the vaccinated. So it seems as though that is now bleeding over not only into public life and this idea of COVID fatigue, which was already setting in and now is resurgent with this latest variant, but also in corporate planning and in the markets that people just aren't really sure. There's this uncertainty once again that has come into folks' calculations. And added to that uncertainty, perhaps, is not just what our administration is doing, but then you get reports out of Israel that they're now recommending a fourth shot of vaccines. And I think that just makes the situation just highly confusing.
And all this confusion, you're right on, Julie. It is being reflected in the market. One day, you're up 500 points in the Dow. Next day, you're down 500 points, and the rally's back on. But then it ends the next day. And well, where do you go? I mean, do you go out there and buy some of these FANG stocks, like a Netflix, down 11% over the past month? Who knows? I mean, where does the Federal Reserve stand right now as this Omicron variant continues to rage on? How does that impact their Fed policy decisions? And also keep in mind, we are supposed to be normally going into the Santa Claus rally. That's the last 9 trading days of the month. And going back to 1928, the market has rallied 77% of the times in those last 9 trading days of the session. And as people have called it, of course, is in fact that Santa Claus rally. So it's unclear if we will even get that.
So what we can look to perhaps are some early indications of demand for stuff that requires you to be in a space with a bunch of other people, right? And so you can look to restaurant reservations, which is something that you flagged earlier in the week, Saz. They're trending lower a little bit, but not falling off a cliff, for example. We have been getting sort of localized reports of restaurants being closed in some cases because staffers are sick. So will they reopen then once folks are well again? Will people just wait until the new year to open up? We'll have to see, but that's not showing a drop off. We can look at TSA checkpoint travel data as well. I mean, obviously a lot of folks going to be traveling during the holiday season. We haven't yet seen a drop off there, but this is the sort of real-time data that we can continue to monitor as we try to figure out what is the actual effect of this. And by the way, we're going to be getting consumer confidence numbers coming out at 10 a.m. So that will also give us a temperature reading, if you will, on how consumers are feeling right now. Well, coming up next, we'll talk to someone who's feeling pretty good right now about the end of next year. That is John Stolfus over at Oppenheimer. He has the highest target for the S&P 500 on the street. We'll be right back.
The S&P 500 is poised for another year of double-digit gains next year, with the benchmark index potentially climbing to 5,330, says our next guest. John Stolfus is the chief investment strategist at Oppenheimer. John, always nice to see you. Listen, we've talked to you many times throughout the years. What is it like to be the biggest bull on Wall Street during these volatile times?
Well, I've got to say, first of all, thanks for having me on the show, Brian. I've got to say, for us, it's we look at the fundamentals, and overall, the fundamentals have been remarkably supported by the Federal Reserve, as well as by the response to Federal Reserve liquidity via business, the consumer. It's been a remarkable thing. Everybody steps up and does their job, but the Federal Reserve, the most important part. And then we've even had, we believe, overstimulation by politicians, both administrations. And look what we've been able to accomplish, showing remarkable resilience.
John, walk us through this call a little bit. The way I'm seeing it right now, we may have 1 or 2 rate hikes next year, potentially. I'm seeing events canceled into January because of Omicron. What gives you the optimism on the S&P call?
Well, the one thing, first is the events being canceled at all. We've been through this before. And I think the president very well pointed out in his talk, I guess it was last night when he was on television. I think essentially this is not March of 2020. This is with all the experience that society, business, the consumer, et al, have experienced. We've been through this before. We can expect a certain element of slowing in segments of the economy that will be shuttered or partially shuttered. But gosh, we've got, technology and science have brought us to the dance, and they'll take us out of the dance when it comes into the next new normal.
Again, love the optimism that there's light at the end of the tunnel at some point, even if it's a little bit further off than we thought. Let's talk a little bit more about the fiscal stimulus side of the equation, which you just mentioned as one of the things that has helped the U.S. economy be so resilient. As you know, of course, Build Back Better doesn't look like it's going to pass, at least not in the very short term. Is your call contingent upon another tranche of stimulus? Does the U.S. economy still need it?
It actually isn't contingent on another round of stimulus. We think that the economy has shown that it is in good stead now, and the Fed can afford very well to begin the tapering process at an accelerated pace, end it in 3 months into next year, and then actually begin considering when it's going to be tweaking its rate upward on the Fed funds rate, its benchmark rate. We do understand, from the day, and we're not epidemiologists, of course, but from the data that's coming out from the medical community, it does appear that this variant, it will not be as disruptive as COVID-19 was, or even as disruptive as Delta was. So we'll have to see. Well, it's much more infectious, and that's very worrisome. But it does appear also, just when we talk to people want to get out. They want to get back to work. They want to get the kids back to school, but they're also experienced. It's like Jimi Hendrix used to say, have you ever been experienced? Well, we've all been experienced with this COVID thing, whether or not, if we've gotten it or not. I fortunately have not, at least not yet, and I hope not to get it. But, we maneuver, we navigate, and it's been remarkable. But again, it's been science. It has been technology, which has enabled many businesses that can deliver their products or services via technology, and it all to achieve really good results. And we've got to think that resilience will follow through, even though we'll get some choppy waters in here. And I think the market has reflected that of late.
So let's talk about consumer resilience then versus market resilience, right? Because part of what has fueled the stock rally this year has been that dual stimulus, right? Fiscal and monetary. And next year, both of them are fading. I mean, the fiscal is already fading, right? And monetary stimulus is going to fade. So What gives you the confidence that we're going to still see a lot of money coming into the market? I mean, and that said, you're not looking for a huge rally next year. You're just looking for a bigger rally than most of your peers. But what gives you the confidence that we're going to continue to see money come in?
Well, we think, for one, we think in terms of business through whether it's robotics on the factory floor, algorithms in the offices, is generating greater efficiencies in terms of maintaining margins and capability to improve cash flow and profitability. But within the consumer, over the 38 years that I've been in this business, it's very risky to bet against the American consumer. The American consumer will shift what they buy, but the American consumer is determined to buy. In terms of the withdrawal of liquidity, we just think it's been fairly well proven by the high degree of inflation that we've experienced, close to 40-year highs in inflation, that indeed, when we look at it, there probably is too much. That's evidence that there was just too much stimulus, and it's time to get back to work.
John, within your call here, which sectors do you see really outperforming?
Favorite sectors here right now remain what we've held to be this year, where we're accumulating positions in these. In terms of our outperform rated, it would be technology, which we expect will not be hurt by higher interest rates, at least the higher interest rates that we envision. We don't see the Federal Reserve slamming on the brakes, but simply pumping the brakes. We also like consumer discretionary, which offers a mix of growth and value. And then we like financials, which we think will benefit from a higher yield curve. And we think the industrials are going to do better. We've already seen indication that investors are beginning to favor them, or the latest pullback, they did hit them. But we think they're going to get a stronger appetite for industrials moving ahead, as the infrastructure program, the side that was voted positively by both sides of the aisle, as that comes online, we think that'll be good. Overall, our call is go for growthier value and GARPier growth. And the reason why we say GARPier growth, it's growth at a relatively reasonable price when it comes to growth.
And John, there are some very large, reputable firms that compete with yours out there, with calls on the S&P 500 flat to negative returns next year. Where do you think they're missing the boat?
Yeah, some of those of which I've worked for, by the way, in the past. I've got to say, I'm not going to mention any names, but listen, we think that what their call right now is similar to the fourth quarter of 2018. And it was the wrong call. It missed the fact that the thought in 2018 was that the Fed would continue to raise rates blindly, and it didn't. It pivoted. And we think the Federal Reserve remains highly sensitive. This is not Alan Greenspan's Federal Reserve, where they would slam on the brakes or they'd flood the system with liquidity, either or. This is Bernanke legacy. It's Bernanke to Janet Yellen passing on the ball to Jerome Powell. Jerome Powell, we believe, is not the greatest communicator in the world. He's a little stiff, but we think he's a straight shooter, and we think he's very sensitive, and we think the whole Fed is. Whether it's related to employment or inflation, there is vigilance on both ends of that. And we think they're going to navigate this very well. And it will positively affect business and the consumer.
Yeah, I'll agree with you. He's certainly a little stiff. We'll leave it there. John Stolfus, Chief Investment Strategist at Oppenheimer. Always good to see you. Happy holidays. All right, BlackBerry is the top trending ticker on Yahoo Finance right now. After the company's earnings last night, we'll tear apart the report to see why the stock is seeing so much interest. Next.
about 4.5 minutes. What is it till the opening bell here on this Wednesday morning? And here's a mover that we are tracking. That is BlackBerry. The shares are off by 3% this morning. They had been rising after the close yesterday, after the company came out with its numbers. And then it looks like people took another look and they said, maybe we didn't like those numbers so much. For the third quarter, the company did beat estimates, revenue coming in ahead of estimates, and the company posting adjusted loss per share that was better than estimated, or adjusted earnings per share, I guess, of break even here. But it looks like that the company's guidance is disappointing, according to some analysts. So looks like it missed RBC estimates as one example. Saz, as we know, BlackBerry doesn't do what it used to do in terms of making BlackBerries, but now known as a software and security company. And it's also a company that sort of got memed earlier in the year, along with so many others. What do you make of these numbers and the action that we're seeing in the company?
Yeah, it was a bit of a snoozer to me, Julie. Go through the numbers here. The conference call didn't really get me fired up, certainly. And let's keep in mind the stock was about almost $29 at the height of the meme stock mania in late January. But you look at the margins in their Internet of Things division, those were flat. Cybersecurity division, those margins also flat. Licensing business down about 600 basis points year over year. That wasn't good. Company said on the conference call they have not yet finalized their deal to sell off a large part of their patents. Market doesn't like that as well. All in all, stock, it's right to see the stock declining the way that it is. But it does, I will say this, Julie, remind me of how much I used to be a big BBMer on my BlackBerry way back in the day. It was a very exciting time. Very exciting.
I think all are exciting times for you, Brian Sazi, in the Saz world. Yes, I was also a BlackBerry user and BBMer back in the day as well. So we'll keep watching BlackBerry there. Again, the shares are now down nearly 4% in pre-market trading. Let's also focus on Carmax, which reported its numbers this morning as well. It looks like that company came out with earnings per share that beat estimates, $1.63 versus the $1.44 that analysts were predicting. And those shares are trading higher. Revenue rising 64% year over year to $8.5 billion. Used vehicle sales, they're up 53%. Wholesale vehicle sales coming in ahead of estimates as well. So it looks like on a number of different fronts, the company beating estimates here. Comparable store used vehicle revenues up 51%. So, you know, the car business continues to do well for companies like this.
Yeah, Carmax doesn't really do it for me either today, Julie. I think the play all this year has been AutoNation. We have talked to now outgoing CEO Mike Jackson numerous times. The AutoNation shares have outperformed Carmax really since March of this year, as they should. I mean, that company has been more aggressive on stock buybacks, more aggressive opening up new locations, more aggressive, I would say, in taking market share. You had Carmax on their earnings report today say they only opened up one dealership in the quarter. Will open up 10 for this year during a major boom in sales of new and used cars. To me, that's not getting the job done. Also, margins didn't really excite me either here.
All right. Well, so much for that. I mean, I guess I
sound bullish. AutoNation and Carvana. Those are the real plays here. Carmax just chilling out there in third place.
Do you miss being an analyst, Saz? In moments like this, I feel like you want to give like some buy and sell recommendations, but you can't quite do that.
I can't do it. I continue to stop myself, though. I've got myself out of that habit about a year ago, so I'm good.
Yeah, that's probably,
I've cleansed my soul.
Best.
I don't want to be an analyst anymore. I've cleansed my soul. Though that era's done.
I am curious as we start to see pricing come down, and I don't know when that's going to happen more consistently for both used and new cars. It'll sort of be like just like the rising tide lifts a lot of boats. When the tide ebbs, we'll see which boat is still ship-shape, so to speak. So, I think it'll become more clear with this proliferation of online and in-person car dealers, which one of them is in the strongest position as we start to see pricing wane in the coming year. That's what it feels like.
What I do find interesting, too, on another note, how these car dealerships are planning for an electric car future. It's one thing to start offering these on the platform, Julie, but I still don't think the service stations are in any way set up to support these electric vehicle ambitions by the big three automakers. I just drive by the service stations by me. I mean, I don't see any signs suggesting they can service electric vehicles. I'm not sure if they have the infrastructure to service electric vehicles yet. So I would expect CapEx is going up for all these guys in the coming years.
Interesting. So we'll see what they have to say about all of that as well. We are just about 30 seconds from the opening bell at this point, and we've got the major averages pointing to a slightly lower open, although the Dow and the S&P futures are really coming back to almost unchanged level here on this Wednesday morning. We've seen a lot of gyrations in recent days based on Omicron and other factors. We'll see what happens today. Boxed ringing the opening bell here this morning. I'm sure they're preparing for the holidays just like everybody else is. Oh, one mask on the platform here today. I don't know what, I guess we've got sort of a mask indicator here as we
Time to unbox a package of masks. Come on, guys, let's get on that.
Yeah, I don't know. We'll be keeping an eye on that platform day by day. Jared Blickery, he likes to keep an eye on that platform as well. Now he is doing it virtually instead of in person. And Jared, so it looks like we actually are looking at a mixed open here this morning. Indications were looking a little bit uglier when we came in, and things have been steadily improving here. But, as I pointed out earlier, it's thin volume times because it is pre-holiday here. But nonetheless, it's been very interesting in recent days as people try to assess what the heck is going on with this variant.
Yes, I think so. And probably I think a lot of traders are just hoping that things finally settle down a little bit. And that seems to be what is happening. Of course, that means there's a violent price movement to the opposite side imminent. I'm kind of kidding. So let's go to the Wi-Fi Interactive, where I am charting the 5-day price action in the Dow, and you can see we basically retraced half of what we lost. So 50% line, kind of a target for new shorts. So we'll have to see what happens. S&P 500 similarly situated, but we do have some bullish seasonal factors, which we talk about every single day. And you can see the Nasdaq still off about 1.5% over that time frame. Do want to get a check of the bond market. I'm going to go to my 1-month candlestick view here, and it looks like bond markets have settled down in terms of volatility as well. We can see over the last 3 months that we've had a lot more price action in the past, but we are now pretty much in the middle of this range, and we could actually trade down and kind of settle in here for a few more trading sessions, perhaps into the end of the year. Won't read too much into that. That's a 5-year T-note yield, by the way, down about 1 basis point today. The 10-year down about 3 basis points, and the 30-year down 3 basis points. So the yield curve is flattening just a little bit. U.S. dollar taking out lows from yesterday, so just kind of been in a trading range over the last month itself. So nothing new on that front. And let's get to some heat maps. So here's the NASDAQ 100. Standout is Tesla, kind of in the middle there. It's up 3%. JD.com is down 3%, but not a lot of big movers. And that's kind of nice to see indications of that lower volatility. I do want to check out the pharmaceutical sector. There's an announcement coming expected today on the Merck and Pfizer anti-COVID pills. So we could get some positive price action off of that just because there's not a lot else happening today. So want to be on alert for that. Do want to check out the travel sector as well. That's under a little bit of pressure here, kind of with that flattening yield curve, kind of indicating not as much appetite for risk, at least in terms of the value sector. But you can see Trip.com down 4%, but Live Nation up 7%. I'm going to have to see if there's some news on that one. I mentioned Tesla before. Tesla's up 3%, and looks like we got one mover down here. That's Luminar. And let's get a year-to-date chart on Luminar. You can see still down 50%, but up 4% today. Also want to check in on ARC. Now, these are some of the ARC components, not all of them, but you can see aside from Tesla, really slipping into the red here. Now, I want to check out the last 5 days here in the ARC fund, because 5 days back, we had the Fed announcement that was kind of let's get that behind us. And a lot of these names took off after that. So we are seeing some retention in gains among these names. As far as the potential Santa Claus rally, which really begins next week, continues into the first 2 days of January, what are we expecting there? Well, who's to say? But we have seen some interest in the value stocks, although it's been quite the defensive setup lately, guys.
And Jared, the month is almost over. Anything stick out to you?
Yeah, I was looking at the Wi-Fi Interactive, and if I do a month-to-date view of the sector action, I think it's pretty telling what's going on in December, because we see a lot of defensiveness in the leaders. Up in the upper left, XLP, that is staples, consumer staples, that's Walmart, that's Coca-Cola, those stalwarts, those are in there. And the top four here are real estate, in addition to staples, healthcare, and utilities. So traders have really been packing on the defense this month. It's been higher than average volatility for December. Really, usually we don't get this kind of price movement, although we did 1 year ago. And in the lower right, I just circled consumer discretionary. That is the loan sector that is in the red for the month. And let me just take a look at the retail sector there. Some of the standout names to the downside. We got Wayfair down 16%, American Eagle Outfitters, that's down 11%, Buckle, that's down 10%. And some of these stocks were really high flyers. Buckle, one of the best performing stocks in its class earlier in the year, but you can see it's really fallen out. And one of the trends I've noticed lately, and this has gotten some analyst attention, is that the stocks that are performing well this month, well, they tend not to be the high valued stocks. So high valued stocks have really gotten hit. And if we take a look at the ARK Innovation Fund, you can see kind of a bifurcated market here. We got Coinbase, that's down 16%. We were talking about that yesterday. Square down 13%. Tesla down 11%. So some of the high value stocks really getting knocked back to reality. And finally, I want to take a look at what's happened at crypto so far in the month of December. And we can see Bitcoin is under a little bit of pressure there, down 3.5%, Ether down 10%. But even crypto is kind of quieted down lately, not seeing the huge volatile moves that we've seen at least previously, several weeks ago, several months ago. It seems like an eternity, guys. I got to tell you, I don't know about you guys, but spending the entire day in my house every day and not walking down to the New York Stock Exchange twice per day puts a different spin on things. Haven't worn shoes.
I recommend a dog so that you will be forced to go outside and walk the dog. That's my secret in terms of working from home all day. Yes, but yes, it's time has no meaning anymore. Thank you so much, Jared Blikre. Appreciate it. All right, we're going to take a quick break. When we come back, of course, there have been let's bring your stat of the day. I almost forgot.
Yeah, thanks.
Despite many reminders. The once hot FANG complex, it's limping to its conclusion of the year. The average FANG stock down 5% over the past month. That's according to Yahoo Finance Plus data. The worst performing member during that span was Netflix. It fell 11%. The sell-off in FANG has been so ugly. Amazon stock fell below its 200-day moving average on Monday. We'll see if that ends up being resistance or support, as Jared Blikre would say. Now we're going to take a break. There have been many, many COVID headlines that we've been tracking here this morning. I know it's tough to make sense of all of them. We're going to get a little help after the break with Dr. Amesh Adalja of the Johns Hopkins Center for Health Security. We'll be right back.
Some reports out this morning suggest South Africa's Omicron-driven surge in new COVID cases may have peaked. That hopeful news comes as Omicron continues to spread aggressively in many parts of this country. Joining us now is Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. Doctor, thank you so much for joining us. So we did get a little bit, a sliver of hopeful news this morning, but we still continue to see cases here in this country rise. I mean, is there anything in the data that you track to suggest we may be nearing a peak?
Nothing so far, other than what we've seen in other countries like South Africa, the UK, and Denmark, that these waves with Omicron seem to go quicker than Delta waves, and Delta waves went quicker than other waves. And it may have to do with who's getting infected and network effects of that go on in the community and how people change their behavior in response to increased levels of cases. But I think what we can expect is the next couple of weeks, we're going to see cases rise. The goal is going to be making sure that hospitals in some parts of the country that are already stressed with Delta have the capacity, have the staffing to be able to operate. And that's going to be the key thing. We're going to see kind of a two-track pandemic, something where the vaccinated basically get their inevitable breakthrough case and they go on with their life, but high-risk unvaccinated individuals may end up impinging on hospital capacity.
Doctor, there's a lot of confusion out there, I think, right now about what people should be doing in terms of travel, in terms of testing and when they should be testing and for how long they should be quarantining. Do you think that public health officials are doing a good enough job right now? And I speak specifically of the administration in terms of communicating. And I think with the understanding, I should say, we all realize that there's still a lot of uncertainty, but the things that we can be certain about, do you think they're doing a good enough job with that messaging?
No, I think there's been missteps throughout this pandemic with public health communication. I think that's one of the stories of this pandemic, is that we could have done a lot better just with better communication to the public and wouldn't have kind of had the country divided into kind of two different camps if there was better public health communication. But I do think that what we need to be clear with is, if you're fully vaccinated, and you heard the president say this, you have a different trajectory when it comes to this pandemic because you're protected against what matters: severe disease, hospitalization, and death. And for those people, they can, for all intents and purposes, go back to enjoying their life. They can test if they want to minimize the risk, but a lot of this for them is going to be risk calculation because they're inevitably going to get a breakthrough case of Omicron. That's not something that's avoidable. When it comes to the unvaccinated, the message still has to be get vaccinated, and get vaccinated quickly, because Omicron is going to be coming for you. And if you're high risk, you may end up not having a hospital bed if your hospital is already getting crushed with Delta. But I think we've got to teach people how to risk calculate and really be honest with them that this is a virus that's not magically going into bats. It's going to be endemic. We're always going to have some level of COVID-19 risk. And the post-pandemic world is not the world of 2019. It's a world in which COVID-19 is ever present. And I think that was something that hadn't been said or articulated much. Yesterday, I think you saw the president finally kind of acknowledge that, saying breakthrough infections are going to happen everywhere. That's what we expect, but that's not something to worry about if you're vaccinated, because that's what the vaccine was meant to do, is make all those breakthrough infections shift towards the milder side of symptoms.
Yeah, I mean, I think it's more of a question of, if you get a breakthrough infection, if you're vaccinated, you might not be adversely affected. It's more a question of who you might be adversely affecting, right? And so on that point, Dr. Fauci has recently made comments about that maybe folks don't need to quarantine or don't need to quarantine as long, even if they're positive, if they've been vaccinated. Does that feel like the right guidance for you? How should people be thinking about quarantining at this point?
It's absolutely the right guidance, because we can't apply a one-size-fits-all isolation period to everybody, especially when you're talking about breakthrough infections, where we know that the contagious period is significantly shortened. So what you can do is use rapid tests to be able to determine when you become not contagious. So you can take a rapid test every day or every 12 hours. And when you start becoming negative, you can then end your isolation period. So I think we can go from that 10 days probably down to 5 days for some people. And I think that's going to be really important, because even though breakthrough infections are mild, the fact that people have to isolate for 10 days is really, really disruptive to their lives, to the economy, to everyone. So once we can get to the point where this becomes guidance, that you use tests to end your isolation period or to end your quarantine period, that will be something that everybody will really welcome. And I think there's data to support it. Hospitals are already doing that. We're hearing about NYU going down to 5 days. This is something that I think really has to be part of how we learn to navigate with this virus, to make it much more manageable, much like other respiratory viruses. If you have the flu, they tell you to stay home until your fever goes away for 24 hours. I think we'll get to a similar point for the vaccinated with COVID-19.
Doctor, we're changing the definition of fully vaccinated be helpful in getting the pandemic under control.
I don't think so. I think when it comes to getting the pandemic under control, what we're really trying to do is prevent severe illness, hospitalization, and death. Fully vaccinated individuals are protected against those metrics. When I work in the hospital and I take care of patients in the intensive care unit, it's not people who lack a booster that are there. It's people who lack first and second doses. So I don't think that there's any way to say that someone who has 2 doses of the Pfizer Moderna vaccine or 1 dose of the J&J vaccine is equivalent to someone who has 0. And that's what changing the definition of fully vaccinated would mean. I think we should stick with the definitions now and emphasize booster vaccinations for those at high risk, people above the age of 65, people with high risk conditions that put them at risk for hospitalization, and those who got the J&J vaccine. But keep the definition the same because it really reflects the fact that you're protected against severe disease, especially if you're a healthy person.
Doctor, it seems like this current wave, that testing is more important than it has ever been because of its level of transmissibility. And yet we can't get tests. What should people do if they can't get a hold of a test right now?
They have to be innovative and try, and I would call around, drive to different towns, use online ordering. It's really inexcusable that this is happening now, this far in the pandemic in the United States, when all of us have been clamoring for better access to testing from the very beginning. I've always said that the original sin of the pandemic has been testing, and it continues to be a sin that the government commits. What I think people should do is also ask why they're getting tested. If you're fully vaccinated and you're just doing it for screening, I think there's less value in that situation than if you're exposed or if you have symptoms. So in those situations, if you've been exposed, you probably should be careful until you can get a test. Maybe you're going to have to get a PCR test, but that's a problem as well because the turnaround time might be 5 days and it's completely worthless when you get the result back. It's really just a horrible situation. It is another failure that we've seen. And it's, to me, inexcusable because it's not something that was not forecasted. We knew that this was going to be a need, especially as people want to get back to their lives and they see testing as a way to do it safely because they can know their status and take protective actions based on whether they're positive or negative.
Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. Good to see you. Thanks so much for making the time this morning. We appreciate it. All right, coming up, we'll wade into the sustainable investing pool to get a pulse on the industry and potential investing opportunities in the new year. Do stay tuned.
Well, the ESG trend has certainly been gaining steam here over the past 2 years in the United States. And companies are trying to integrate it into all kinds of operations, including how they finance operations. Aaron Franklin is joining us now. He's head of sustainable finance at SMBC. Aaron, thanks for being here. So first of all, just give us sort of a big picture view of what sustainable finance means right now. I imagine your job has evolved quite a bit over the past few years. So what does it entail? How should we think about what sustainable finance is?
Sure. Thanks for having me here. The way to think about it is corporate finance transactions, bonds, loans, where you incorporate a connection between the financing and sustainability. This generally has meant one of two things. First is that you're talking about how the money's going to be spent, and this is where you have things like green bonds. And the other, more recently developing innovation is that the financing costs actually shift depending on how the issuer or borrower does on sustainability-related metrics. That's the kind of corporate finance version of sustainable finance, as opposed to the kind of retail asset manager side of sustainable investing.
Aaron, what is the pipeline of deals looking like into next year?
Well, it's going to be another busy year. And 2021 was a huge growth year across sectors, across geographies, different products being innovated. We spend a lot of time with our clients trying to come to grips with how this market works, dealing with pressure from various stakeholders to show strong ESG performance. So we're going to see a lot of folks who started paying attention to this in the past couple of years, who have developed a strategy, developed the right disclosure, and are now going to be ready to come to market. We'll see folks in all sorts of different sectors, probably some more harder to abate sectors, sectors where it's not just good performers, but those who are trying to move in the right direction, even if they have a bigger ESG impact.
And Aaron, do you feel like when you're talking about things like green bonds, there's always the question of accountability, right? And sort of realness, for lack of a better word, of various ESG efforts. Because of the financial linkage here, is this an area where there is real accountability, more so than just sort of making promises in a company's annual letter, for example?
Well, that's a great question. I think this year has seen tremendous improvements around the way that the market understands accountability, verification, the procedural elements of this. But it's important to note also that what's driving ESG improvements, climate transition, it's a million different things. Stakeholders from equity investors, employees, regulators are all pushing companies to really change their operations, invest, have a plan for how they're going to deal with the changing world. Finance is a way to communicate that, to show real commitment around that. But it's not financing that's pushing everybody to do this. We're part of it and a part of emphasizing that. But we wouldn't want to go so far as to say that it's driving the whole thing.
And Aaron, is Europe ahead of the U.S. in terms of what you do?
Well, it's another good question, and it's a very common narrative to point to Europe with their green spending plans, targets, their taxonomy of what business activities can be called green. But I'd frame it a bit differently, that the United States is really poised to go on its own journey, run its own race in 2022. It's a lot less of a policy-driven market in the United States and a lot more driven by what asset managers need to see, what banks need to see, and how companies can differentiate themselves. That's distinguished from the European approach of having a bit more of a top-down, did this comply with the definition of sustainability?
Aaron, thanks for being here. Obviously, ESG going to be a big focus. We'll see what those numbers end up being in 2022 after a big 2021. Aaron Franklin is head of sustainable finance at SMBC. Thank you. Well, coming up next, stock buybacks also set a record in 2021. Sals isn't happy about it. We'll find out why next.
Nope.
The record number of stock buybacks this year, the record amount, I should say, definitely one of the things that helped underpin the stock market. Brian Sazzi doesn't like it though. Saz, would you rather what do you want them to spend their money on?
Well, I can't give everything away right now, Julie. Let me run through the stats first. Geez, let's some new data out of S&P that tracks this very closely. Have to give my man Howard Silverblatt a shout out. This guy is an institution on Wall Street, and his data never disappoints. Stock buybacks or share repurchases, whatever you like to call them. You say tomato, I say tomato. In the third quarter, they were up 18% over the previous quarter here. So a big quarter for stock buybacks. The top 20 largest issues or companies accounted for 53.8% of those third quarter buybacks, talking about Apple, Facebook/Meta. They were, of course, both big buyers of their stock, as was Google. And really, for the 12-month period through September, we've seen companies repurchase $742.2 billion worth of their stock, up 21.8% year over year. So again, you see those companies right there, those top 5 companies repurchasing large amounts of their stock. And even further down the list, you have the likes of Visa and MasterCard as well, repurchasing large amounts of their shares. But Julie, to your point, I have historically not been a fan of stock buybacks. I would much rather see companies pour their resources back, pour back into capital expenditures, make those longer term bets instead of trying to pop up their stock price and boost the big fat wallets of their executive team, which in many cases, their compensation programs are tied to earnings per share targets.
Well, I guess the question is, are they doing both? I mean, what do we know thus far about CapEx this year? And, because if they have a lot of cash on their balance sheets, which I believe they do as well, are they deploying it in, is it sort of a multifaceted approach? I think your argument makes sense if they're doing one at the expense of another, right?
Yeah, CapEx, I would say, is not growing at the same pace as stock buybacks. Stock buybacks are just easier compared to, let's say, if you are a tech company to go out there and spend a couple $2 billion and commit to a new plant out there in Arizona or in the desert somewhere. But I still would rather see them companies invest more in their people, more in plants, more in machines, more in digitization, because the world, as we continue to learn here during the pandemic, is ever changing, and you have to be positioned correctly.
Yeah, most definitely so. And we're awaiting some consumer confidence numbers coming out from the Conference Board on that front. And speaking of an ever-changing world that you have to really keep on top of, it looks like the number's coming in at 115.8. 115.8, that consumer confidence number. Just looking for the estimates here, it was 111 was the estimates, coming in better than estimated. And the prior month, November, being revised upward as well. So very interesting there.
Surprising.
Also, we're getting existing home sales. That's coming in a little lighter than estimated. 6.46 million is the annual pace. We're going to dig much more into these numbers in just a moment with Brian Chung. So stay right here.
Hello there. Welcome back to Yahoo Finance Live on this Wednesday morning. I'm Brian Sazi, and that right there next to me on the screen is Julie Hyman. Stocks are crawling into the close of the holiday-shortened trading week. We are seeing another day of cautious buying as the Omicron variant continues to spread quickly around the world. Seeing the Dow slightly in the green, S&P 500 and Nasdaq also, again, slightly in the green. I do want to get over to Yahoo Finance's Brian Chung now for more analysis on that breaking consumer confidence report. Brian.
Hey, Brian. Yeah, well, we're getting a slew of economic data this morning. As you mentioned, the consumer confidence coming from the Conference Board. This is not the University of Michigan releasing their figures showing that the consumer confidence index sat at 115.8 in the month of November. That is a tick up from the 111.9 that they had seen in November. What's interesting was that not only beat the estimates that people had expected for the month of December. Wall Street estimates were about 110, but actually the November revision up is what caught my eye because as you'll recall, a month ago, the number was actually something closer to 109.5. That was a tick down from October. A lot of people freaked out and they said, whoa, this shows consumer confidence is really slowing because it was 111.6 in October, dipped down to 109.5, but this new upward revision actually shows that the October to November period actually showed an uptick, and the December number that we got just this morning shows that trend continuing to go up. So the concern about consumer confidence doesn't appear to be manifesting as much as it did when people first initially read that November report about a month ago. So maybe things aren't as bad when it comes to people's concerns. Now, of course, one question naturally is whether or not the Omicron variant is going to change that because of the rapid situation, the fact that the flare-up in the amount of cases really only happened as of the last few weeks shows that maybe consumer confidence isn't fully reflective of the Omicron variant, at least in this report. We might have to wait until the next report to get that figure. And then one other thing that's worth mentioning, since we're getting a number of economic data reports, want to point out existing home sales coming in at 6.46 million, a bit lower than the street's estimates of 6.53 million as well. So very busy Wednesday morning ahead of this holiday season, guys.
Yeah, and we didn't mention one of the other reports that was out earlier. Speaking of busy, that was GDP. And, you know, it's not as important because it was the third read of the third quarter GDP. But what's notable here is we did get an upward revision.
We did get an upward revision. It was a small revision, but it was an upward revision. So the last read that we had gotten, again, this is for the third quarter, which covers the July to September period of the year 2021. It was originally 2.1%. They revised that up to 2.3%. Now, again, for comparison, that is a lot slower than the 6.7% that we had seen in the second quarter of this year, which covers the March to June period. But that was very much expected because, again, a lot of that fiscal relief was a little bit more pronounced in the second quarter, also in the first quarter of this year. We know that the unemployment insurance was starting to fade as of some periods in that third quarter. So no surprise to see that economic activity was slowing. What is interesting and something that I always frequently remind people when we talk about GDP is that the 2.3% figure doesn't mean that the economy grew by 2.3% between the second and the third quarter. What it means is that if you were to take the pace of growth in those 3 months and then extrapolate it to a whole year, it would be 2.3%. So just keep that in mind when you're reading these numbers. It's not like it's necessarily that easy to understand exactly how to translate those into year-over-year figures. It's not really until we get the fourth quarter reading where we can kind of take a look at the whole year 2021 and say this is exactly how much the economy grew by. But again, this is the third estimate, a little bit more pinpointed and accurate than the other readings that we had gotten for the third quarter, guys.
Duly noted there, Brian. And I know you're also locked and loaded on a PCE inflation report.
Absolutely, yeah. So and that's going to come tomorrow. So again, we still have more data releases to come for this week, but a very important read on personal consumption expenditures. This is one of two major readings on inflation. And we already know what we had gotten from the consumer price index showing a very, very hot print in the month of November. PCE takes a little bit longer to process, but the expectation for tomorrow is that on a month-over-month basis, at least in the month of November, prices are expected to show an increase of 0.6%. On a month-over-month basis. On a year-over-year basis, the so-called PCE deflator is expected to show 5.7%. Now, that's lower than that 6%-ish reading that we had gotten on the CPI, again, the other alternate reading of inflation. But we have to keep in mind that PCE and CPI read prices a little bit differently. Generally, the interpretation is that CPI tends to read inflation at hotter levels than the PCE does. So it's a little bit expected for it to be lower than what we usually see on the CPI. But 5.7%, guys, important to remember, that would still mark a very hot print historically. Keep in mind that the last print that we had gotten on PCE for the month of October was 5% on a year-over-year basis. And guys, last time we saw a number that hot, 1990, before I was born. So we'll have to see if that number clocks in even hotter than that when we get that number tomorrow morning.
Well, Brian, last time I saw a Binax COVID test really 3 weeks ago. Where'd you get that one behind you?
No, here's the thing is that I feel like I like to call what's behind me the flex shelf. You know, it's usually the hottest sneakers on the street, but the thing that's hottest right now is one of those rapid COVID tests. So I figured I'd pop it on the flex shelf for all of our viewers to see as well. I'm not going to flip that, though. I'm not selling that on StockX. Don't worry about it.
Okay. Brian Chung,
you probably
correspondent flexing with his Binax COVID test made by simple ABT. Brian Chung, you're the man. See you later. All right, let's head over to Yahoo Finance and Nez Ferre, who's maybe flexing over at the Wi-Fi Interactive. Nez.
Yeah, Brian, I can't beat Brian's background there, but I can show you what's happening on the Wi-Fi Interactive board right now. We are looking at the 11 sectors of the S&P 500. We're seeing consumer discretionary that's slightly higher, but we're watching energy stocks, lagging communication services, and technology flipped into green territory. So is Microsoft and Google. The big outperformer here being Tesla, up more than 4.5% after Elon Musk said he sold enough shares to reduce his stake by 10%. Shares, though, are about 20% lower from their November 4th peak. But nevertheless, that overhang of Elon Musk selling shares is now gone. Taking a look also at the Dow, we are watching Caterpillar, the big outperformer here, up more than 2%. And then just looking at the travel sector, we are seeing some green across the board here, adding to yesterday's gains for some of these travel names. I'm going to pull up the 2-day chart. You can see quite a bit of green for the airlines, for the cruise operators. And looking also still on that 2-day chart, I just want to pull up the Chinese companies that are trading here in the US. We are seeing gains for these Chinese names, but today's action is a little bit different. Baba pulling back about 4%, Pinduoduo down about 3%. And then I also want to mention what's happening with some of the meme names. BlackBerry, which had become a meme name earlier this year, down about 5% after BlackBerry beat on the top and the bottom line. Its guidance, some analysts not liking some of the guidance from the company, but still, nevertheless, this is, we put it in that meme stock basket. Also want to mention Naked Brand Group. Remember this company, they had announced an acquisition of Central Automotive. That's an EV technology company earlier this year, down 17% after a reverse stock split, a 5-for-1 reverse stock split. So we are watching some of these names. Robinhood also a little bit lower today, trading just above the $18 share level. Brian?
All right, thanks so much, Inez. Sports seasons are in chaos as the Omicron variant causes fresh problems for schedules. Yahoo Finance's Josh Schaefer is back with the details on all this coming right up.
Elon Musk's SpaceX, the headquarters, has the highest number of COVID-19 cases of any workplace in Los Angeles County. That's according to the County Department of Public Health. The rocket factory recently had at least 132 workers test positive out of its 6,000 employees, so still a minority. But that accounts for nearly 30% of LA County's recent workplace case count. The second highest workplace case number was at the LA Airport FedEx facility with 85 cases. SpaceX said that the vast majority of cases were contracted outside of work. About 1,400 Kellogg union workers approved a new 5-year contract ending a 2.5-month strike. The new deal includes pay raises, new health benefits, pension multiplier increases, and wage cost of living adjustments. The deal comes after the workers rejected another tentative contract earlier this month. Kellogg is one of several companies that saw employees go on strike this year. Others include Mondelez and Deere. And bad behavior on flights has been on the rise, and the Transportation Safety Authority has a new punishment. Passengers who act out of line during flights could lose their TSA pre-check status. The Federal Aviation Administration will notify the TSA about passengers who face fines for bad behavior, and those passengers can ultimately lose their pre-check eligibility. This year, the FAA has initiated over 300 enforcement cases against passengers, and there have been over 5,500 reports of unruly passengers. In 2019, by comparison, the FAA initiated less than 150 investigations into passenger behavior. Saz?
The NHL is beginning a league-wide shutdown today due to a rise in positive COVID-19 test results amongst players. Yahoo Finance's Josh Schaefer has more on this. Josh, wow. And how long will this continue?
Yeah, so the pause is going to go through December 25th, Christmas, and then they'll be able to return December 26th, barring a negative test for players, which the NHL has struggled with recently. The NHL had over 15% of players before this pause were in COVID-19 protocol, and they've had 50 games postponed thus far. So they're the first league that we've seen in the winter here that's gone on a kind of extended pause. We'll have to see how that shakes out. But what's really this is going to impact is the Winter Olympics. So the NHL kind of needs a place to play these games now. They were going to take a 2-week pause later in the season for players to go over and play in Beijing. They're kind of rolling back on that now. There's COVID concerns, players going there, getting stuck in China, maybe gone for 3 weeks, and then it turns into 5. There's also concerns of just they need a time to play 50 games now. They need to make up 50 games. So they're going to try and make these up in the 2 weeks in February, potentially. But it's unclear how that's going to shake out because a lot of the stadiums aren't owned by the teams. And so these stadiums have planned concerts and other events for that February time period. So it's not really clear if they're going to be able to play the games then. And then there's the other question for the NHL, which is an international league with 7 teams in Canada. How can they handle this better? They've had players in the past couple of weeks get stuck over in Canada for a week at a time, isolated in a hotel. Can they figure out the border thing come December 26th? Is pretty unclear, and I'm not really sure how they're going to do that. Last year, they went to the solution of having only Canadian teams play Canadian teams and the U.S. teams play U.S. teams. Maybe we'll see some sort of move like that mid-season, which could be chaotic.
Wow. So all of this is very, very complicated. And those complications make it perhaps even more notable and maybe puzzling, I don't know, that the NBA says there's not going to be any kind of pause to the season. Apparently, that's what Commissioner Adam Silver is saying.
Yeah, NBA Commissioner Adam Silver last night came out and said that there are no plans to pause. And he pretty much said, or he did say, we're going to have to learn to live with the virus. So the NBA and the NFL are taking a different stance than the NHL. They don't want to do as frequent of testing. The NFL is now not even testing asymptomatic players, they're not going to test asymptomatic players and they're going to let them play. And the NBA is kind of going potentially with that route. They haven't gotten there with testing yet, but they're just playing with teams that don't have enough players that could potentially be infected that haven't tested yet. The plan is to just push through for the NBA and NFL. And as we've seen with 50 NHL games postponed, the NBA and NFL ignoring the virus, while some might say it's not the right decision, is at least keeping their business going for now. And it'll be interesting to see how other businesses sort of take what the NBA and NFL are doing, pretty publicly facing businesses, letting asymptomatic people participate in activities. Is that something we're going to see continue as a trend in business? Will be interesting to watch.
Well, you will be here to break it all down for us. Yahoo Finance's Josh Schaefer. Good to see you. All right, 'tis the season for holiday returns. Our next guest says returns will hit record highs this holiday season. because of the major shift to online shopping during the pandemic. We'll dive in next. Consumers will return at least $66.7 billion in holiday purchases, up 13% year over year and 45.6% over the previous 5-year average, according to a new report from Optoro and CBRE. And that could spell bad news for retailers, as every return comes at a cost. Adam Vittorello is the president and co-founder of Optoro and joins us now. Adam, nice to see you this morning here. What's causing all these returns?
Good morning, Brian. Thanks for having me. Yeah, so the big cause of the returns is e-commerce. So we all like the convenience of being able to shop from home. But with that, you got to touch and feel those products. And maybe that, shirt that your mom got you or the present your uncle gave you for Christmas, isn't quite to your liking. And so you have to find a way to send it back. And it's, as you mentioned, there's going to be a record number of returns in 2021 as we've seen a growth in e-commerce.
And you guys are processing a lot of these returns. Who's paying for it now? Because I just on an anecdotal basis, Adam, I've been surprised, shame on me for not reading the fine print, but lately when I return things more commonly than it used to be, the cost, I'm bearing the cost of returning stuff. Is that change? Has that been a change?
Yeah, I think the short answer is we're all paying for it. We're paying for it in a few different ways. One is a lot of companies are starting to charge for return shipping, although I would say that trend is generally going down as retailers realize that, kind of annoying customers and tagging them with the return shipping costs is actually going to make them not shop again. And that's why folks like Amazon and Zappos and others don't do that. But more broadly, this incurs, I guess, two big costs that we all incur. The cost that this gets passed on to retailers, over $20 per return. And so they pass that along to consumers, and we all pay for having an inefficient returns process. And then even bigger picture, the planet pays, because many of these goods actually go into landfills. Almost 6 billion pounds of returns end up in landfills every year. And that's something that isn't nefarious, but just is the byproduct of an inefficient system. And we're all paying for that. And as we're looking for a more sustainable, more ecological future, this is one of the problems we got to solve.
I think Julie got me a couple Xenia suits for the holiday season, all of which I will not be returning. I know those are very expensive. But who ultimately, I mean, this comes at a time where we're seeing massive supply chain bottlenecks here, Adam. Does that, all these returns, will that impact me being able to get this new stuff that I want in January and February?
Yeah, absolutely. There's two big impacts on this supply chain crisis going on. On one hand, it's going to exacerbate it, right? Because the Postal Service, the shipping carriers, they're now going to see an influx in returns, and right now is kind of the second peak, right? That's coming through as all these goods that were bought and being returned are now being shipped back. And so that's going to put a lot of pressure on supply chain. On the flip, it's a big opportunity for retailers because this is actually a great source of inventory. So rather than having to ship the goods over from the Far East or from overseas, you can actually just repurpose these returns and get them back in the hands of consumers. And so the folks that we work with, like American Eagle, IKEA, Best Buy, are really using this return stock as a great opportunity to get the next inventory back to consumers and not wait for the stuff to come overseas.
I mean, to your point, though, Adam, a lot of the stuff doesn't get back in the hands of consumers, right? Which is the environmental issue as well as also if you're shipping everything everywhere. Do people need to be a little more choosy again about? I feel like there has definitely been a cultural shift and a higher willingness to return. You shop with that in mind, right? Do you think that needs to change again?
I think people and both consumers and retailers need to be conscious of the decisions they make around returns. I don't think it's fair to say that, hey, if a retailer sent you something and it doesn't fit, or hey, you just got to keep it because it's not gonna, it's gonna have a bad environmental impact. I think more importantly, you have to retailers and consumers need to choose ways of dealing with returns that are more ecologically friendly. So, for example, returning something to store has a way lower carbon footprint than returning it via the mail. And retailers that have good systems to repurpose these goods and not just kind of throw them away. And even something innocuous or seemingly innocuous, like telling a customer to keep a good, is actually really bad for the environment, because most customers, something like 70 to 80% of customers that are told to keep something end up throwing it away. And so we would tell retailers, rather than do that, let them return in store where it's really cheap and then repurpose it right from there. So we all need to be conscious about doing the most environmentally friendly option. And for example, Amazon actually shows you when you go to return it, hey, this is the most sustainable option to return it to store. We think innovations like that are really going to drive better customer behavior.
Good advice there. Adam Vittorello, president and co-founder of Optoro. Good to see you. We'll check back with you soon. All right, Jefferies is getting bearish on Adagio Therapeutics due to uncertainty around next steps on its COVID efforts. And you can see the stock is, getting smacked around this morning. The analyst behind that call joins us on the other side of the break.
Well, so much attention is focused on the sort of big name drug makers and their both vaccines to prevent and treatments for COVID-19 that you forget there are some other smaller drug makers that also have things in development. One of them is Adagio. And I got a new call from Michael Yee over at Jefferies today, who is skeptical of this drug's chances, at least at boosting the stock. Michael is a managing director at Jefferies, and he joins us now. So for folks who are not as familiar with this company and its efforts, talk us through what they've been doing and why you don't think it's necessarily a great signal for the stock.
Hey, thanks for having me. Great to be here. Adagio has been working on a next generation long-acting antibody for the treatment and prevention of COVID. It's a next generation antibody that is supposed to be better than the Regeneron and the Lilly and the other antibodies that are out there and approved. And it was supposed to be significantly more potent and longer acting than the others. However, recent data over the last week or two suggested that the potency on Omicron specifically could be 20, 40 to 100-fold less neutralization on Omicron than on the other variants. And so that leads us to believe that the ongoing treatment study and the prevention study could be at risk, both from a timing delay risk and enrollment risk, and ultimately the data over the next year.
I mean, it's so hard to keep track, right, in terms of this fast-moving virus and what is going to be most useful from a therapeutic perspective, since we know, or maybe we don't know, we think we know, that Delta seems to cause more severe illness. If this treatment is effective versus Delta, then there still would be presumably some use case here. I guess what you're saying is it's just not as expansive as perhaps investors would have hoped for.
Well, I think there's two factors that I think cause us to be, more uncertain. One is the fact that there simply is significantly less neutralization capability on Omicron, and Omicron is predicted to be, the dominant strain over the next 6 to 12 months around the world. Therefore, if the treatment is not great at neutralizing that, then that's not going to be a very good therapeutic. The second is the fact that there are already many other antibody treatments out there, as well as pills. And so therefore, I think the visibility on the value proposition and positioning in the market is under question. That said, over the long term, there will be other variants. The antibody does have some neutralization capability, but it's not clear that it's significantly any better than everything else that's already out there. And they're still running studies. Meanwhile, you have a lot of other drugs and pills on the market. So look, I think there's going to be a delay in the treatment and the prevention data, which is supposed to be over the next year. I think that will be pushed out. There's also for traders a futility analysis. It's going to take a peek at the treatment study in the first quarter. I think that's risky now that Omicron is out there. And so while there is some neutralization capabilities on Omicron, it's certainly a lot of questions on there. And I think we're not going to find out for another year.
Michael, I see you also cover Moderna. It's been an interesting week and a half for that stock and company. What's your current thinking on it?
My current thinking is twofold. One is I think we're going to see continued increase of COVID infections driven by Omicron. However, I think that's mostly expected by everybody now. And actually, it is remarkable to see, boosting demand going up, yet Moderna stock has been going down. That's interesting and perhaps troublesome for people who are long the stock. And so I do think that we'll see a wave. I think the problem is that since that's already expected, and I do think that COVID infections are probably going to taper off over the next few months, we see a rise and then we see a fall just like we did with Delta. I think the interest level in vaccine stocks is probably going to wane. And I think that therefore money flow and interest in Moderna stock is probably going to be lackluster. Therefore, we have the hold rating. And I think this stock is going to have less interest in 22. Look, I do think that Moderna has some very interesting long-term stuff in the pipeline, flu, cancer data later in 22. But I certainly think over the next 3, 6, 9 months, people's interest levels in the vaccine stocks are going to fade.
That's really interesting, Michael. And I'm so glad we have you here and that you mentioned 2022, because I do want to get a bigger picture sort of outlook question. You cover a pretty broad universe of biotech stocks. Do you feel like more broadly beyond Moderna that the sort of excitement around COVID treatment and vaccine developments is going to fade going into next year, and the focus there'll be a refocus on all of the other things that are bubbling up that these companies are working on?
I do think that's the case. We have a huge report out today with some top ideas, M&A ideas, our outlook on this space. I would say a couple points. First, it has been a very bad and very challenging 2021, certainly for the XBI. Some of the standouts were mostly the COVID vaccine and COVID antibody stocks. Everything else actually did a lot worse than the XBI index leads you to believe. However, in 2016, 2018, we also had down 15 to 20% years in the XBI. And the following year, there was a big bounce back in the index, 30 to 40% in the following year as people rushed to come back and buy the dip, mostly because fundamentals structurally are not bad in the index. It's just been an exodus of money flow this year and a focus on recovery stocks, cyclicals, industrials, cruise lines, everything else out there that look to be a rebound as we come out of the lockdowns. And I think that very much was the case in 21. Therefore, biotech stocks suffered. I think as we go into 22, I think there will be a bounce. I think there will be more focus on fundamentals. I don't think it's going to be a rip-roaring year, 20%. Now, for some people, that sounds like a great year, but I do think it's a slow and steady recovery during the year. We do like names like Vertex, which we put as a franchise top idea for 2022. I think that had some remarkable data and could have a huge year in 2022. We also like names like Fate and Inhibirex, which we referred to in our report as bounce back. So I think it's a recovery year. I think it's a positive return for the index. I think there could be more M&A, but we got to get past Omicron and COVID because that seems like what everyone is all focused on. And that's not necessarily good for most of the other biotech stocks.
And Michael, on that M&A, I mean, who do you see as the top dogs making these deals and what are they focusing on?
In our report today, we cited that large pharma and large biotech around the world have almost $500 billion of cash on the balance sheets to deploy. And we do think that biotech companies are 30% cheaper than where they were a year ago. So rising cash at pharma and biotech, decreasing valuations certainly says to me that there's more to happen and it could be a coiled spring. I think names that we cited in our report like Argenx or BioMarin or Fate, names like those that are certainly very interesting for 2022, I think are on the top of the list. I do think that it's going to take some time, but I got to tell you, certainly deals can happen. It's not necessarily going to push all biotech stocks up. I think you want to see what we used to look at as FOMO, which was a fear of missing out. And I think we have to have a bunch of those deals. Quite honestly, it's fundamentals that need to get better. You saw negative data out of Allakos today. You've seen a lot of FDA delays and a lot of disappointing data. Biogen was probably your poster child in 2021. And we just need to get a lot more positive news flow, some M&A, less of a focus just about COVID, and really the market to focus on great companies. And I think that would get us higher in 2022.
I think less of a focus on COVID overall is my hope for 2022. But yes, specifically with this space as well. Michael, it's always really great to get some time with you and to get your thoughts on this space. Obviously, you know a lot about it. Michael Yee of Jefferies. Be well, Michael, and happy holidays.
Thank you, guys.
Thanks. All right, we're going to take a quick break. Coming back, we're going to talk about the hottest toys of the holiday season with Toy Insider's James Zahn. That's coming up.
Shares of major toy makers Hasbro, Mattel, and Funko have generally trended lower since the holiday season officially kicked off back on Black Friday. That's despite what looks to be continued strong demand for toys this holiday season. James Ahn is a senior editor at the Toy Insider, and I know has a pulse on all things in this industry. James, always nice to see you and get some time with you. Look, the stocks have not acted well. What are you seeing this holiday season in terms of toy demand?
Toy demand is phenomenal, and it has been a very unpredictable year. So we have seen the shelves go from empty to full to back to empty. It's been unpredictable because of all of these different issues we've seen with the supply chain, shipping domestically, labor issues at the stores, but consumer demand is insatiable for toys. Around Black Friday, the big players, Walmart, Target, they really started loading the shelves. We've seen that up until a week ago. But then last night, I actually did some store checks locally here, and the merchandise is clearing out. So families are out there and they are buying.
Yes, and I echo your sentiment. I went to a couple Walmarts last weekend myself, James. Hot Wheels cars, Matchbox cars, completely sold out. Very good price points, though, 97 cents for them. A lot of Nerf guns by Hasbro sold out as well. Where else are you seeing out of stocks?
Yeah, so the die-cast aisle in general, Hot Wheels, Matchbox, all of those mainline vehicles, totally sold out. Some of the electronic toys are starting to be light. Some of the learning toys, things that, of course, might have been affected by that chip shortage. On the flip side, Lego, interesting sidebar to that. Most of our supply comes from Mexico, and no matter where you go, those Lego aisles are totally wiped.
Hey, James, it's Julie here. Yeah, I'm lucky enough to have celebrated Hanukkah, so I got my stuff out of the way already. Now we're 3 days from Christmas, so maybe not surprising, right, that we're seeing some of those shelves bare. What have you been seeing on pricing? How much have we seen prices go up for these toys versus last year or even a few months ago?
Sure, we've seen like an average of about 5 to 10% across the board. This is largely related to the raw materials costs. Shipping, of course, has impacted that a bit. You know, we've all talked about the spot rates going up and things like that. Of course, that gets passed down to the consumer. But really, it's those raw materials, things like the resin that goes into the plastics, the paper pulp that's needed for the packaging and the cardboard and stuff. And then, of course, those chips. So that has kind of come down and filtered out. A few toy companies have not done increases, and I've found that the independent companies that are not publicly traded, that don't have shareholders to answer to, have been a lot more nimble in being able to eat some of those costs and then come out on top and say, hey, we didn't do a price increase. But I think Hasbro might have been the most transparent in that space, where they said in August that they were going to increase prices across the board. We've seen things like their 6-inch action figures, Marvel Legends, Star Wars Black Series, Ghostbusters Plasma. Those were $19.99 for the past couple years. They went up to $22.99. Now, if you go to your local store, you're going to find they're about $24.99.
James, you really get unprecedented access to stuff and what's hot. I mean, every time we have talked to you, you unveiled something new. Hit us with some stuff. Give us some visual eye candy.
All right, let's go with the Tony box. You know, Tony's was big in Europe. This is sort of a big success story here this year. This is a screen-free audio player. This box is electronic, but it's soft, so kids can take this in the car. It's rechargeable. You get these figurines. Kids love to play with figures. I've got Woody from Toy Story right here, and when I place him on the top of the box, he starts playing music from the film, and then there's stories. I've also got Moana here, dozens of figurine characters, and they are going big for 2022. So if you get your kids a Tony box this year, this is about $100. You're going to find dozens of characters with all kinds of quality entertainment on store shelves, and they're not only doing the indies. They started in the indie market. They're also expanding. You can find these at Target now.
I can tell you, James, that is way better than the crap my parents used to get me way back in the day. And I'm sorry, Mom, I know you're watching, but you didn't really get me that many good gifts. I'm just saying. James, besides new products, I know the Toy Fair is supposed to come up next year. Do you think it goes off? And what are some of the big trends you're hearing?
So yeah, as of yesterday, the Toy Association says it is full steam ahead for Toy Fair New York. Of course, at the newly expanded Javits Center there in New York in February. The industry wants to gather. The big players, Walmart, Target, Amazon, they have all committed to sending buyers to this event. Retailers are booked. Exhibitors are booked. There are some differences. Mattel and Hasbro have moved to different spaces within the Javits this year. Another company we talk about a lot, MGA Entertainment, LOL Surprise and all of that, they've moved out of the Javits. They're going across the street to their own space. But the industry wants to gather. Of course, we're all sort of held hostage right now by Omicron and whatever else COVID-19 is going to throw at us. One good thing we have all shown over the past 2 years, this is a business filled with creative people. They figure out ways to work around challenges. And this has been nothing but challenge after challenge, and it's constantly evolving. But the toy industry has been able to innovate. They've developed product. They've done it remotely. They've got it to shelves. And of course, families are continuing to just really embrace the joy of play, which is something that, COVID-19 might have made happen because folks were spending so much time together. They realized again, hey, toys exist, games exist, they're fun, we can spend time together. And that has just continued, which is a good thing that's happened with all of this. But Toy Fair New York, all systems are go right now. Same thing overseas. Viel Warenmesse, that's the big international toy fair in Nuremberg, Germany. They're saying it's full steam ahead right now. And that takes place end of January, beginning of February. And a lot of folks are booked. Big question there, international travel. I know some of my friends in the UK are concerned about if they'll even be allowed to go. So it's a lot of, roll the dice and see what happens and cross your fingers.
Yeah, I think that's true for everything right now, unfortunately, James. Hey, I want to ask you, speaking about creativity, as a parent, my constant battle is getting the kids off the screens. And I'm happy to see lots of analog toys behind you. What is the industry doing on that front? Are they focusing on incorporating screens and sort of those interactive kind of elements into toys? Is there an analog trend? What are you seeing there?
It's all of the above. Analog play, screen-free play is huge. STEM toys are just a huge market, and there's a lot for that with the science, technology, engineering, and math, and sometimes we add the A, which is arts, into it. There are just huge innovations that don't involve the tablets, and as a parent myself, I have 2 young daughters. I love to see anything that gets them away from it. There's even a couple of things too, like, VTech and Leapfrog, big innovators in the tech space. I've got one in front of me right now. This is the Count Along basket and scanner here, which this incorporates a lot of tech into the toy itself. So you're playing with the toy and then you can pretend, hey, I'm like mom and dad going out experiencing inflation at the grocery store as I'm scanning my $10 block of cheese here, that type of stuff. But very, very high tech, the way that this works, and it interacts and it teaches letters and numbers and colors and what these are. I mean, this will tell you this is carrots, it's orange. There's a number 3 on it. So there's lots of ways to get engaged, to get hands-on, to, play in grocery store or kitchen. I mean, this is something kids have done forever, but there's ways to get the tech in it that doesn't involve being tethered to a tablet. And of course, even in that space, there are companies that are merging the two, like Osmo and Play Shifu, that use the screens, but they use it to accent physical play pieces that the kids have in front of them. So somewhere along the line, there really is a marriage of analog and digital, and I think we're finally seeing it come together. But whatever kids are into, whatever parents want for their kids, they're going to be able to find it. And I think that's pretty exciting. And I've seen it as my own kids have grown up, that even over the last decade or so of being a parent, things change so rapidly. And as folks in the industry are young parents and stuff too, I think that really helps inform the products that are coming out and what's on the horizon for 2022. I think we're going to see a lot of innovation in that space.
James, my bosses are telling me I unfortunately have to go, but very quickly, where did you get that Outwork Everyone Monopoly sign behind you?
Weird to throw out a plug, but that's from a company called Iconic. That is officially licensed by Hasbro. But I bought that, and I also bought one that's on the other side here that says rent due. Success is always rented.
Fair enough. Two sayings I very much agree with. James Zahn, senior editor at the Toy Insider. Always good to see you. Do not disappoint. Have a great rest of the holiday season.
Happy holidays.
All right, do stick around. From toys to stocks. We'll be right back. Welcome back to Yahoo Finance Live. We are rechecking the markets here, and we've got now all three major averages are positive. We started, remember, futures in the negative this morning. Now we flipped on over to positive. As we've mentioned a couple times, I've been reminding folks that on these holiday shortened weeks, you tend to get low volume. So it's not surprising to see stuff bouncing around here. But speaking of which, we also have to talk about Tesla. Speaking of bouncing around, it seems as though Elon Musk is done with his stock sales, and those shares are now bouncing about 6%, Saz. Yeah, closing back in on that $1,000 mark. Julie, one of the hottest tickers right now on the Yahoo Finance platform. And of course, when Elon Musk says he might be nearing or done those stock sales, of course, you're going to see a bounce on Tesla shares because those stock sales really have pressured Tesla going on a little bit over a month here. So no surprise to see that. Julie, I was just thinking about my favorite toy as a kid. For me, it's my Hulk Hogan action figure. Really, James Zahn really inspired me today.
Wow, what was my favorite toy as a kid? Definitely play with Barbies. I played outside a lot. I don't know when I was a kid, so didn't play with much of anything toy-wise. So in that case, I guess my son inherited that. His favorite toys are probably like sticks and rocks. On that note, he likes Legos too. All right, on that note, we're going to leave it there, folks. We'll be back for one more day before the holiday. And Akiko Fujita will take you through the next 2 hours of trading. Maybe she'll tell you her favorite toy also. Stay tuned.
I'll tune in.
Welcome to Yahoo Finance Live. I'm Akiko Fujita. A fairly flat day on Wall Street if you compare it to the session we saw yesterday, with just 2 days to go until Christmas. Let's take a look at the Dow right now, up about 180 points here. Certainly a lot quieter than that rally we saw yesterday, well above 1.5%. The Nasdaq right now up about 107 points, and the S&P 500 up 31. Some positive economic news helping lift sentiment. Consumer confidence rising more than expected, while home sales continue to rise at a moderated pace, though. Tesla is seeing a big pop in this session after Elon Musk says he has dumped enough shares to reduce his stake in the company by 10%. And confusion and frustration around COVID. The president prepares to roll out 500 million COVID tests to alleviate those long lines we've been seeing, while hospitals brace for an influx in patients as Americans head home for the holidays. We are beginning this hour, though, with some promising news around the Omicron variant. A new study out from South Africa saying the variant has an 80% lower risk of hospitalization. Let's bring in Yahoo Finance's Anjali Kamlani with the very latest. And Anjali, we'll take any good news as it comes, but what are we hearing about this study?
Well, Akiko, I wish I could give you better news. I would say take this good news with a grain of salt. Just as a caveat, this study that we just got from the National Institute for Communicable Diseases of South Africa is a preprint, non-peer reviewed, and really they themselves acknowledge that there are some minor pieces that we need to pay attention to. So let's go over the details. First, they did say yes, 80% reduction in hospitalization was observed, 70% reduction in severe disease compared to Delta, and by comparison to other strains, about the same when it comes to severe disease. But that big caveat that I was alluding to is that natural immunity and infection from previous Delta waves, from the July wave, is likely playing a role in what they're seeing. We're also waiting for data to come out of the UK that might also shed some more light. But as it stands right now, remaining sort of on par with what we've seen, we know that already in the UK as well as in the US, we've seen unvaccinated individuals who have died from the Omicron variant. So it looks like some level of protection, whether vaccine or otherwise, is playing a role in how this variant is playing out.
And Anjali, meanwhile, we've got reports that the FDA is set to authorize those COVID pills for Pfizer and Merck. How significant is that when we're anticipating a big surge come January and hospitals are already bracing for an influx of patients?
Well, the timing is key there. We know that the FDA is poised to give both of those pills authorization today with some shipments already sort of in movement. We've seen Pfizer share that on social media. Meanwhile, the U.S. government is already purchasing those doses and getting ready to deliver them. Based on a Bloomberg report, it looks as if 400,000 courses of the Merck pill are going to be delivered initially, as well as 65 courses of Pfizer. So you see a really dominant participation from Merck there. By the end of January, significantly more numbers, as well as shipments of that AstraZeneca preventative treatment. So a lot going on there. Whether or not it is in time for and has any impact on this surge will remain to be seen. Of course, we know that South Africa's wave sort of has plummeted since, in the last couple of weeks. So it could be a quick burnout or not. Meanwhile, as we reach into the holiday weekend, looking at testing, of course, as you pointed out, and as we know, the administration is looking to get rapid tests more quickly into homes. Meanwhile, there are lines for PCR tests out of stock online and in stores, prompting big retailers like CVS, Walgreens, and Walmart to limit the number of at-home rapid tests that customers have access to. Right now, Walmart limit of 8, Walgreens limit of 4, and CVS limit of 6. Some of those may vary by store, but that's where things stand right now.
Okay, Anjali, stick around here. We've got Dr. Paul Offit, Vaccine Education Center Director and Children's Hospital of Philadelphia, attending physician in the Division of Infectious Diseases. We've also got Dr. Calvin Sun with the Monsoon Diaries, founder and CEO, clinical assistant professor and attending physician in emergency medicine right here in New York City. Dr. Sun, I want to start with you on that point Anjali made. We have all here in New York, at least, and I imagine major cities across the country, seen those long lines outside these clinics, some waiting more than 3 hours. How much of the inconsistencies, or I should say the delays that are happening on the testing side, is preventing us from getting a full grasp on the spread of this variant right now?
Oh, it's terrible. I mean, the biggest nightclub in New York City is now happen to be testing sites, and they're really waiting in line to go to a healthcare center or a testing center where most of the positive cases are going to be. So the irony is catching it while they're waiting in those waiting rooms. And it's just seeing the writing on the wall. And on top of that, these tests take about 3 to 5 days. If not, now we just got an email that some of our PCRs are going to take 5 to 7 days for a turnaround. I mean, that's clinically useless to me, because I have to expect that you're going to somehow quarantine yourself right after that PCR test, walk through that full waiting room, walk outside, go to the subway, go home, and then quarantine to 5 to 7 days so that you finally get a phone call of what your status was 5 to 7 days ago. What about the person you had dinner with 2 days prior to that phone call for your PCR results? It's not useful if it's taking that long. You cannot wait 5 to 7 days, especially like a city like New York. Rapid antigen tests are finding out there's a correlation with contagiousness, which gives you a status in that moment. So it's actually a more useful test, considering the circumstances, to test right before that gathering that you want to do with your family this holiday season. So I would say now, given that PCRs take so much longer, unless you can get your hands on a rapid PCR, which, 45 minutes, 1 hour turnarounds, which is so rare or expensive, rapid antigens will have to do right now.
And Dr. Sun, to follow up on that point, I know anecdotally plenty of people around me who have gotten COVID despite being vaccinated. They want to test out to see if they are still positive or negative to be able to meet their families over the holidays, and yet they've had to wait more than 3 hours to get that test done. How much of that is contributing to the infection?
I mean, depends on if you're waiting outside or you're waiting inside. I mean, outside is a slower spread, but nightclubs and big parties and big gatherings, it doesn't matter if you're outside or inside, it's more likely you're going to catch it. I mean, 3 hours waiting in line is so long when it's for a 15-minute test. I wish we had more access to at-home tests, the ones you can order online, but even that's being scooped up and it's hard to find. They're like liquid gold. And it's a test. And I think the intentions are good, though, that you're testing for your due diligence, you're testing for ethical purposes, to be able to know that you can go to your family and holiday gathering knowing that you did your best. But on top of that, keep in mind, you could test negative for 14 days until you're positive after an exposure. Sometimes it takes that long. We've seen that before in the first wave, where patients we hospitalized for COVID because it was positive on the CAT scan or a chest X-ray would test negative until 4 or 5 days later in their hospital stay. It's just sometimes this virus is a tricky thing. But the best thing we got, considering circumstances, is the rapid antigen to know your status at that moment if you're going to be contagious.
Dr. Offit, a question for you. I know that there has been a lot of concern and conversation around the idea that boosters could play a key role in how this winter surge sort of happens. I know that you had some reservations about the handling of the 16 and 17-year-old boosters, but I wonder, since the surge of Omicron, do you think that we should be thinking about boosters differently?
The question is, what do we want from COVID vaccines? If what we want is protection against serious illness, meaning the kind of illness that causes you to seek a doctor or go to the hospital or go to the ICU, it's very likely that 2 doses of an mRNA-containing vaccine or 2 doses of Johnson & Johnson's vaccine will provide protection against serious illness. I mean, those are the data out of South Africa, where you get at least 70% protection against serious illness. If, on the other hand, we're trying to prevent more mild illness, it's likely that 2 doses of an mRNA vaccine won't be great at protecting against mild illness, especially if you're, say, more than 6 months after having gotten your second dose. There, a booster dose will increase your chance of being protected against mild illness. But if that's what we're trying to do, realize that neutralizing antibodies, which mediate protection against mild illness, will fade over time. 6 months, 9 months, and then you would need another booster, which kind of is where Israel is coming from right now, offering a 4th booster dose or 4th dose for people who are over 60 years of age. So we have to define what it is we want. Remember, protection against serious illness is mediated by immunological memory cells, which tend to recognize regions on the virus that are conserved and have been conserved now for all 4 variants, including the Omicron variant.
So what would you say about sort of the timeline too of the pills coming out? I mean, do you, especially from your rounds, do you anticipate an impact right now?
Well, again, get vaccinated. I mean, it's not hard to figure out how to get out of this pandemic. If you look at Israel, which has a vaccination rate in this population of over 90%, they're averaging about 1 death per day, which would be the equivalent of maybe 35 deaths a day in this country. So that's our way out of this pandemic. You obviously, as Ben Franklin said, an ounce of prevention is worth a pound of cure. But it's interesting to see what happens with these, the antiviral medicines, which, if taken early, can make a difference. And it may be that people who are unvaccinated would be more willing to take a pill, as they've been willing to take hydroxychloroquine or ivermectin or things that don't work. This would work if taken early. So we'll see how that plays out. It could make a difference.
Dr. Offit, what are you seeing in terms of the impact Omicron's having on the youngest kids who can't necessarily get a vaccine right now? Have you seen, increasing hospitalizations on that front? And number two, to the point that the president has made over and over again, that there are the tools in place. What do those tools look like for the youngest?
Well, again, so we have learned, I think, over the last 2 years of this pandemic, how best to treat children in terms of how to ventilate, whether to give sort of immune suppressive agents like dexamethasone or baricitinib. So I think we're getting better at taking care of children. I mean, I was on service about a week and a half ago. We saw probably 18 children come into our hospital, including a handful in the intensive care unit. Actually, only 1 was less than 5 years of age. All the rest were over 5, many over 12. All of them could have been vaccinated. Not a single one was, nor were their parents, nor were their siblings. So again, I feel like with the discussion of boosters and antivirals and monoclonals, we're somewhat taking a detour from what the real issue is, which is to try and figure out a way to vaccinate the unvaccinated. I have to believe there is a way to do this at the local level, where we go into those communities that are under-vaccinated and just listen to them and try and answer their questions. I have to believe this is possible, because that's our only way out of this.
Dr. Offit, I hope your optimism gets spread around the world. But to Dr. Sun, on that note, I know that there's been a lot of spotlight on the idea and on the efforts of frontline health workers. We know that there are surges happening now in New York, for example. How is the situation when it comes to labor and staffing as it stands right now, are you running into any issues?
I just got 3 text messages in the last 5 minutes during this program asking for coverage. I'm trying not to look at it, but it's popping up on my screen saying 2 of us are called out sick. One of us is changing their guidelines to come in 7 days after the positive test instead of 10 days. We're trying to make ends meet. We're increasing premium pay. We're closing down 3 of our urgent care centers in Manhattan, at least 15 in New York City. This is the life of a per diem doctor, works everywhere. My phone is blowing up with text messages asking for coverage. On top of that, we are frontline healthcare workers. We've been working 2 years straight, and there's no end in sight. I mean, the conversations with our patients have changed given the vaccine. Thank goodness for the vaccine, because a year and a half ago, before the vaccines, the conversations once you tested positive was about pulse oxes, silent hypoxia, life and death, where the closest ER is, following up with your primary care doctor. This time, the conversations are about ruined travel plans and ruined holiday plans with a fully vaccinated that test positive. It's a relief per se, but also a different kind of burnout, because we've now become bona fide travel agents on top of trying to see sick patients in our line of work, on top of the fact they're facing staff shortages. On top of that, we're cutting corners on trying to get positive staff members tested positive to come back earlier than the 10-day the window that they mandated for us. So we're trying to juggle a million things at once, at real time, after time, and it's exhausting. And when we are going to, be able to take a relief on this, if there are also misinformation out there and people pressuring us to not talk about the vaccine as much from our patients who don't believe in it. It's unforgiving. But you can't pour from an empty cup, but we just got to keep fighting.
Yeah, I think the exhaustion is the right word after having to deal with this pandemic for so long. Dr. Offit, the last question to you. We did hear from Danny Meyer today, the head of the Union Square Hospitality Group, saying that he will now require boosters for his employees immediately, and then come January for those visiting his restaurants. That raises the question, of course, of those who can't necessarily get the booster. And there seems to be, all kinds of reports here about how long somebody has to wait to get the booster after having had COVID. Can you clear that up for us?
Well, in terms of after having had COVID, you should wait until your symptoms are all completely gone, and then you can get a vaccine. In terms of but if you've gotten vaccinated, for example, and then you had COVID, you don't need a booster. If you've gotten COVID and never got vaccinated, then the answer would be to wait until your symptoms are gone.
I think a lot of people appreciate the clarification there here. Dr. Paul Offit, it's good to talk to you today. Vaccine Education Center Director in Children's Hospital of Philadelphia, attending physician in the Division of Infectious Diseases. We've also had Dr. Calvin Sun with the Monsoon Diaries. He's the founder and CEO there, and our Anjali Kamlani joining us on the conversation. Let's turn our attention back to the markets. As we said, a relatively quieter day when you compare it to the big rally we saw yesterday. That snapped a three-day losing streak. And we are seeing the Dow up about a 0.5 percentage point right now. Let's bring in Stephen Sarge Guilfoyle with Sarge 986 LLC president. Stephen, we got Q3 GDP today, 2.3% versus the 2.1%. A lot of people right now looking to 2022 and those rate hikes that could potentially come from the Fed. How's your outlook shaping up right now as we count down to year end?
Well, right now I'm kind of bullish. I'm thinking we're going to probably get something of a Santa Claus rally going into the last week of the year, the first week of the year. But looking out forward, I believe the Fed does have to move rapidly to be in a flexible position. Beyond that, I really wish they didn't have these dot plots, because I don't think they know or we know what goes on past the first quarter. So we expect earnings to remain strong through Q1. After that, we really don't know. We expect that economic growth will probably move into the later stages of the business cycle as monetary policy seems to tighten, as fiscal policy is uncertain, but will probably be less liquid than may have been priced in. So quarters 2 through 4 next year might be a little bit tougher. So I think we have to mentally prepare ourselves for that. And then, as the two guests you just had on told us, COVID keeps resetting the whole ball game.
You mentioned the Santa Claus rally. That's been the big question mark going into year end. What do you see kind of sparking it? What kind of levels are you looking at?
Well, we have The S&P 500 just retook its 50-day simple moving average and its 21-day EMA, exponential moving average, which places more weight on recent prices. NASDAQ is struggling a little bit more. The NASDAQ Composite and NASDAQ 100 are both moving towards taking those levels, but haven't quite taken them just yet. I believe that will be a catalyst where let's say portfolio managers who are sitting out right now may have to jump back on board of positions they got out of maybe just a week or two ago when the market was a little bit tougher.
We were just talking to the doctors about where this variant is, how quickly it's likely to spread. We have seen some swings in stocks on the back of these headlines, starting with what we saw the day after Thanksgiving and that big sell-off from the news out of South Africa. At what point does that kind of get pushed to the back in terms of risk factor and the type of market moves we see?
I think the market's already started to push it to the back. We've seen this week alone, today and yesterday, we've seen the market adopt a more risk-on nature. We've seen the defensive sectors, which led during the 3 days prior, which were very nasty, move to the bottom of the sector performance tables. We've seen the cyclical and growth sectors move back towards the top of the performance table. So I think the market, I don't take this disease lightly. I had this disease back in April of 2020. It was awful. But I think the market economically is looking through Omicron.
And so you mentioned cyclicals. Is that what we're going to see continue to lead the way as we see this Fed tightening cycle, really kind of become increasingly the big focus for investors? How do you think they should be positioning themselves heading into 2022?
For now, I think cyclicals are better. As I mentioned, I think Q2 is a question mark. Q2 through 4 are question marks. So I don't expect traders like myself and investors to make the money we have made just surely from trading this year and the last few years next year. I think next year it gets a lot tougher. I think next year you might be grateful to have an 8% to 10% gain on your portfolio, where we've been a little spoiled for quite some time.
Good to get your insight with just a few days to go until Christmas. Happy holidays to you, Stephen Sarge, Guilfoyle, Sarge 986 LLC president. Coming up on the other side, an update on those supply chain disruptions we've been seeing. The president meeting with top executives to see how much progress has been made. We'll have a live report on the other side. We'll be right back. Supply delays continue to plague businesses across the country. President Biden meeting with CEOs at the White House today to get an update on any progress on that front. Let's bring in Yahoo Finance's Jessica Smith. And Jess, we're talking about his supply chain task force CEOs from the likes of FedEx as well as Gap. What did we hear in terms of any improvement that's been made?
Yeah, the president did speak at the top of this meeting when cameras were allowed in, and he did say that there has been progress made. Again, he's meeting with these executives to try and get a handle on the supply chain issues that we've been talking about for months now. At the top of the meeting, President Biden did say increasing prices are top of mind for him. He said there has been progress made so far, especially when it comes to issues around the ports and making sure shelves were stocked ahead of the holidays. The president noted that on-shelf availability pre-pandemic was at 91%, and he says now that number is at 90%. You'll remember the president did put together a task force in June to try and deal with all of these issues. He pushed to expand trucking hours and hours at ports. And tomorrow, he says the Transportation Department will announce more grants for ports. We also heard from the FedEx CEO at this meeting just a short time ago, and he said that supply chain issues are not all solved, but progress is being made, and he is optimistic. He said peak season is going to be a good one. And you might remember at the last meeting like this, we heard from the Walmart CEO who said all of the efforts around the ports and trucking hours were helping the flow of goods. Still, the president noted there is more work to do on this when it comes to shipping times and higher prices for consumers. He laid out a little bit of what he plans to do going forward. He says the administration has been investigating those excessive shipping times and potential illegal conduct in the oil and gas market. The White House also noted today that the price at the pump is down 12 cents per gallon since the peak last month. The president said he's going to convene his competition council in January to ensure robust competition across industries. This is something that he's working on that he says is a hallmark of healthy capitalism. So in order to solve these issues in the long run, though, in order to make more progress, the president once again urged Congress to pass his Build Back Better Act. Of course, that has stalled recently after Senator Manchin said he could not support it as it stands now. But President Biden is again still pushing that legislation. And Republicans have been seizing on all of these supply chain and pricing issues politically. So this is something that the White House definitely wants to get under control before the midterms next year. Akiko.
Yeah, and just on that Build Back Better, we did hear the president yesterday in talking, he was talking about the vaccines and the variant, but really used that opportunity to say, with that now being put on hold, even Goldman Sachs lowered its outlook for 2022. What are we hearing about any discussions that are happening behind the scenes between the president and Senator Manchin, or is that pretty much on hold right now until the new year?
I think it's definitely going to be back in force in the new year once they start working on this again to try and figure out something. We've heard from Democratic leaders and the White House that they're not giving up on this. And I think you've heard some frustration from the White House when you hear these concerns from Republicans and from Senator Manchin when they're talking about inflation and concerns about the deficit. The White House argues that this bill is paid for and that in the long run will actually help these pricing issues. So it's definitely going to be back front of mind, I think, at the beginning of the new year as they try to figure out some sort of compromise, some sort of way forward to get Senator Manchin to support at least some version of this bill.
Jessica Smith with that update. Thanks so much for that. We're off for a quick break here, but on the other side, growing headwinds clouding the outlook for crypto, with the industry bracing for regulation in 2022. We're going to be discussing all of that with the CEO of the Association for Digital Assets Markets on the other side. We'll be right back. Welcome back to Yahoo Finance Live. Well, crypto regulation expected to be in the crosshairs yet again in the new year, with the industry bracing for potential crackdowns after the SEC rejected 2 applications for the Bitcoin spot ETF with concerns about investor protection. And then also crypto executives testifying before lawmakers earlier this month. To talk about all of this, we've got Michelle Bond, Association for Digital Asset Markets CEO. Michelle, it feels like we did a lot of talking this year about regulation, but didn't actually come down, and potentially 2022 will be the year where things shake down. What's at the top of your radar?
Yes, absolutely. Thanks for having me. So I think 2021 was a very formative year. We saw a lot of change happening. Certainly, we saw some very prominent policymakers coming into Washington. The Biden administration has really started to get its footing on crypto assets. So now I think that kind of set the stage for crypto regulation in 2022. And I think, look, it's going to be a highly substantive year for digital asset policy. I think we're going to see broad principles for crypto regulation really taking shape. And it'll be on the regulatory side and also on the legislative side. The SEC and the CFTC, I don't think will make significant policy announcements without action from Congress. We are expecting those enforcement cases from the SEC. Chair Gensler has been hinting at them for a while, and these things do take time. I think the biggest question is what kinds of cases are we going to see? Which topics? How big will they be? I think crypto is noticeably off of the regulatory agenda that the SEC released last week. So I think, more to come from the SEC. The CFTC has been pretty quiet due to a lack of confirmed commissioners at the agency. The Biden administration has now nominated individuals for all seats. It's too early to tell what direction the regulator is going to take, but Chairman Benham has made it clear that he's willing to take on a lot more responsibility over digital assets. And obviously, there are so many other departments and regulators that are stakeholders in this. I mean, how is Treasury going to perceive crypto? Treasury has been hyper focused on it from a threat finance perspective. And I think we're also going to see, some interesting work that Treasury takes on. We've seen some interesting speeches from Deputy Secretary Wally Adeyemo, and Yellen and Undersecretary Lang both hail from traditional economics backgrounds. So they have work experience from being at the Fed. And I think that positions them as being obviously very close with the banking regulators. And we know the banking regulators are all looking at these issues. FSOC is also talking about this. So are they going to deem stablecoins as systemically important? I think the MetLife case raised a lot of questions about the extent to which the FSOC has authority. So I think every single regulator or financial regulator in Washington is going to be looking at crypto in 2022.
Yeah, Michelle, you laid out a very long list of headwinds for the space right now going into next year. Let's talk about the legislative side of things. We did see that first real high profile testimony with crypto executives testifying before Congress. We also had a separate one that was focused strictly on stable coins. Which side do you see lawmakers really moving on in the early part of the year?
I think that hearing in the House Financial Services Committee with all the crypto CEOs went an incredibly long way for crypto policy. And that really sets the stage in going into 2022. The lawmakers were so receptive and on a bipartisan basis to what the crypto CEOs had to say. And they really seem to want to develop, I would say, a responsible public policy framework. So I think this is really just the beginning. And what I saw from that hearing, I was there. They want to see the industry flourish. They want to see how the US can benefit. But at the same time, they want to make sure that consumers are protected and there are appropriate guardrails in place for market integrity and investor protection. I think there are going to be a lot more hearings. Obviously lawmakers in Washington are seeing all the tweets and everything that's happening, with Jack Dorsey and Elon Musk, and it's a top of mind for the general public too. So I think there's going to be a lot happening. And there are some I think there's going to be a very specific bill that's going to roll out in January that I think is going to be a really big deal.
What specifically are we talking about?
So Senator Lummis will be rolling out a bipartisan legacy type digital asset legislation. So it's a big bill, and it's going to comprehensively address digital assets. They'll be covering definitions, tax, securities, commodities, the distinction between the two, stable coins, having an SRO, the banking system's interaction with crypto, consumer protection, market integrity. Obviously, the SRO is a big one, and I think it's going to be a really big part of this bill. And I think, we're going to see the CFTC have more jurisdiction over spot digital asset transactions. I think the SEC's role in overseeing crypto will be strengthened. And I think the creation of an SRO is also going to be a really big deal because, we see that with FINRA and NFA on the securities and on the future side. And I think there's a real role for digital asset markets SRO to play as well.
With that said, Michelle, you recently had an op-ed where you said that the crypto market should be able to regulate itself. It sounds like you think the SEC will try to shape the regulation, but not come in as strong. Do you think they can strike that right balance? And I mean that specifically, and not just the price action we're talking about, but this ability for the space to continue to grow in the way we have seen it in 2021.
Yeah, and that's a great question. So I actually used to be a lawyer at the SEC, and we worked very, very closely with FINRA. And I think, it's really important because I think an SRO can serve as sort of that connective tissue between the SEC and the industry. And it helps from a variety of perspectives. An SRO is more cost effective. It can help advance policy. An SRO can provide regulatory clarity. Provide a bigger budget. There are a lot of different things that an SRO can do that would be helpful to the SEC. And the SRO would act pursuant to delegated authority by both the SEC and the CFTC. So it would be overseen by both regulators. The idea is that it works in conjunction with the federal regulators. I think that's important that, the regulators are working sort of together.
Well, Michelle, we'd love to have you back on in the new year as we continue to have these conversations. Michelle Bond, Association for Digital Assets Markets CEO. Coming up, a search for survivors over in Myanmar as a landslide traps dozens of workers at a jade mine there. We've got that story, along with the latest restrictions we're seeing on COVID around the world in our worldview after this break. In our worldview today, new COVID-19 cases in South Africa are starting to decline, leading some medical experts to say the surge driven by the Omicron variant may have peaked there. Nationwide, infections have dropped more than 40% from a record 27,000 that was reached last Thursday. The decline's been even more pronounced in major cities, including Johannesburg. Now, doctors caution it's too early to draw any conclusions, given that daily case counts are not always reliable. Meanwhile, over in England, health officials have reduced the number of days required to isolate after showing symptoms of COVID-19. The government's health security agency says patients will now be required to isolate for 7 days instead of 10 if they test negative on day 6 and 7. Unvaccinated people are still required to quarantine for 10 days. This comes as hospitals and businesses across the country struggle with staffing shortages, with more people testing positive. Israel's rolling out a 4th dose of the COVID vaccine, becoming the first country in the world to do that. A panel of coronavirus experts made the recommendation on Tuesday, one day after new COVID cases topped 1,300, the highest daily total Israel's seen in 2 months. Prime Minister Naftali Bennett said those 60 years and older and medical workers will be first in line to get the latest jabs. Israel's been a leader in vaccinations. As the first in the world to offer the booster shots back in the summer, nearly all citizens have received the Pfizer-BioNTech vaccine, and they'll be eligible to receive the 4th dose 4 months after their 3rd jab. Over in Myanmar, dozens of people are missing following a landslide at a jade mine in the northern part of the country. Rescuers say more than 70 people were mining early Thursday morning when the landslide was triggered, sweeping workers into a lake roughly 200 feet below. Search and rescue crews have only uncovered a handful of bodies so far. Myanmar is home to the world's largest jade mining industry, and the military says it had shut down mining in this particular area. But the Associated Press reports mining companies have continued to operate illegally. Coming up, investing in the digital infrastructure. We discuss the outlook for data centers in 2022 with Wells Fargo's senior equity research analyst, Eric Lubchow. That's coming up after this break. Well, Boeing and Airbus are warning against a plan to deploy new 5G wireless networks next month. AT&T and Verizon are expected to roll out the new technology on January 5th, but there are serious questions about how they're likely to disrupt operations in the air. Let's bring in Eric Lupko. He is Wells Fargo Senior Equity Research Analyst. Eric, I want to have you explain what the big concern is here, because I think a lot of people have heard 5G, potential disruption for planes. What exactly is the concern, and how is that likely to delay the rollout, or is it?
Yeah, absolutely. It's a very good question. The real issue is that some recently auctioned airwaves in the C-band are nearby some of the airwaves that the FAA and aircraft use for radio altimeters. And this has been an issue that the FCC has explored for several years to prevent any type of interference from C-band operations and 5G with aircraft. The FCC has studied it for several years. They have set aside a guard band of approximately 220 megahertz, which is double the minimum requirement to help protect against interference. And then, more recently, AT&T and Verizon agreed to give the FAA a little bit more comfort to impose some power restrictions on C-band cell sites near major airports. So, that's the main issue. I think in terms of whether or not this delays the 5G deployments, it's already been delayed 1 month. AT&T and Verizon agreed to that. This spectrum was supposed to be deployed in December. And the latest we've heard from the carriers is that they're continuing to plan to move ahead in January. They have given the FAA a lot of data, real world data in other countries where C-band has been operated for many years with no interference with airplanes whatsoever, in Europe, in Japan, in South Korea. And given the fact that AT&T and Verizon spent collectively about $80 billion on the spectrum, I think that they are wanting to get going as soon as they possibly can.
Yeah, it's going to make a lot of people jittery who are about to fly listening this a few weeks out from this rollout. Having said that, talk to me about how significant this next phase in 5G is going to be. And in your case, how big of a driver they're likely to be for some of those tower stocks.
Sure. So in our view, true 5G will come in mid-band spectrum. And that's spectrum where you can see speeds that are at least 10 times greater than what we've seen under 4G. And so that is really, to us, the critical spectrum layer that we need for 5G. AT&T and Verizon haven't really deployed much 5G at all on mid-band. And so this C-band rollout is critical for them. They both have plans to roll this out and cover almost 200 million people by 2023. So this will be a very quick rollout. And they are primarily using the large tower companies, American Tower, Crown Castle, and SBA to scale that deployment as fast as possible. They're hanging new equipment on macro tower sites across the country. And as soon as the spectrum is active, they can turn those equipment sites on and very quickly get coverage on C-band. So they are already partnering with the tower companies. And we've called for total leasing volumes to be up 15 to 20% in 2022, and then up potentially another 20% in 2023, as we have those two carriers deploying 5G, in addition to T-Mobile deploying a 5G network, and also Dish, who is is building a brand new greenfield 5G network from scratch.
You look at the digital infrastructure overall, particularly around data centers, they haven't necessarily been immune from some of these supply chain disruptions we've been seeing, pushing costs higher as well. How is that likely to weigh on some of those names that you've highlighted and their growth prospects?
Sure. So there's always a little bit of impact from cost inflation. I think the data centers are fairly insulated next year from it. The majority of the capital that they put into new data center sites, they've pre-contracted with large groups of suppliers at fixed prices to deliver critical equipment such as generators and switchgear and power distribution units. So largely speaking, they have the equipment on hand to continue to build. In general, we do think that cost inflation will cause a lot of these data center companies to push up pricing in the next couple of years to maintain kind of stable returns. But that is something that, we haven't necessarily seen come through yet. In general, pricing in data centers has been deflationary for many years. And I think the hope is that with inflation now on the horizon, or already here in many cases, that they will start to push pricing higher.
Eric Lubko, Wells Fargo Senior Equity Research Analyst. Good to have you on the show today. Coming up, a major withdrawal from the Beijing Olympics. With less than 2 months to go until the Winter Games, one sports league saying no way to players taking part. We're going to be discussing the latest COVID disruption in sports after the break. Well, day after hitting pause on its season, the NHL is saying no to the Beijing Olympics. The Hockey League saying its players will not be allowed to take part in the Winter Games, in part to try and curb the spread of the Omicron variant. Let's bring in Yahoo Finance's Josh Schaefer, who's covering the story for us. And Josh, I guess part of the reason here is that because they've now had to pause the season, they have to make up some games. And the thinking is they could do that during the Olympics.
Right. They have a 2-week period there. It's about 16 days where the NHL could maybe slot in some of those games. And that's pretty much what NHL Commissioner Gary Bettman said in his statement today. He called it, quote, no longer feasible. And then he said, we certainly acknowledge and appreciate the efforts made by the International Olympic Committee, the International Ice Hockey Federation, and the Beijing Organizing Committee to host NHL players. But current circumstances have made it impossible for us to proceed despite everyone's best efforts. We look forward to Olympic participation in 2026. So basically what the commissioner is saying here is they want NHL players to be able to participate in the Olympics. This is not like 2018 where they kind of didn't want the players to go over there and it was more of a scheduling issue. They had the time set up for the players to be over there February 4th and play in this tournament. But the NHL is going through a serious COVID spike right now. Over 15% of players have been added to the COVID-19 list across the league. They've already postponed 50 games. They're going to have to find a way to play 50 games at a later date. And they're currently on pause through December 25th. And then this Sunday on December 26th, they're going to come at a pause, but they're going to have negative tests for players to return to action. So it's really kind of fully up in the air. And then you add in the final total variable here, which is the NHL has teams in Canada and the US. How's that going to continue to progress over the next couple months? They've already had American players go over to Canada and get stuck and have to quarantine in a hotel for a week and not be able to come back with their team. Is that something we're going to see moving forward? If so, the NHL's in big trouble. They already lost billions during the pandemic, and it seems like it might be getting worse.
Josh, in some ways, this is a story that we have seen play out before. 2018, the players were not allowed to take part in the Pyeongchang Olympics at the time. How big of a blow is it for the Olympics, and particularly Beijing, at a time when these games have been seen as quite controversial?
Yeah, it hurts. There are not a lot of sports that normally have pro players that fans recognize internationally that play in the Olympics. That's not always the case, right? And the NHL is normally one of those sports. It has been over the past couple of years, and since for decades now. It wasn't in 2018, and we saw in 2018 the viewership dip for NBC. Now you could maybe attribute that to Team USA not being as good that year in men's hockey, and maybe that's why the viewership dipped, but it dipped by a couple million. And I think that has to do with people not recognizing the faces that they see playing and those names that they're normally rooting for in the National Hockey League. Perhaps maybe the narrative can shift and people will be excited to root for the amateur players that are going to replace the NHL players over there. If you remember back in 1980, when people were excited about the Olympics, all those players, when the USA beat Russia or the Soviet Union, were college players. And it is fun to root for younger players and kind of an upstart story. So I think that's what the Olympics is going to have to hope for here, is people get excited to see new faces and young stars that can emerge.
Yeah, hard to believe we're just, less than 2 months out from the Beijing Olympics. I feel like we just watched the Tokyo Olympics, but a lot of attention going to be placed on Beijing. Josh, thanks so much for that. We've got much more to come in our next hour. We're going to be watching the markets closely here. A pretty quiet day so far, although the Dow now up 160 points. Much more to come here on Yahoo Finance Live. We'll be right back. Welcome to Yahoo Finance Live. We are in the noon Eastern hour here in New York City. A relatively quiet day on Wall Street with just a few days to go until Christmas Day. All stocks, though, off of the session highs, but still holding up here. All three majors in the green with the Dow up 166 points. Some positive economic news helping lift sentiment. Consumer confidence rising more than expected, while home sales continue to rise despite a moderated pace. Tesla is seeing a big pop in the session after Elon Musk says he's dumped enough shares to reduce his stake in the company by 10%. And Omicron concerns loom ahead of the holiday travel rush. We're going to be speaking with the president of the International Association for Flight Attendants as unruly passengers could stand to lose their TSA pre-check perks, and potentially much more straight ahead. Let's begin with that economic data we got out this morning. The final reading for third quarter GDP revised upward. Let's bring in Yahoo Finance's Emily McCormick, who's tracking all of that for us today. Emily.
Akiko, as you mentioned, we got a slew of upbeat economic data out this morning, and I'll touch on GDP, but first do want to start with consumer confidence because that report is suggesting Americans are feeling increasingly optimistic about the prospects for economic activity, even given the latest spread of Omicron. Now, the Conference Board's headline consumer confidence index came in at 115.8 for December. That was a third straight monthly increase and also came in higher than expected. And this also came following an upwardly revised reading of 111.9 in November. Now, this confidence index is still tracking below the 2019 average of around 128.3 before the pandemic, but at least with this latest increase, we are starting to bridge that gap. Now, beneath the headline index, the details of this report were also solid. The proportion of consumers planning to buy homes, vehicles, major appliances, and vacations over the next 6 months all increased. And moreover, concerns about inflation did also pull back after reaching a 13-year high in November. Now, in terms of what we should be expecting for consumer confidence going forward, do want to highlight what Ian Shepherdson of Pantheon Macroeconomics wrote in an email this morning. He said, quote, "We just don't know how people will respond to the soaring number of COVID Omicron cases. Past experience suggests we should expect a clear hit, though each successive wave has had a smaller impact on sentiment." Now, meanwhile, also do want to highlight the third and final estimate that we got out from the Bureau of Economic Analysis on third quarter GDP, also out this morning. This came in higher than previously reported and showed a 2.3% annualized increase in economic activity, up from the 2.1% rise previously reported. And this upward revision to headline GDP came as personal consumption rose by 2%, also upwardly revised from the 1.7% increase previously reported. Now, all told, we should note that the level of GDP is currently about 1.4% above pre-pandemic levels. So we have recovered those losses from that brief but severe recession that we had last year. And then finally, Kiko, before I turn this back to you, do want to touch quickly on the numbers we got out from existing home sales from the National Association of Realtors. Now, that did come in a little bit weaker than expected. We saw the month-over-month increase for November up by about 1.9% compared to October to reach a seasonally adjusted annualized rate of 6.46 million existing home sale units. Consensus economists were looking for a 2.9% monthly increase, but even still for the year to date, we're seeing that existing home sales were up by 10% over the same period last year. So taken together, this morning's batch of economic data really points to yet again more progress being made in this recovery. Akiko.
Okay, Emily, thanks for that. Let's pick up on that point with our guest, Anik Sen, PineBridge Investments Global Head of Equities. Anik, good to have you on today. We had a guest on in the first hour talking about a Santa Claus rally. Sounds like you're pretty optimistic that there's more upside ahead.
Yes, definitely. I mean, coming into the start of this year, we said that, the market breadth, which was extremely narrow in 2020, will improve. We also said that analyst earnings estimates had been cut drastically for not just the pandemic year in 2020, but for 2021, 2022, and beyond. We said that that was a mistake, that we would see the recovery in earnings estimates happen during the course of 2021. And in fact, that's exactly panned out. We've been saying that, this is definitely a buy the dip sort of market, because we expect more earnings upgrades to come. We think that the real debate should be about the length and strength of the economic cycle ahead. There's a ton of investments that need to go in for net zero. There's a lot of obsolescence in the system that needs to be replaced, and a huge amount of investment that needs to be made in automation and supply chain rewiring that really is a kind of a multi-year pent-up demand that is now really kind of catching up. So we think that the U.S. consumer, as you've just mentioned, is in a very good shape right now because house prices has a dramatic wealth effect. It also has the largest multiplier effect on the economy, and house prices are increasing very nicely this year. So I think all told, the manufacturing side of it has good pricing power, good order books, multi-year capex cycle ahead, and the consumer is actually in good shape. So for all those reasons, we think that the next set of earnings releases in Q1 and Q2 of next year should have an upward bias, which makes it a buy the dip sort of market.
Let's pick up on that CapEx cycle. No question, a lot of companies are looking to put their money to use. You mentioned investments on the renewables side, automation. How much of that outlook is clouded, though, now that Build Back Better is in question? You had some revising their growth outlooks next year. How significant is it if, in fact, this bill isn't passed?
Well, it is definitely a factor in terms of acting as a catalyst for a lot of the investments. But I think, over the last 10 or even 15 years, not a huge amount of investments have been made in the economy. So whilst it is a factor, I think it's a relatively small factor. Most companies, when they think about their capacity utilization, the number is not really a representative number of the real capacity because so much of obsolescence in the system results in inefficiency. So, the real kind of efficient capacity is much less than what you see on the headline. And the other thing to note is that not a lot of debate and discussion is being had about China. China has been largely missing in action, I would say, as a market driver, as a sentiment driver as well for the longer term outlook. And our impression is that speaking to companies and building up that view of the top down from the bottom up, company by company, we see that the growth outlook in China has likely to have bottomed already in Q4. So if you put it all together, I think for 2021, you have a very strong, resilient US outlook. But to that, you have to have additional growth and additional investment spend that is really coming from the Chinese side as well, really from the Asian side. India is another market where we see a tremendous amount of positive potential for recovery coming through as well. So major economies around the world are likely to be in a more synchronous outlook for growth in 2022.
On China, there's the growth outlook overall, and then there's the question of where the Chinese money moves. We've seen the crackdown here in the U.S., what the SEC essentially saying, if you don't follow those accounting rules for all other foreign companies, there will no longer be a place for you on U.S. exchanges. Going into 2022, do you see some of the money shifting more to Hong Kong? How do you see that playing out?
That's a great question, Akiko. I think the easy call for 2022 is that you'll see many more companies doing secondary listings in Hong Kong during the course of the year. I think it just makes good insurance policy, so companies that are listed through ADRs in the US market, you should expect them to pursue secondary listings. The other thing to note is that the SEC has actually given these companies sufficient breathing time. There's a 2024 deadline that the SEC has put in, which means that it's not a major kind of panic situation at all. So companies have sufficient time to plan, but you should expect more secondary listings. As far as the shift is concerned, yes, we think there will be a shift, but money is fungible in the sense that ADRs can be swapped into a local Hong Kong listing. So you should expect some release to come through as the markets begin to understand that there is there is a plan, there is a framework, and it is not as if these stocks are facing an imminent delisting fear at all.
Yeah, an interesting story out from the FT today about how U.S. exchanges are now trying to recruit Southeast Asian companies as well as Indian companies to try and maybe fill the void left by some of these Chinese companies leaving. Anik, it's always good to talk to you. Anik Sen, PineBridge Investments Global Head of Equities. Coming up, airlines navigating some choppy skies during the height of the holiday season. Concerns around the Omicron variant and unruly passengers all adding up to one big headache for flight attendants. The president of the Association of Flight Attendants, Sarah Nelson, is going to be joining us after this break. Well, just 3 days to go until Christmas, and millions of Americans are getting ready to fly out to their holiday destinations. But with so much uncertainty around the Omicron variant and the recent rise in unruly passengers, flight crews are being forced to prepare for the worst this holiday season. Let's bring in Sarah Nelson, Association of Flight Attendants, CWA president. And Sarah, we got some troubling news from IATA, which is the trade group that represents the world's largest airlines. Their top medical advisor saying that he believes that Omicron variant is much more transmissible on the plane. He said specifically that the variant doubles the risk of getting infected on a plane. I have to imagine all these headlines have only added to the stress level for some of your members.
Absolutely. A year ago, as we were going into the holiday season here, we weren't sure if Congress was going to get in place or if President Trump was going to sign the emergency relief that would return people to their jobs and have us be trained in our certification and be able to do our jobs. So we understand that the safety of our workspace also directly relates to our economic security as well. And as we've been on the front lines for the last 2 years dealing with all of the stresses of this pandemic, to have a new variant that is spreading like wildfire and try to focus people back on the basic procedures to stop the spread as much as you can with a controlled environment, proper hand hygiene, making sure that you're wearing that mask all the time, getting the airlines to cool it on the increased service provisions so that we don't have more interaction on the plane than we need to have, making sure that those HEPA filters where they exist are being run all the time on the ground and in the air so that we're helping with that filtration and also the deep cleaning. But all of that layered approach has to be in place in order to have the most controlled environment we can possibly have and try to mitigate that spread.
What specifically have you seen in terms of impact on flight attendants? I mean, we've heard so many stories of those who are close to us getting infected at a rate we haven't seen during the pandemic. Are you seeing the same? And are airlines able to staff, to keep their staff in place at the busiest time with infections? And
well, it's an issue. It's an issue, Akiko. And what we saw this fall was that due to COVID concerns and also due to the disruptive passengers, even though we have more flight attendants on staff across the industry than we had pre-pandemic, if you compare it with the number of flight hours that airlines are running, people are just not willing to pick up the overtime hours at the same rate that they were before the pandemic because of these concerns, because they're getting sick, actually, and they're using that sick time, and also because they're families and they are a little reticent about spending more time in the air when we've been getting beat up. So this is a serious concern, and what we did to try to address this over the holidays was to negotiate incentive pay that provides a pretty hefty financial incentive for flight attendants to pick up time so that we can keep the operation going. But it is a real stress and strain, and it is very difficult for flight attendants on the front lines right now.
You talk about the stress and strain. We've seen plenty of those videos of unruly passengers. And I think last time we spoke, you talked about having essentially a ban list for those who have had to be kicked off of planes. We've got the FAA now saying that passengers could lose their TSA pre-check if in fact they are cited. Does that go far enough, in your opinion?
Look, I think it's a good step. And anytime that you have coordination between agencies to work on this, it is a step in the right direction. So FAA having the zero tolerance policy, having the MOU with the DOJ on getting their investigations over to DOJ for criminal prosecution, and then working with TSA on telling people that you're not going to be able to go through security quickly if you are acting out. These are steps that all lead to additional action and create a layered approach to a deterrent for people to act out on planes. So it's a good step. Does it go far enough? No. We say next up is that banned list, and we want to keep pressing the agencies to work harder together to have more mitigation factors in place to get these events down on the plane and lift the risk, the incredible risk to aviation right now with the high record-breaking number of events this past year of disruptive passengers.
How much support are you getting from the airlines on that front? I mean, I know you testified before Congress last week, maybe 2 weeks ago, along with the executives of the major airlines. Your members are the ones that are having to deal with this. We had the CEO of Southwest saying that he doesn't really feel masks are needed, and maybe he's pulled back that statement since. But those types of statements only add, I'd imagine, to the resistance that we're hearing from passengers.
Look, I was really concerned about this hearing going forward before the holidays because I expected that we would have some sort of mask debate. I did not expect it to come from the witness table, frankly, and that was a really unfortunate moment. Gary Kelly corrected the record with me right after the hearing and said he was with us on masks and understands that it has to be the layered approach. He was talking specifically about HEPA filtration, but we need that in place for safety and also for confidence from the public to actually buy airplane tickets. So he's corrected that since, but those kinds of comments and keeping in the air that there is a debate over needing to wear masks puts flight attendants in harm's way because people come to the door of the airplane thinking that there's a question there rather than understanding that they simply have to follow the rules. The rules are in place for a good reason, and everyone has to do it in order for all of us to remain safe.
And that's just one layer to keep flight attendants safe. Do you think that vaccines should be mandated for passengers who are boarding some of these flights? I mean, it feels like that the standard, the evaluation is shifting by the day.
Yeah. Traditionally, vaccine mandates have been employer-based. That's the way that they have rolled out, and they've also rolled out in our school system. So we don't really have an example of that being mandated for passengers on airlines, and we don't have a great way of tracking that and being able to implement that. Well, I think that I appreciate what everyone is saying, just like we heard from our members who said that they very much supported a vaccine mandate at work because they didn't want to be working with people who weren't vaccinated. The fact of the matter is that we have to work very hard to get everyone vaccinated around the world, because this isn't just about our country. Wherever there are low vaccination rates, this virus can continue to live and mutate and create havoc, just like it is right now with Omicron. So we think that whatever we can do to push people to understand that they're doing their part by getting vaccinated, the better off we're going to be, and the sooner we're going to be able to live in a COVID-controlled world. Maybe not getting rid of it completely forever, but in a controlled way so that we can get back to living our lives and feeling the full freedom of pre-pandemic era.
And finally, Sarah, we had Randy Weingarten from the American Federation of Teachers on the other day talking about just the challenges teachers have had to face during the pandemic. She essentially said teachers are just bone tired right now. And I'd imagine, I know we were talking in the break, but flight attendants have also had to cope with so much, not just about their safety, but also passengers too. Has that affected recruitment? What's the sentiment right now among your members 2 years in?
Randy and I were on the phone last night talking about this very issue, and the fact that people feeling exhausted and getting beaten down is creating a problem. It's creating a problem for their ability to be able to get back in the saddle, come back to work and do their jobs. And if we allow pandemic fatigue to sit in and don't continue to work every single day to try to eradicate these issues, to stop this violence towards frontline workers who are just doing their jobs to protect the people in their care, then we are really going to unravel the entire structure of our society and break down our economy again. So there's a lot at risk here for not paying attention to the fact that we all need to call for solidarity in backing up frontline workers, teachers, flight attendants, grocery store workers, retail workers. We've got to get behind everyone, and healthcare workers. Frankly, we've got a lot of stories now about healthcare workers taking abuse and physical violence from patients. This is just not going to allow us to continue to do the work that we need to do to care for people and keep a civil society. So it's time for all of us that really know how to treat each other and want to treat each other well and want to have peaceful holidays to take an extra effort to reach out to our neighbors and our friends, give them support, thank the people where we go into businesses and interact with people, or when we get on planes or go into classrooms, and recognize that everyone is trying to do their level best to keep everyone safe and to get on with this and go to a better place.
Well, Sarah, I hope you get some time off during the holidays. It is much deserved. Sarah Nelson, Association of Flight Attendants, CWA President. Thanks for joining us today. Coming up, Spider-Man to the Rescue, the latest Marvel movie, seeing record attendance, at least a record during the pandemic. Is this a sign of things to come as theaters look to bounce back? We'll discuss that after the break. Movie theaters are breathing a big sigh of relief after the new Spider-Man movie saw record-breaking attendance in its opening weekend, despite climbing back from 2020 lows. North American box office, though, still seeing a 62% drop from those highs we saw in 2019. To dive more into these numbers, let's bring in Comscore senior media analyst Paul Dergarabedian. We've also got our very own Ali Canal joining in on the conversation. Paul, you've always said the theaters are going to come back. Is this a sign of things to come, or is this just the popularity of the Spider-Man franchise?
Yeah, well, I think this was the movie that a lot of people were waiting for. And those who are on the fence about going out to the movie theater, let's face it, if you're a Spider-Man or a Marvel fan, you're not going to sit this one out. And it was only available in theaters. And it opened massively. I mean, it just obliterated expectations. The film opened with $260 million in North America alone. That's the second biggest opening of all time, behind only Avengers Endgame that opened with $357 million. And now, as of yesterday, Spider-Man No Way Home has crossed $751 million globally and now has its sights set on the $1 billion mark. There's not been a single film that has opened this year that has gone over $1 billion in global box office.
And Paul, Spider-Man debuted right before the Omicron spread really started to make headlines. So I feel like the timing was right there. But as we've seen surging cases all over the country, how much of a risk factor do you think this variant is as we close out this year and head into 2022? Because some experts have said, look, I don't think the Marvel fans would have stopped and would not have come to see this movie regardless of the headlines out there.
Yeah, and that's, the headwinds that are the Omicron variant definitely are there. For a movie like Spider-Man, that may be a bit of an anomaly because that movie just transcended everything. Like, it seemed like nobody really cared about any external forces. They just wanted to go see this movie in a theater so they could talk about it with their friends. It's a great movie. I'm sure there was repeat viewing. For other movies, we're going to have to see how this all plays out. Although it seems that even earlier in the year when Delta hit, Free Guy opened and still did really well. So it seems like even though people are certainly aware of these variants with COVID, they know that movie theaters, by and large, have been incredibly protective of their patrons, done a great job of, I have never heard of any incident in a movie theater related to COVID. So if you're safe and you adhere to those protocols when you go into the theater, I think if the movie really grabs you, if the marketing grabs you, you're still going to go to the movie theater to see it if the movie theater is indeed available and open for business. And I think that's the X factor. What's the effect of Omicron going to be moving forward on every brick and mortar business? But this Spider-Man result, these numbers just show that people want to go to the movie theater, even if you have tons of content, which you do at home on streaming.
I mean, with that said, we have seen kind of this divide between the big budgets and then all the others. And we're not just talking about the Marvel franchise, but even movie theaters, AMC, IMAX, these big chains have the reserves to keep going, even as some viewers sort of pull back and rethink going to the theater. What about the independent theaters? How significant a hit have they already taken? And how many more can actually ride out this latest wave?
Well, it's tough. For independent theaters, for which I have so much respect, because they play the indie films, the films that are more challenging, not just blockbusters. It's been a really rough go since theaters essentially shut down on March 20, 2020. And we don't want to see that segment of the movie theater realm go away. In other words, the independent theaters are so important. And we found, though, that the more mature audience that gravitates to those kind of specialized movies, they've been more reticent to go back to the movie theater. So I hope independent theaters can hang in there and weather the storm, because they are a vital part of movie going and the kinds of movies that they show to their patrons. And they are the curators of all this great content. But I'll tell you, this has been really tough. And obviously there's a fixation on blockbusters by the big theater chains, because those are the movies that are going to help bridge the gap for now and in the future to keep the movie theaters running, getting those people coming through the door. So it's very important, but no question, it's been tough. But a movie like Licorice Pizza, it's been doing very well, very great per theater averages for that movie, and it goes wide this week, so it's going to be available to many more people. It'll be interesting to see how that movie does once it's available to a broader audience.
And Paul, I want to follow up on that point because I have not seen a good, solid romantic comedy in the theaters in quite some time. And I'm not talking about a cheesy Netflix film like The Sweet Home Alabamas, How to Lose a Guy in 10 Days. It seems like consumers are gravitating more towards these big budget franchise superhero films. But does that mean those other types of genres are going to die out in the name of ticket sales?
Well, that's a great point. You do a whole hour on the rom-com and what has happened to it. It's been really difficult to find those comedies, but there's so many available on the small screen. I think many people are just gravitating towards the small screen to get their rom-com or comedy fix. And it's been tougher for those movies in theaters. And that was even pre-pandemic. I think part of the problem was so many of those movies were not that great, to be honest with you. And I think audiences have come to expect a much higher level of quality with movies that are, that have that comedy element or the rom-com, as we have called them. And so that's definitely a genre that's taken a big hit. Musicals also, West Side Story, the most recent film, to not really grab an audience like we thought it would. Big name was Spielberg, great movie. Hopefully over time people will come out. But again, that's a movie that appeals to more mature audiences, and that one's had a rougher go. So I think for now, we're going to be living in a world where you have mainly the big blockbusters, franchise films, superhero films being the bread and butter of the industry. But I hope going forward, this normalizes. And by the way, we've got about 7 movies opening this week, brand new films opening in theaters, including the expansion of Licorice Pizza. Sing 2 is out there, some other big movies. So we'll see how the Christmas box office measures up this coming weekend, with Spider-Man in the mix continuing to, I think, dominate the marketplace.
Who knew so many people were looking for a good rom-com? To Ali's point, though, it would be nice with all the negative headlines. We'll take some positive storytelling. We'll see if it comes through. Paul DeGarabedian, Comscore Senior Media Analyst, alongside our Ali Canal. Want to check shares of Pfizer here. We are seeing the stock push higher, up about 1.6% on news that the FDA has given the green light for the company's COVID treatment pill. So the very latest there on Pfizer with the FDA giving the go-ahead on Pfizer's COVID treatment pill. We're going to take a quick break here. We'll be right back. Welcome back to Yahoo Finance Live. On running co-CEO and CFO Martin Hoffman and co-CEO Mark Maurer spoke with our very own Brian Sozzi and Julie Hyman about the footwear brand's outlook amid COVID lockdowns in Europe and their expectations for the holiday shopping season with rising inflation in the U.S. Take a listen.
We just came out of a very strong third quarter. It actually has been the strongest one in the history of the company, not only in top line but also gross profit and EBITDA margin. So we really see that there's a strong demand for the On brand across all channels, across all product categories, across all the different regions, and this also continued now into the holiday season. We just passed the Black Friday weekends and have seen very strong results there. At the same time, of course, Europe, many countries are going back into lockdown, so this is obviously something that we are feeling as well. So Asia is on the hindsight is doing very well. So it's a bit a mixed picture in the fourth quarter so far, but overall very, very happy where we are, and very, very strong feelings about the future. We just started our sell-in season for the second half of 2022 and get a lot of really positive feedback from our key retail partners all around the world on our existing products and our new products. So we are really positive about the future.
Yeah, you guys have seen incredible growth over the past couple of years. Mark, you guys, when you reported your earnings last month, you talked a little bit about supply chain and trying to diversify the supply chain a little bit more. Now that we're a month on, from those comments, I'm just curious how that's going, especially given what Martin was just talking about in terms of this latest wave of the virus.
Yeah, I think for us, it's been very important since a long time to be extremely agile and nimble on how we're approaching things. And what you're seeing right now is you're seeing a lot of disruptions on the demand side, but then also on the supply side, lots of disruptions in the freight market. And so what we've been up to is really kind of balancing that out. We continue to diversify. We're entering new countries. We're actually in January and February above the capacity that we originally planned back in June. So we're very, very happy on where we stand from a supply perspective.
And you guys have also been diversifying in terms of product, right? When you reported your last quarter, your apparel sales are way up as a percentage of your overall sales. And I'm curious what the goal is for that side of the business. In other words, what is Martin, I'll ask this one to you. What does the appropriate mix look like for you between apparel and footwear?
Well, we're looking less at the mix. So apparel is obviously at a very earlier stage than our footwear business. We started with apparel back in 2016, but it's growing much stronger than footwear. So it will be a very important pillar of growth for the future. And we're very excited about many new products that are coming next year, especially in the area of buttons and insulated jackets and outer layers. But at the same time, our footwear business is still extremely strong across running, outdoor, performance all day. So for us, it's about growing all the different businesses, but less about how much share apparel will be in the future.
Yeah, Mark, I know the team puts a lot of pride in its innovation and the product pipeline as well. What's your biggest innovation that we need to be on the lookout for next year?
I mean, there's lots to come, but definitely I want to highlight Clean Cloud, which we announced, where we basically take carbon emissions and we're intending to make a midsole and outsole out of that. Please look out and watch out for Cyclone, which is our fully recyclable and circular product that comes in a subscription model. Very, very important. But then we're also looking at amazing innovation in the running space. So we're relaunching the Cloud, we're bringing a Cloud Monster, a Cloud Runner, and all of these products come with a way higher share of sustainable materials than in the past. So we're very, very happy with that progress, and we're very happy that we can, continue to ignite the human spirit through movement and bring an amazing feeling to runners' feet.
Guys, I want to ask you both, now that you have been a public company for several months, how that's been, if there is anything that's particularly surprised you about the difference between being public and being privately held, if there's any big learning that you have taken away. I mean, I want to get both of your takes on that. Martin, let's get you first on this.
Well, first of all, I think the IPO itself was a very emotional moment for all of us. And I think we were very fortunate that we hit the moment where actually our teams all around the world could at least meet in the office and celebrate that moment a bit before we now all have to separate again. So there was a lot of positive energy that came out of it. And at the same time, we are at a new starting line of delivering on our mission to ignite the human spirit through movement. So it maybe took like 2 weeks of digesting that whole situation. And then we all fully went back into the business and the opportunities that we have there, and also the volatility that we see on the supply side. But overall, we really see that it ignited a lot of positive energy into the company and into our partners as well. We've just been at the running event in Austin, one of the biggest trade shows for run specialty. And also there was a lot of positive feedback and pride from our retail partners about that milestone.
Yeah, it's always good to meet those people in person. What about you, Mark?
Yeah, I think, look, we exist, as Martin said, to ignite the human spirit through movement, and we have a big dream to bring millions and millions and millions more into that. And the IPO really helps us to have the funds and the opportunities available to do so. And I think already since the IPO, we've been able to announce a few things. We've been able, like Clean Cloud that I just spoke about, we've been able to celebrate successes with a podium in the Berlin Marathon. And we can take that and, we can bring it back to the athletes. We can create even better product, even faster product. We're expanding our distribution with some of the biggest retailers. We're doing pilots with JD and Foot Locker, and this is all very, very positive. So, in the end, as Martin said, it's a new starting line, and it's a huge motivation to everyone to make this way, way bigger than what it is today.
And guys, I was slated to be in your neck of the woods soon for the World Economic Forum in Davos, but now that has since been canceled because of the pandemic.
Very sorry.
What are you seeing? Yeah, no, you could have shown me how to ski for sure. But what are you seeing on the ground there in Switzerland? Is your team back in the office? Are you seeing less mobility? What are you seeing?
No, so now it's mandatory home office again. Everyone is back in the home office, but also in the outdoors, which was already a positive momentum in the last lockdowns. But anyway, we are approaching now the holiday season, so I think it's also a moment where the team deserves to switch off for a moment and to recover. They have done an amazing job over the last 12 months. And then hopefully everyone comes back fully energized to dream on in 2022.
And let me just very quickly add, I think it's, we've seen that in the past, in the last 2 years, that, lockdowns and kind of that being bound to a home place also triggers the need to go out and run. So I think, over the last 2 years, we've seen that this also gives a very, very positive momentum in the end to our products and, to the movement that we're trying to create. So we're ready to tackle what's to come, and we want to help people to get out and move.
Well, some welcome news for millions of student loan borrowers. The White House announcing a short time ago an extension in that pandemic moratorium. Let's bring in Yahoo Finance's Jessica Smith, who's following that story for us. And Jess, what kind of extension are we talking about?
Yeah, Kiko, the White House says it is extending this pause on federal student loan payments until May 1st. That pause was set to expire at the end of January, but after a lot of pressure, the White House said they are extending that by an additional 90 days. The White House says this will give borrowers more time. They are still feeling the impact of the pandemic, and it says it also gives the administration more time to deal with the ongoing spread of COVID and the issues that we're seeing pop up over the past few weeks. The White House has been under a lot of pressure, especially from progressives, in light of Build Back Better stalling, saying that the administration needs to do something to help borrowers. We did get a statement from Majority Leader Schumer, Senator Warren, and Congresswoman Presley praising the Biden administration for extending the pause on student loan payments, but they are continuing to pressure him to do more and cancel student loan debt. They're calling on him to cancel up to $50,000 in debt per person. That is something that the White House has resisted. But again, a big step here for student loan borrowers. That federal pause will last now until May 1st. Akiko.
Yeah, a big relief for so many, certainly. Thanks so much for bringing us that developing story, Jess. Let's turn our attention back to the markets. We're seeing the Dow near session highs right now. Those gains accelerating in the afternoon session, up about 209 points. In terms of sectors, energy continuing to see the gains despite some of the negative headlines around COVID. Let's bring in Jared Blickery for the very latest. Jared, what are you watching?
Well, I'm looking at the S&P 500, which is just shy of its record close. Now, let's pull up a intraday chart. We can see the price action. It's been up and away, but just hovering around the session highs right now. Here is a 2-month look, and you can see over the last 2 days, after we put in this hammer candle a few days ago, it has been off to the races. Now, our record high is somewhere around here, and we'll see if we can get to that in the next couple days. If we reject from there, could be a little bit of a negative for that Santa Claus rally that we've been talking about. Also want to take a look at the VIX, and the VIX is heading back down below 20 for the first time in several sessions. So that's another risk on flavor for the market. Now the bond market, the yield curve is contracting a little bit instead of steepening. And so that is a little bit of a negative, but maybe giving growth stocks a little bit of an edge here. Let's take a look at the NASDAQ 100. Big standout is Tesla. Let's check out a chart of Tesla right around $1,000 per share. Haven't seen that in a while. Here is the year-to-date view, and we can see it's up 41%. And then over the last month, you can see it's been in this downtrend. However, it's finally just breaking out, so maybe some signs of life for the EV space. And I do want to take a look at the sector action before we go. Consumer discretionary, which is one of the worst performing sectors of December, that is in the forefront here, followed by energy, healthcare, and tech. So a nice broad mix to round out the sector action for today. Akiko.
Okay, Jared Blickery, thanks so much for that. We'll be right back. The Consumer Electronics Show may be going on as scheduled in person next month, but some major names are already canceling their plans. Amazon, just the very latest in a growing list of companies who say they won't be traveling to Vegas. Let's bring in Yahoo Finance's Dan Halley. Dan, we were talking about this yesterday, saying, they can say they're going to continue. Other companies will say they're not going to take part. And it certainly a lot of big names already saying that they just don't feel comfortable traveling.
That's right, Akiko. It's not just Amazon that's pulling out, though they are one of the major companies that attends because of the Alexa integration in a number of devices. I mean, pretty much every year you go, you're going to get Alexa integration. One year was a shower, another year was a toilet. So it's basically everywhere. So to see them not show up is a big deal. But it's not just them, as I said, Twitter, Facebook, or Meta, which they're called now, not showing up. Pinterest, T-Mobile is pulling out, at least in person, is their president, Mike Sievert, or CEO rather, Mike Sievert, not going to be making a keynote there as well. So there's a number of big name companies that aren't going, and a huge number of tech outlets are not going as well to cover the show in person. But other companies are going. We're talking about the likes of Google, some of the other major brands that generally attend will be there. And look, this is to not host it in person is a huge blow to not just the people that attend, the smaller companies that have to pay the thousands of dollars for flights and for hotels and for the tickets themselves for the days there, but also for Las Vegas itself. It's 180,000 people that attend in general. And so that's a big boon for the economy there. They specifically built out an increase to the Las Vegas Convention Center to ensure that they can host more people there on premises. So to see it starting to fall apart in the face of this Omicron surge, obviously a sad event, but really, I think it comes down to the safety of the attendees. The CES says that they're going to be having on-site testing, requiring masks while indoors, and have vaccination requirements. But it seems at this point with Omicron really just spreading so rapidly, people just aren't feeling as comfortable as going to a massive trade show at this point.
Yeah, Dan, and to your point yesterday, that there's a precedent here with CES being virtual last year. I know you're going to be on top of it virtually as well, covering the event for us in January. Thanks so much for bringing us that story. Let's do a final market check before we let you go. The Dow up about 238 points here. Session highs is what we're looking at for the S&P 500, up about 38, and the NASDAQ up 128. Much more to come here on Yahoo Finance Live, but that does it for me in these 2 hours. Keep it right here.
Stocks jump for a second straight day as Omicron fears ebb and Wall Street traders head out for the holidays. Mizuho economist Stephen Rasciuto joins us in just a few minutes to take a peek at what 2022 has in store for investors. You're going to want to hear his Fed prediction. Plus, the latest Monster.com job survey. It reveals some startling trends as workers prepare to return to the office next year, why the Great Resignation may persist longer than your boss would like. Monster exec will lay out all the details. And renowned Bay Area chef David Nayfeld of Che Fico fame. He stops by to discuss how Omicron is disrupting holiday plans and slashing reservations, what the restaurant industry is looking like now with 1 million fewer jobs. Welcome back to Yahoo Finance Live. I'm Jared Blickery along with Karina Mitchell. And Karina, investors celebrating finally a couple. We're stringing together 2 straight up days. Well, we still got a few hours left, but what are you looking at here?
Finally, you're right. Stocks extending those gains on the back of that rebound yesterday, and helped along by some really nice, encouraging eco data. So the third read for third quarter GDP coming in at 2.3%, better than the 2.1% estimated. And consumer confidence really surprising a little bit, showing the biggest gain since July, coming in at 115 versus 111 for December. That's, of course, despite rising inflation and COVID cases, all helping the major benchmarks today. You can look at them and see all in the green. At our near session highs, the Dow is up 219 points. The S&P is at its near an all-time record high, up 35 points, and the Nasdaq also better by 117 points. Sector-wise, all in the green, and consumer discretionary leading the pack, and the VIX below 20. That happens after a long time. Here with much more on what's driving the market action today is Yahoo Finance's Ines Ferre. Ines?
And Karina, you mentioned consumer discretionary and energy stocks that are leading the gains today. If we just take a look at our Wi-Fi Interactive board, you can see the 11 sectors of the S&P 500. And if you pull up a month-to-date chart, you can see that consumer discretionary was actually underperforming and energy underperforming compared to the rest of the sectors. But today, these are the leaders. Let's look at where we're at with the NASDAQ 100. The big outperformer today being Tesla, up more than 6% earlier. Tesla up 7%, going up above $1,000 per share. And then looking at the Dow, we are watching on the Dow, one of the better performers being Caterpillar, up almost 2%. This is after Bernstein put out an outperform rating on Caterpillar, upgrading the stock. Then just looking at the RX space, I've been watching Pfizer shares up almost 2%. Pfizer near session highs after the company's antiviral pill was approved for emergency use authorization by the FDA. It's first actually at-home COVID drug. And if we're looking also at Moderna, the Moderna shares have been at session lows after that Pfizer news. And lastly, I just want to point out where we're at with travel today, because we are seeing more gains for travel. If I just pull up a 2-day chart, you can see quite a bit of gain over the last 2 days for the travel stocks. Karina, Jared?
Yeah, we thank you for that, Yahoo Finance's Ines Ferre. And we want to continue the markets discussion with Stephen Rasciuto, Mizuho America's chief U.S. economist. And Stephen, I want to start with a startling prediction of yours going through your notes here. You're saying that the Fed may not raise interest rates at all next year. And this comes on the heels of some really high inflation numbers, not only for the prior quarter, but we're expecting some PCE inflation numbers tomorrow, expecting 5.7% on the headline number, 4.5% when you strip out food and energy. What's your reasoning here?
Well, the reasoning is we anticipate that the economy is going to start to roll over very, very quickly next year. We believe a lot of activity was pulled forward into 2021. We also believe that the variant issues will be around longer than people anticipate. And we look at the failure of the Build Back Better program to suggest that fiscal policy will be a drag on the economy, as well as the fact that rising interest rate expectations have already weighed on the economy, and that a rising currency will continue to weigh on the economy. So when we look at a lot of the factors that led to the stronger growth environment in 2021 and the rebound in 2020, a lot of those factors are starting to roll over. And we anticipate that the impact on the economy will be quicker than a lot of people anticipate.
And then I want to ask you, sir, about the reads that we got today, third quarter GDP at 2.3%. What are you expecting for fourth quarter results, given that we have this sudden surge of COVID spurred by the Omicron variant?
Well, actually, the fourth quarter is going to be biased upwards by September and October developments. November and December developments are really going to bias down first quarter. So we have a nice rebound taking place in the fourth quarter of the year after the very disappointing third quarter numbers. But then we have every quarter of next year consecutively declining until we get back to around 2.25% in the fourth quarter of next year. So on a quarterly pattern, it's being biased upwards by what happened very early in the quarter, whereas the first quarter of next year will be biased down by what happened at the end of this quarter. And we believe the end of this quarter is going to be a drag.
Stephen, you mentioned the US dollar before, and I think you talked about its strength. And I have on the Wi-Fi Interactive a 3-month chart of the US dollar index, albeit that it's weighted kind of archaically. We can see we got this big price rise in November, and then it's just been kind of sideways ever since. But if you take a look at the 5-year chart here, you can see we've crossed some pretty big levels, at least on a technical basis. And now that we're consolidating above, some traders are thinking the dollar has room to advance farther. If this is the case, how does this affect the economy next year?
Well, again, I mean, this is our view. The dollar is going to move higher. I mean, on the DXY basis, which you have plotted up there, we expect it to go above 98, and we think there is a possibility, an overshoot to 100. What this does is, in a world of excess supply where global deflation is dominating at the long end of the curve, even though we're worried about inflation here, deflationary pressures are much more evident globally. We're going to import that global deflationary environment, and that's again one of the key reasons why we're looking at 2022 while everyone else is ramping up their expectations on the Fed. We're saying, you know, press the pause button. Let's see how things unfold in the early part of the year to see whether or not the Fed's even going to be forced to do it at all.
And Stephen, I want to get your take on the consumer confidence index read that we got, 115 for December. What do you think will be the health of the consumer going into next year, particularly the first half, as inflation seems to be, you know, like it will continue to rise or be at elevated levels?
Well, let me lay out two things about the number that came out this morning. Number one, the current conditions component was flat. So all of the improvement was in the expectation side, and expectations can dissipate very, very quickly. The other thing is when we look at the labor market components of that report, they were a net drag, showing that we are starting to see some, you know, downward adjustment in employment that's taking place, or at least in terms of the dynamics of the labor market. We're starting to see some of that turn a little bit less positive. And I will tell you, from talking to a lot of our regional contacts in the banking industry, we're getting a sense that a lot of households have already started pulling down on some of the savings that they accumulated as a result of the CARES Act stimulus and the upward adjustment in unemployment benefits that continued through the American Rescue Act, and that people are starting to, in order to stay home, are starting to draw down on savings. And there's no pent-up demand in the system, so that just suggests to us there's not that much potential for the consumer to really drive the economy appreciably higher in 2022.
So I just want to continue this line of thinking. If in fact the economy does roll over in Q1, Q2 next year, and the labor market, which some say is close to full employment right now, but as you're saying, signs a little bit of a sign of weakness there. What happens to the JOLTS picture of people, the Great Resignation, people who have been leaving their jobs in droves? We have a Monster.com guest on later today. 60% of the respondents from his most recent survey say that people are still looking for new jobs based on their dissatisfaction with their work from home or return to office situation.
Well, I mean, I think there's a lot of dynamics going on in the labor market. And I think when you ask a lot of these survey questions and you get the response, you interpret them, you have to be very, very careful in terms of reading too much into them. We have seen studies as well that show us that people who retired are coming back into the labor force. So there is an adjustment process taking place in here. And I'm afraid a lot of these anecdotal surveys are just going to miss the boat. The important thing to understand is when we look at the monthly inflation numbers, which we have long-term continuous series of, when you look even at the JOLTS number, where we have a good long-term history of it, what I think is going to happen in the JOLTS numbers, some of those job openings are going to disappear. And I think we're going to see a narrowing of the spread between openings and hirings from both of those components as we go forward in here. And I think the labor market is going to show evidence of beginning to ease up next year as the growth numbers begin to trail off rather quickly.
And then, Stephen, really quickly, I want to know, how does the Fed then take that into account? Because do you think in some respect that it's abandoned its dual mandate of looking at full employment? What is full employment on this side of the pandemic anyway, as it focuses on trying to curtail inflation?
I think if you were to ask them, they'd say they haven't abandoned that. And when you look at their summary of economic projections, which underlies the dot plots that everyone alludes to in terms of what they're going to do in terms of monetary policy, they imply that they believe they are approaching full employment or will be at full employment by the time they get to March. And that's going to be the interesting dynamic, whether that's validated or not. My current assessment of this is they're not going to be validated, and they're going to be pushing that off into the future. Keep in mind, the Fed's growth scenario for 2022 is substantially higher than the consensus, and our numbers are even below the consensus. So the Fed has a much more robust economic outlook priced into their analysis than we have.
Well, we have to leave it there. Stephen Rashuda, always appreciate when you stop by here, and lots of thought-provoking content. Can't wait to get your thoughts on the new year. But for now, we have to say goodbye. And also, we want you to step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. Check it out today at yahoofinance.com/plus. And coming up after the break, we have a roundup of all things COVID. Some interesting headlines coming out. Omicron may have an 80% lower risk of hospitalization. We're going to discuss it.
Welcome back to Yahoo Finance. Well, the FDA has just approved Pfizer's antiviral COVID medication, making it the first at-home pill to help fight infections. Meanwhile, President Biden laid out new protocols for dealing with COVID yesterday that didn't include any new federal curbs. And while a new study from South Africa shows Omicron produces an 80% lower risk of hospitalization, some scientists say cases will still surge exponentially, and the Biden plan doesn't go far enough. Here to help us discuss it all is Dr. Owais Durrani, emergency medicine physician. Thank you so much, Dr. Durrani, for joining us. First, want to get your reaction to this antiviral Paxlovid. The government says it has purchased 10 million courses. Delivery will start in the new year. Is this a game changer in the fight to have it in the arsenal?
Yeah, thanks for having me. I think it is a major tool in the arsenal. It's an exciting day anytime we get a new medication or therapeutic that'll help us fight this pandemic. This is a medication that if you test positive and are symptomatic, you start within 3 days. It's a 5-day course that'll decrease the chances of hospitalization and death by 80% plus. The good news is also initial data shows that it is effective against Omicron. So it's positive news, but I want to be cautious and make sure that this isn't taken as a magic bullet. Vaccinations are still going to be the first option. If you get infected and you take this medication, sure, you might not get hospitalized, but you could still end up with long COVID. This is also going to be, even though we've purchased a large amount, there's still going to be accessibility issues in getting this widely available just because of how much demand there's going to be for it. And then I'm concerned about that individual that, might not have access to the latest information, might not have a primary care physician, how they're going to get this medication, and making sure that we remove the obstructions that might exist in getting this medication equally to all parts of the country. And so definitely good news, but we still need a strategy that is vaccination-based, mask-based, and then other therapeutics such as this medication.
And then, Doctor, I want to turn back to the president's plans that he outlined yesterday. He said, if you're vaccinated, go out, don't worry, celebrate the holidays. If you're boosted, even better. That is in stark contrast to what the Director General at the World Health Organization says, which, he says sit out the holidays because a canceled event right now is a life less canceled further down the road, saying, you're going to impact someone's life if you're not careful during the holidays. And, in hospitals like New York City, in hotspots like New York City, where we're seeing a huge number of cases, exponential growth, some medical professionals are saying that Biden's plan doesn't go far enough. So do you think that the plan does go far enough? Did he send the right messaging out yesterday?
Yeah, I don't think it's an on-off switch. I think what we as a society really have to focus on is taking all of our personal circumstances and then using the calculus to see what's right for us. And so, for example, if you are a small family and want to get together for Christmas and everyone's vaccinated and boosted if eligible, if you travel appropriately with high-quality masks, KN95 masks, N95 masks, and if you use appropriate testing, then sure, that might be a good idea for your family. But the flip side of that might be, some members of your family are unvaccinated, or you're in an area where there's very high viral transmission and the hospitals are full. And if you get sick, you might not be able to get into hospital, and that might be a different circumstance. And so I think we each have to look at our individual circumstances and then make a decision based off of that. No matter what decision we do make, we need to ensure that we are vaccinated, that we're using high quality masks, and that we have tests before we get sick. And so the time to get a test is now. And then when you do feel potentially symptomatic and you're not sure if it's allergies or something else, that's when you get tested. If that's when you start searching for a test, you might not be able to find one and it might be too late.
And Doctor, I want to get your reaction to some recent comments by Dr. Fauci regarding the CDC's 10-day COVID isolation policy. It's been kind of a one-size-fits-all. And of course, we are, as you've been talking about, in very different circumstances. There's been talk of reducing it to 5 days for vaccinated people. Just wondering what your thoughts are on this.
Yeah, I think that's a good idea. It's got to be data-based and data-focused. But, as you mentioned, it has been one size fits all, and it hasn't been updated in a while. And so if you are fully vaccinated and boosted and you have an asymptomatic positive infection that then is negative a few days later, I think it's fair to go back to work based on the data. Furthermore, a lot of healthcare workers, even though we might be boosted, we got boosted a couple of months ago, we might test positive and have an asymptomatic case. And it'll be crucial in ensuring that a large portion of our healthcare workforce doesn't go home and sit out when we need them the most. And so I think it's something that is worth looking at. And as long as it's based on data and as long as it doesn't cause a detriment to safety of those around us, I think it would be a good idea.
And Dr. Durrani, I understand that you're based in Texas. What are you seeing in the hospitals there as far as the number of patients and those patients that come in? How many of them have the Omicron variant versus, some other form of COVID? And how many of them are, vaccinated versus unvaccinated?
Yeah, so most of the patients that I've been seeing that have been admitted to the hospital have been unvaccinated still. I've admitted probably maybe 1 or 2 vaccinated patients over the last couple of months. That was previous to Omicron. Omicron is the dominant variant here in Texas as it is in much of the United States. And so we essentially assume that Omicron is what all of our positive tests are, most of them. Delta still does exist. And we, kind of go off of that. Furthermore, we had our Delta surge back in the summer and kind of came off of the Delta surge, but our hospital capacities never really went back to what they were pre-pandemic. And that was because of, so many people delaying care in 2020, coming up with, things like heart failure, kidney disease that has been much progressed. And so them needing to be admitted for extended periods of time. And so our ICUs have been at 90% plus capacity, even when the Delta surge waned. And now we're seeing a huge Omicron surge. And even if the hospitalization rate for Omicron is not as high as it has been for previous variants, just because it's so prevalent, people are going to get hospitalized, and that's going to put another strain on our system. And so although we haven't seen ICU capacities maxed out yet in the Houston area, it's going to take very little for that to happen.
Okay, Dr. Owais Durrani, we will have to leave it there, emergency medicine physician. Thank you so much for your insight today. We're going to take a quick break, but after that, a conversation with the chairman of the U.S. Securities and Exchange Commission. Stay with us.
Welcome back. SEC Chair Gary Gensler joined Yahoo Finance's All Markets Summit in October, where he discussed crypto regulation, among many other things. Let's take a listen.
we really take a look at this. These went effective, as you know, last week, but we look at these as the Chicago Mercantile Exchange has Bitcoin futures. It's been regulated by our sibling regulator, the Commodity Futures Trading Commission, for 4 years. And then on top of that, there's the regulatory regime, which we've had for nearly 80 years, that for investment funds and the like. We'd already had some Bitcoin futures mutual funds. They didn't get as much publicity, and these went effective along with that. It's really a matter of bringing as much of this space within the investor protection remit. And I think that that's really the story here is if projects, tokens come to us, work with us, and bring themselves inside the regulatory perimeter, investors will be better protected.
So on that point, I mean, just to kind of drill down, the Bitcoin spot ETF, you've expressed concern about what the underlying risk might be with Bitcoin, right? Whether that's anti-money laundering or other types of issues. Do you feel like anything that you've seen, though, with the Bitcoin futures products last week are resolved? Are any of those concerns kind of alleviated given what we've seen the response to those products be? And are you becoming more friendly towards the idea of a spot ETF because of what you saw last week, or are you still trying to kind of form what your thoughts are on the underlying product first before you try to move forward on any sort of other product there?
Brian, you can imagine I'm not going to speak to any individual filings that might be in front of us or prejudge anything, but I think that the concern for the investing public is the crypto asset space, $2.5 trillion. Most of it has not come within an investor protection remit. And thus, investors aren't protected the way they are, whether they go into the stock or bond markets that we've overseen for so long. Without that, I think that it really is, as I've said to others, a bit of the Wild West. And these markets, largely around the globe, 24 hours a day, 7 days a week, don't have the similar protections against fraud and manipulation and front running and other abuses.
So let's move on to stable coins, kind of a sub-corner in the crypto space. They've been eating a lot of lunch from the prime money market funds, and there's been some media reporting that's gotten a lot of attention about the transparency by which some of these stable coins are detailing what's actually underlying the reserves that back these assets. You've compared stable coins to chips at a casino. Do you think that stable coins should be regulated as banks?
Well, there's about $130 billion of stable coins today. That's up nearly tenfold in the last year. And they are intertwined inside of crypto exchanges, crypto lending platforms, so-called DeFi. And those poker chips, so to speak, are facilitating 80% of the volume. So they're only 5% of the crypto market, but 80% of the volume in this token-to-token, crypto-to-crypto trading. And so I think there's a lot of speculative activity. And again, it's best to bring that inside a regulatory investor protection remit. So I do think there's work to be done here.
By extension, I mean, what you kind of said right there about the amount of volume that we've been seeing in this space does kind of also extend to the broad DeFi movement. Just wondering what your thoughts are on DeFi. Obviously, it stretches into a lot of different areas. What do you feel like the SEC's role is in regulating that space? Just kind of your broad thoughts on that.
My broad thoughts are it's one of the innovative areas in this crypto movement. I mean, we start with Satoshi Nakamoto, who was pressing up against the definition of money and ledgers, a sort of an old, thousands of years old technology, money and ledgers. But decentralized finance has started to press up some other innovations. While that's all interesting, it reminds me a lot about when peer-to-peer lending came along about 15 years ago. People said, well, I'll lend money to you and it will just be peer-to-peer. And we had to take 3, 4, 5 years to bring it within an investor protection and in some cases banking regulation. And I would say that's what we're going through right now, the same process. Hopefully we get to the other side where whatever innovation that's there survives. But again, the public's protected. We protect against financial stability concerns as well. There's a lot of lending going on. There's a lot of trading going on. And without protections, I fear that it's going to end poorly.
And you draw the comparison to banking. Does that mean that, because it's not just the SEC that's in that space, right? The Federal Reserve, the OCC, the FDIC. So have you had discussions with them also about the proper way to approach these types of new offerings?
Well, under Secretary Yellen's leadership at the Treasury Department, the president's working group, a group of financial regulators, we're working together around stable coins. And again, the stable coins of today, this 130 billion or so, which has been rapidly growing, could lead to payment tokens and general purpose payment tokens in the future. But even the current system, the current remit, we're working most closely with, again, our sibling market regulator, the Commodity Futures Trading Commission, but also along with the bank regulators and lastly, the Consumer Bureau, the Consumer Financial Protection Bureau, that has a lot of authorities around payment systems as well. So we're all working together, trying to bring the protections that we've had in our traditional securities markets, derivatives markets, and the like.
That was SEC Chair Gary Gensler speaking at Yahoo Finance's All Market Summit. Well, coming up after the break, we have a conversation with Bay Area renowned chef David Nayfeld about the troubles the restaurant industry is facing with the resurgence of Omicron. Coming up.
Welcome back to Yahoo Finance. Well, the resurgence of COVID spurred by Omicron is forcing businesses to make some tough decisions on whether to stay open or not during their busiest season. And feeling the impact firsthand is David Nayfeld, Kay Fico, group co-owner and Independent Restaurant Coalition board member. David, thanks so much for coming on today. So I had plans. I booked dinner for 8, Christmas Day, for 8 people. We had family and friends coming in from Los Angeles. They just canceled their trip. They're not coming now. I was able to salvage and, cancel my booking without paying a penalty. I'm wondering, what are you seeing firsthand at your restaurant and among the coalition as far as cancellations due to this wave of Omicron?
Well, thank you very much for having me. As of right now, we're seeing it trending roughly towards around 30 to 45% per night in cancellations, either the day before or day of, which is, incredibly detrimental to restaurants. Here in San Francisco, we're also experiencing a tremendous amount of rain. So outdoor dining has become less of an option for us. So right now, what you're seeing is us go through this, as well as a number of restaurants just having to shut down very, very quickly because they're getting breakthrough cases with their all vaccinated staff. So then you essentially have to account for the entirety of the loss of revenue for that night and potentially other nights, as well as loss of products. So we're in a really, really dire situation right now.
And David, I just want to ask about the labor situation. We asked you about this, and in your notes today, you said that there are actually 1 million fewer people in the restaurant business. I'm just wondering, is it still tough to attract talent or to attract any kind of workers in your industry, or are you still seeing a really tight labor market?
Yeah, look, I think that the labor market, especially when in reference to the restaurant industry, is a multifaceted issue, right? You have people who left certain locales that became too expensive for them to live in. You have the fact that people still have a certain amount of tension when dealing with staff or dealing with clientele that could potentially be combative because they don't like some of these new kind of implementations that we need to do that have been put on us by the government. You have staff that just feel uncomfortable in public still. And then you add to that the fact that our industry is a challenging one to work in, for anyone. And so, but I want to be clear, the labor force issue is just one of maybe a dozen of issues that are just really crippling our industry right now, and none of this is going to be solved unless we get federal funding in the form of the Restaurant Revitalization Fund refilled, which is something that's been promised to us time and time again, and something that has overwhelming bipartisan support.
And this, as you say, couldn't happen at a worse time. It is the busiest season of the year for the restaurant industry during the holidays. But I'm wondering, you were also surely impacted, as many other sectors were, with supply chain disruptions, the rising costs of food. Every ingredient costs more, from chocolate to coffee, meat prices, skyrocketing as well. So how have you weathered that over the course of the pandemic? Have you had to raise menu item costs, and have you passed them on to the consumer? And then if you have, what's been their reaction?
Right. So, to answer your question succinctly, we've dealt with it poorly, right? Like everyone has had to. There is no, elegant solution to the fact that we just have to raise our prices across the board. And I'm not talking about by a little. I'm talking about menu prices going up sometimes between 30 to 50% if you want to hope to survive this, right? And so that is by virtue of the fact that we're going through record inflation for our time, by the fact that to entice the labor that we need to open our restaurants, we need to overpay them. And I say overpay as in a historic figure, not as in they're being overpaid for their work, because a lot of these people have deserved to get paid more already, right? And so we're dealing with a number of different challenges. And I think at the end of the day, the pricing at restaurants is just only going to go up from here if restaurants hope to survive. The fallout is the fact that many restaurants aren't even go through that exercise. Many of them are just going to shut their doors. And we're talking about, we've already lost over 100,000 restaurants in the United States permanently. what we're looking towards, if we don't get the restaurant revitalization fund refilled, and I'm talking about like within the coming month, we're already so far behind the ball. A lot of these people are not going to make it past this New Year's.
Well, let me continue that discussion then. What's it going to take to get this through? I haven't heard about the Restaurant Revitalization Fund in some time, and we just had the Build Back Better plan kind of drop off the radar now. Is in the new year, what is it going to take to drive the impetus for this? And maybe one thing just coming to my head here is lower menu prices, because if in the face of all this economic hardship, all you can do is raise prices 30 to 50%. If you do get the funds, are you going to be able to keep prices at more manageable levels?
Oh, certainly. If we get funds, that will help a lot of restaurants sustain current pricing models and take care of their staff, as well as make their landlords whole, pay their creditors, pay everyone involved in the kind of, ecosphere of the restaurants, right? So it's a win-win-win for everybody. If you pay restaurants money, they are going to stay open, continue to pay people, pay payroll tax, pay sales tax. You don't get empty storefronts. The entire community benefits when you keep these businesses alive. To get to your initial question as to where we're at with this, I mean, frankly, we're very, very close. We have overwhelming bipartisan support. We really need a couple more Republicans in the Senate to sign on, but we have some Republican support. I just want to kind of point this out to you. We have a bill that's being presented by Senators Wicker and Senators Cardin. We have Senator Schumer's support, full-throated support. What we need is, we just need a few more senators to sign on to this. If you have a bill that both Joni Ernst and Elizabeth Warren agree on, right? Like, think about how rare that is, right? The entirety of Congress understands that small business is the backbone of this country, and that restaurants are at the eye of that storm, right? Like at the very, very center of one of the most crucial industries to save. And so what we need right now is, Congress went home for a holiday while we're all dying and closing our restaurants, right? We need for them to take action now. And this is action that they should have taken, to your point, a year ago. They should have refilled this. Right now, what we're seeing is the fallout of that, with a lot of restaurants that are struggling, and with the Omicron virus kind of gaining a lot of traction. You're going to see a lot of restaurants that are having to suddenly close, lose a ton of revenue, and a lot of them may not reopen at all.
It is a very difficult situation for the entire industry. We will have to leave it there, but David Nafelt, KFICO Group co-owner and Independent Restaurant Coalition board member, thank you so much for your time today, and we wish you very well. We are going to take a quick break, but after that, Wells Fargo is the latest business to delay its return to office policy indefinitely. But a new poll from Monster shows that a majority of workers are being ordered to go back to work. How do they feel about it? Stick around to find out.
Welcome back to Yahoo Finance Live. A recent Monster survey among workers revealed that a slim majority are being required to return to their office in the new year, but nearly two-thirds of them, or two-thirds of workers, are planning, they have other ideas in mind. Maybe their job isn't what they want for them. We're going to talk about all of this with Scott Blumsack, Monster Senior Vice President of Research and Insights. And I just want to begin with that stat here. You're saying 64% of respondents are saying that employers' return to work plans are leading them to look for a new job. I find that number a little bit high here.
Yeah, no, I mean, that was one of the most interesting takeaways that we got from conducting this research. And I think part of that is obviously driven by what's going on in the current environment and concern that employees have over COVID and the new variant. But I think it also speaks to just the larger trend around employees are really continuing to feel a great deal of burnout and stress, which consistently in our research has caused them to say that they are looking for work. And I think just the latest situation going on is just, I think, one more piece on top of that. And having to kind of go back to work amidst all of that is potentially sort of the straw that breaks the camel's back for certain of these candidates.
What are some of the biggest concerns that they say, about returning to work? What's holding them back?
Yeah, so some of the biggest concerns are what we've consistently heard from employees, which is they've really adapted to the remote work environment and sort of the flexibility and the work-life balance that comes along with that, and they're very worried about having to give that up. About two-thirds of the respondents said that work-life balance was a key concern for them, and just under half, said they are actually worried about getting COVID in a return to work situation. So it really speaks to the need for employers to be really clear around what they're doing from a return to work policy in order to keep everybody safe.
And when it comes to incentives, how are employers enticing employees to retain their services? I would think offering more money would be a big one.
Yep, and that was certainly the number one factor that we got from our research. 73% of respondents said that incremental wages would be one way to get them back to the office. More paid leave was another one, and then also really being able to offer and communicate that sort of safe workplace was the third.
And then I, did a little bit of homework on this. And according to a survey from the OECD, workers in 25 countries say a 5-day work week in the office is now dead. Many prefer at least 1 day a week teleworking. Do you think that's true? 5 days in the office is dead forever now?
It's interesting. Certainly from our research, we found that only 20% are the very relatively few amount were actually going to be going back into the office full time, or just about a quarter of them were going back to the office full time. And I think it really just speaks to the larger trend around remote work and how people have been able to sort of balance this remote work or this hybrid work. And for many employees, that's really what they're looking for in that job, is that flexibility that comes along with it. And I think for a lot of employers, it's going to be really hard to sort of turn back the tide to go to 5 full days back in the office.
And Scott, I don't know if you covered it in this survey, but you guys do a lot of surveys. I'm just wondering, are people's employment decisions being made based on vaccination requirements, mask requirements? And it could go one way or the other. Some people might want to have more stringent requirements in place, and others may not want any.
So we did cover it a little bit as part of this study, and it was interesting and probably not unexpected when you look at the macro trend, where there was about 30% said that they would actually feel more comfortable if their employers dictated a vaccine mandate. There was another 30% who said that actually it really wouldn't impact how they felt about safety. And then there was another 40% roughly who said actually they didn't really feel it was the employer's place to dictate a mask mandate. So it definitely is different across the spectrum of individuals based on their personal situation.
We always appreciate you stopping by with those insights. Scott Blumsack, Monster Senior Vice President of Research and Insights. Coming up after the break, President Biden, has been meeting today with the CEOs of various companies, exploring the supply chain bottlenecks that we're all facing. We're going to talk about it with Yahoo Finance's Jessica Smith after the break.
Welcome back to Yahoo Finance. Well, President Biden meeting with the CEOs of companies including FedEx and The Gap earlier today to discuss the state of supply bottlenecks. And here with key takeaways is our Yahoo Finance's Jessica Smith. And Jessica, the fact that there even is this follow-up meeting obviously means that the supply bottlenecks are still somewhat of a concern.
Yeah, well, this is another meeting that the president is having with these business leaders. He has had several over the past few months, but at the beginning of this meeting, President Biden touted the progress that has been made on these supply chain disruptions. In this meeting with the business leaders and his economic team, the president put this task force together focused on this back in June. He said the actions that his administration has in private sector companies have taken to address these bottlenecks have worked in ensuring that shelves are stocked for the holidays. The president noted that pre-pandemic shelf availability was at 91%, and now it is at 90%. President Biden pushed to expand trucking hours and move ports in California to 24/7 operations. And tomorrow, he said the Transportation Department will announce more grants for ports. We also heard from the CEO of FedEx at the top of this meeting, and he said while not all of the supply chain issues have been resolved, he said they are making progress. He's optimistic. He said that most of Santa's products, as he put it, will make it to consumers in time. He said peak season is going to be a good one. We also heard, you'll remember a little while ago, a few weeks ago, from the Walmart CEO in one of these meetings saying that the flow of goods at ports have improved as well. Still, the president said that increase in prices is still top of mind for him, and there is still work to do. Let's watch.
Addressing these costs has been and will continue to be my top priority the entire administration. And the way to do this is not to slow down our economic turnaround, not to step back from all this progress, but to build on it. We can and we will address prices by expanding productivity capacity in our economy so we move more goods to market, get more Americans working, encouraging more investments in innovation, and making sure American consumers see those benefits at the store and at the pump.
The president said he will convene his competition council again in January to ensure there's robust competition across industries. He said that that is the hallmark of healthy capitalism. Now, also, in order to build on things in the long run, the president says he again urged Congress to pass his Build Back Better plan, of course, that have stalled in recent days after Senator Manchin said he would not support that legislation. But again, President Biden encouraging them to figure out something to come to an agreement on that legislation. Republicans, of course, have been seizing on these inflation issues, the supply chain disruption. And so this is definitely something that the White House wants to figure out and get under control before the midterms next year, guys.
And Jessica, we got another minute here. I want to touch on some other news that broke earlier today. President Biden has extended the student loan forgiveness, I believe, through May of next year. And I believe, as you said earlier today, this was somewhat expected, but do you have any details on this?
Yeah, the president says that they are extending this pause on student loan payments until May 1st. This pause was set to expire at the end of January, but the president says they are giving student loan borrowers an extra 90 days. They said that they know that borrowers, some of them are still coping with impacts of the pandemic and need more time before payments resume. Progressives have really been pressuring the White House to extend this pause. They've also been urging him to do more and cancel student loan debt. We heard from Majority Leader Schumer today and Senator Warren praising this step, but saying the president needs to cancel student loan debt. So this is a relief likely for many borrowers, but I think we're going to see this debate continue to play out in the coming months.
Yeah, definitely a gift for borrowers before the holidays. Okay, Jessica Smith, we'll leave it there. Thank you so much. We have much more coming up after a quick break. More market movers and action, and also the founder of Reseller Fashion File with some gift buying advice. Stay with us.
Risk is in the air as investors cheer day 2 of a rally on Wall Street that has bulls thinking up, up, and away. We've got 3 market gurus on deck to weigh in on what to expect in 2022. Plus, handbag inflation up 60% this year is confounding luxury bargain hunters. The Fashion File founder and president stops by to chat the red-hot resale market for luxury goods, especially among up-and-coming Gen Z fashionistas. And million-dollar listing New York's Ryan Matthew Serhant joins us for a conversation about how fintech is disrupting the real estate market, how brokers are getting paid their 6% upfront, not unlike a payday loan. Welcome back to Yahoo Finance Live. I'm Jared Blickery, in for Alexis Christoforous, along with Karina Mitchell. And we want to start out the conversation with Yahoo Finance's Ines Ferre, who we're going to bring in to talk about 3 of our top trending tickers today, And the first one we'd like to hit, Ines, is Tesla. Elon Musk still selling more shares. By my count, it's up to almost $14.5 billion.
Yeah, that's right. And that's about 13.5 million shares. And you can see a Tesla stock right now up almost 6%. It had been up 7% during the highs of the session. And Elon Musk saying that he sold enough shares to reduce his stake by 10%. On Tuesday, though, he sold another 583,000 shares, a little more than that. Wedbush's Dan Ives had commented earlier that basically that the overhang of him selling shares is through for now. You'll recall that on November 4th, this stock reached new highs around 1129, just a few cents above that was what it closed at. But then it started to sell off after Elon Musk started to sell shares. This is something he had telegraphed before, that he was going to be doing this near the end of the year. But certainly today, shares have been topping the $1,000 level. Also should note that the final paperwork was submitted for German local authorities to be able to give the green light to that gigafactory near Berlin. So we could see news on that any day now to start production at that gigafactory. That's according to German reports.
Okay, and then Inez, Carmax out with better than expected quarterly earnings, but the stock is heading south. Why?
Yeah, that's right. So right now we're watching shares of Carmax that are down more than 6%. CEO Bill Nash, he talked about the record revenue for the company. It's the metrics for the top line, for the bottom line, those beat expectations. Earnings per share coming in at $1.63. Revenue increased 64% year over year to $8.5 billion. Also used vehicle sales, those increased 53% year over year. But some analysts are highlighting a contraction when it comes to margin, and also Carmax Auto Finance. That income decreased 5.9% year over year. The income coming in at $166 million. That's down from $176 million during the same period last year. So that may be why you're seeing a little bit of pressure on the stock today. But still, year to date, the stock is up more than 35%.
And BlackBerry as well, making headlines today, Inez.
Yeah, BlackBerry, it just flipped into green territory. It's now down about 0.2%. A modest beat on the top and the bottom line for the company that now does software and security. That it used to make those BlackBerry phones that many of us used years ago. Adjusted earnings per share coming in at 0 cents. The street was expecting a loss of 7 cents. Revenue coming in at $184 million. That came as a beat. Its fourth quarter guidance, though, coming in short of what some analysts had been anticipating, missing RBC Capital analysts' expectations. RBC, by the way, has an underperformed rating on the stock and the price target of $7.50. The company still has those negotiations going on for the sale of some of its patent portfolio, so that's still not been finalized yet. And its cybersecurity segment sales fell. That's something that analysts had also noted. I should note that this stock had been memified earlier this year. You can see the price action in January and February when it was at the height of the meme frenzy. 0 buy ratings on this stock, 2 holds and 6 sells, with an average price target of $8.55 a share. Again, this is one of these meme stocks that many of us know from when we used to use Blackberries. And just a fun fact, Back in 2008, BlackBerry's market cap was at $78 billion. Today, that market cap is just north of $5 billion. Jared, Karina?
And I'll tell you what, Ines, I remember when the ticker RIM was front and center on most of those cable financial news networks. Thank you for that, Yahoo Finance's Ines Pere. Well, we want to continue the markets discussion with Angelo Kourkafas, Edward Jones investment strategist. And Angelo, thank you for joining us here today. We got some hotter than anticipated economic data out earlier. That would be GDP and also consumer confidence. I'm just wondering what you're making of this data.
Yes, thank you for having me. Today's data, in our view, provides some evidence that the economy is ending the year with a positive momentum. Consumers were more upbeat in December, looking at consumer confidence, which should provide further support to spending. We saw also buying plans for autos and homes increasing, and also consumers are more confident. They have an improved outlook about their employment prospects. We think workers appear to have the upper hand with a record number of job openings, actually more than the number of unemployed, and jobless claims declining to historically very low levels.
And then, Angelo, I want to look ahead. What do returns look like to you on the equity side heading into next year as we start normalizing?
Yes, we think we're still going to continue to see very strong consumer and corporate fundamentals, but it's not all going to be sunshine and rainbows next year for the markets. We think that the main theme for next year will be that of moderation. The economy and earnings, corporate earnings, will continue to expand once again, but at a more moderate pace. And I think that moderation, in combination with the Fed removing some of its liquidity and normalizing policy, that probably means more volatility and more frequent pullbacks than we have seen. But all in all, the expansion, the bull market continues. There's plenty of mileage left. In our view, just returns moderates and pullbacks become more frequent.
And Angelo, I want to ask you about your projection for what the Fed is going to do next year and kind of compare it with a guest that we had on an hour ago from Mizuho, who had a very contrarian opinion. He expects the economy to roll over somewhat in Q1, Q2 next year, and that the Fed won't raise rates at all. They'll just stand pat. They'll do the taper. I'm just wondering, is this a possibility in one of your scenarios, and how likely do you see that?
Certainly, with all the uncertainty on the public health front with Omicron, that is a possibility if the worst case scenario materializes. But our base case is that we are going to see interest rate hikes next year. Probably 3, as the policymakers have penciled in. Growth, we expect growth to remain above trend in terms of GDP growth, certainly above potential, which is between 1.5% to 2%. We think it's going to be in the range of 3 to 4%. So in that scenario of still improving labor market, declining unemployment, and above trend growth, the Fed has some room to hike rates without derailing the expansion in the bull market.
And Angela, I want to ask you, what signal are you getting from the bond market right now? The 10-year yield isn't doing anything at the moment. And I'm wondering, how do you implement that into your forecasting for next year then?
Yes, we have seen yields remain very low, even though on a calendar year basis, we have seen a moderate rise, but still at very low levels, especially in real terms when you consider inflation. We think as economic growth continues, the expansion continues, as inflation moderates but remain at historically high levels through 2022, there is some more upside on the 10-year, probably towards the 2% range. But that, again, provides that we're going to see a clearing of the uncertainties on the healthcare front. We think that bonds will continue to provide the diversification benefits that they have had. We expect, as I mentioned, more frequent pullbacks, and bonds is a core holdings, even with an outlook for moderately rising interest rates.
I want to ask you about what kind of sectors you're looking at for the new year. And if I can draw everybody's attention to the Wi-Fi Interactive, I have our sector heat map, and it's set on a month-to-date basis. So in December, we're seeing a lot of defensiveness. We're seeing healthcare, that's XLV, up over 6%, along with staples. Utilities have been surging, real estate, but those are the defensive sectors. I'm wondering what you're expecting in the new year.
Yes, you are correct. We have seen a defensive tilt in December at the same time as the news about the new variant broke, which is a reminder that the path of the economy is still shaped by the path of the virus. For next year, we think that value investments are still likely to continue to benefit from above trend growth. But so far this year, even after the December pullback, cyclicals have outperformed defensives by quite a bit and are historically at the high end of their last 10-year range. So for next year, we do expect a more balanced performance between cyclicals and defensives. In terms of opportunities at an asset class level, even though emerging markets is a riskier asset class, it is one of the few that is on sale. So that, along with value investments, is our preference for next year.
All right, Angelo, have to leave it there, but appreciate your time. Angelo Kourkafas, Edward Jones investment strategist. And coming up after the break, we're going to do a deep dive into the retail sector and the transformative changes it has undergone, not only this year, but the last as well. Coming up.
Welcome back to Yahoo Finance. Retail in 2021 has undergone transformative change, but are the shifts we've seen here to stay? Joining us with her perspective is Christine Short, Wall Street Horizon VP of Research. Christine, thanks so much for being with us today. And I want to ask you, how have retail sales this year, compared to those of last year? And is the change in the industry a welcome one? Are they here to stay?
Absolutely. I think the changes you've seen amongst retailers in 2021 are absolutely remarkable considering what we were seeing and expecting in 2020 with the onset of the pandemic. And I think the pandemic forced some long overdue changes in an industry that is, pretty slow moving, right? So I think specifically of big box retailers, the department stores who for a long time have been touting their investment in e-commerce and omni-channel. I'm thinking Macy's and JCPenney, Kohl's. There was a lot of chatter. It was very spotty. The investments and the success of it, questionable, didn't really move the needle. But the pandemic created the urgency, mostly because consumers were shopping differently, right? So these retailers now had to offer things like buy online, pick up curbside, faster shipping, easier, checkout online, investments in warehouse technology like robotics, other things like vamped up consumer services. And for instance, one thing I thought was really creative was Signet Jewelers. They actually started doing video chats. You're not going to buy a high-priced item like jewelry without actually seeing it or talking to someone about it. So it forced retailers to get creative, and it pushed them out of this kind of zone many of them were in with talking about investment, but not really doing it.
And thinking about 2022, the year ahead, a lot of the trends we've seen this year that we've been talking about with the supply chain, labor shortages, and whatnot, and persistently high inflation, you have to think at some time we're going to catch up. And when that happens, how are retailers going to adjust? And are they thinking about it? Do they have any timetables for the coming year?
Yeah, I think the tailwinds in 2022 outweigh the headwinds. And to Karina's, prior question, are these changes that are going to persist? Are they going to continue to carry these retailers throughout 2022? And I think so. I think they've made some significant progress. There's winners and losers. I'm talking about those that were able to get through the pandemic and actually end in a better position than they were prior to the pandemic. And many of these retailers have made sustainable changes. I think you bring up some of the macro econ points, such as supply chain. We've heard a lot about that this year. I think about 2/3 of S&P 500 companies mentioned that on their earnings calls as being a great concern. It was something that impacted results in Q3 and something that they were looking at in 2022. Of course, inflation comes into play there as well. But what we saw is we were, for the most part, able to avoid a pre-Christmas crisis by extending hours at LA ports. So we were able to still, most people get packages on time. Inventory seems to be fine at many of these retailers, because you have to remember, we're learning about this for first time as consumers this summer, but most retailers, savvy and sophisticated retailers, were aware well ahead of time, and they've dealt with this before. So they know how to order inventory in a way that the stocks will be shelved in time, or the shelves will be stocked in time for the Christmas season. So I think many of them are getting through the holiday. It's about, where do we end up on the other side? After January 1st, is there a surplus of inventory? I think supply chain woes are here to stay, although if you heard FedEx CEO Fred Smith this morning from Washington, they're slowly moving along. They are working out some of those kinks. As labor shortages kind of start to end a little bit, which I think they will, because look at the savings number. Personal savings has dropped. That means those that were kind of holding out and getting a job or going back into the workforce might start to enter. So you're going to see less pressure on labor shortages, which means you can hopefully loosen up some of those supply chain bottlenecks.
And, we got that a little bit of a surprise read today. 115 came in for the consumer confidence number, higher than expected, the highest since July. And so I'm wondering, we saw less sales this year, right? Has the sort of landscape shifted as far as going into next year and beyond? Because many say Christmas came early this year. It came in October because of those supply chain issues and worries. People went out to shop earlier. So does it change the way retailers then attract customers to, shop online or come in the doors with foot traffic? And then if you are shopping more online, my question is, if you walk into a department store, you may go in for one thing, but you shop around and you see 3 or 4 different things that catch your eye, and maybe you don't buy them then, but you remember the brand. But if you're shopping online, you're so sort of focused on what you need and what you want. How then do retailers sort of advertise and try and reach those customers and make sure it's beyond just people who are loyal to that specific brand?
Yeah, great points. I'll talk about consumer confidence first. certainly a surprise considering in December we saw the lowest consumer confidence rate in 10 years. But on the flip side, retail sales were still quite high. And yes, maybe we didn't hit a record this holiday season, but it was still very high. And like you said, more spread out. I think that has to do with certainly supply chain issues and discounts being offered earlier. You know, retailers have been doing this for years, even prior to the pandemic. It was like Black Friday used to be just the weekend after Thanksgiving. Now you have sales starting as soon as, the day after Halloween. So that period's sort of been stretched out a bit. As far as, how do you get more foot traffic? And that's what many of these retailers are trying to do, create this hybrid model. That's their omni-channel plan. So the integration of online, but both brick and mortar sales. And one way they did this during the pandemic was, you can shop online, you pick up curbside, you pick up in store. Like you said, that gives, you more of an opportunity to kind of look around, see some other things. The other thing many retailers are starting to do is, maybe you want to do your entire shopping experience online, but there is the option to return in store. Kohl's added Amazon returns. So they're finding ways to draw consumers in so that they do have the opportunity to learn about other brands. Because yes, you can be very siloed and focused if you're just going to a website, but we've seen the hybrid model work pretty well for some of these department stores, for Kohl's and Macy's as a way to encourage more foot traffic.
All right. Well, we will have to leave it. There is still time to do some last minute gift buying if you haven't done it yet. Christine Scott, Wall Street Horizon VP of Research, thank you so much for your time today. We're going to take a quick break, but on the other side, a conversation with the Association of Flight Attendants to find out how airline crews are dealing with the Omicron turbulence.
Welcome back. Sarah Nelson, president of the Association of Flight Attendants, CWA, joined Yahoo Finance Live earlier to discuss holiday travel and the burdens that the Omicron variant is imposing on the travel industry. Let's take a listen.
A year ago, as we were going into the holiday season here, we weren't sure if Congress was going to get in place or if President Trump was going to sign the emergency relief that would return people to their jobs and have us be trained in our certification and be able to do our jobs. So we understand that the safety of our workspace also directly relates to our economic security as well. And as we've been on the front lines for the last 2 years dealing with all of the stresses of this pandemic, to have a new variant that is spreading like wildfire and to try to focus people back on the basic procedures to stop the spread as much as you can with a controlled environment, proper hand hygiene, making sure that you're wearing that mask all the time, getting the airlines to cool it on the increased service provisions so that we don't have more interaction on the plane than we need to have, making sure that those HEPA filters where they exist are being run all the time on the ground and in the air so that we're helping with that filtration and also the deep cleaning. But all of that layered approach has to be in place in order to have the most controlled environment we can possibly have and try to mitigate that spread.
What specifically have you seen in terms of impact on flight attendants? I mean, we've heard so many stories of those who are close to us getting infected at a rate we haven't seen during the pandemic. Are you seeing the same? And are airlines able to staff, to keep their staff in place at the busiest time with infections? And
well, it's an issue. It's an issue, Akiko. And what we saw this fall was that due to COVID concerns and also due to the disruptive passengers, even though we have more flight attendants on staff across the industry than we had pre-pandemic, if you compare it with the number of flight hours that airlines are running, people are just not willing to pick up the overtime hours at the same rate that they were before the pandemic because of these concerns, because they're getting sick, actually, and they're using that sick time, and also because they're families and they are a little reticent about spending more time in the air when we've been getting beat up. So this is a serious concern, and what we did to try to address this over the holidays was to negotiate incentive pay that provides a pretty hefty financial incentive for flight attendants to pick up time so that we can keep the operation going. But it is a real stress and strain, and it is very difficult for flight attendants on the front lines right now.
You talk about the stress and strain. We've seen plenty of those videos of unruly passengers. And I think last time we spoke, you talked about having essentially a ban list for those who have had to be kicked off of planes. We've got the FAA now saying that passengers could lose their TSA pre-check if in fact they are cited. Does that go far enough, in your opinion?
Look, I think it's a good step. And anytime that you have coordination between agencies to work on this, it is a step in the right direction. So FAA having the zero tolerance policy, having the MOU with the DOJ on getting their investigations over to DOJ for criminal prosecution, and then working with TSA on telling people that you're not going to be able to go through security quickly if you are acting out. These are steps that all lead to additional action and create a layered approach to a deterrent for people to act out on planes. So it's a good step. Does it go far enough? No. We say next up is that banned list, and we want to keep pressing the agencies to work harder together to have more mitigation factors in place to get these events down on the plane and lift the risk, the incredible risk to aviation right now with the high record-breaking number of events this past year of disruptive passengers.
How much support are you getting from the airlines on that front? I mean, I know you testified before Congress last week, maybe 2 weeks ago, along with the executives of the major airlines. Your members are the ones that are having to deal with this. We had the CEO of Southwest saying that he doesn't really feel masks are needed, and maybe he's pulled back that statement since. But those types of statements only add, I'd imagine, to the resistance that we're hearing from passengers.
Look, I was really concerned about this hearing going forward before the holidays because I expected that we would have some sort of mask debate. I did not expect it to come from the witness table, frankly, and that was a really unfortunate moment. Gary Kelly corrected the record with me right after the hearing and said he was with us on masks and understands that it has to be the layered approach. He was talking specifically about HEPA filtration, but we need that in place for safety and also for confidence from the public to actually buy airplane tickets. So he's corrected that since, but those kinds of comments and keeping in the air that there is a debate over needing to wear masks puts flight attendants in harm's way because people come to the door of the airplane thinking that there's a question there rather than understanding that they simply have to follow the rules. The rules are in place for a good reason, and everyone has to do it in order for all of us to remain safe.
And that's just one layer to keep flight attendants safe. Do you think that vaccines should be mandated for passengers who are boarding some of these flights? I mean, it feels like that the standard, the evaluation is shifting by the day.
Yeah. Traditionally, vaccine mandates have been employer-based. That's the way that they have rolled out, and they've also rolled out in our school system. So we don't really have an example of that being mandated for passengers on airlines, and we don't have a great way of tracking that and being able to implement that. Well, I think that I appreciate what everyone is saying, just like we heard from our members who said that they very much supported a vaccine mandate at work because they didn't want to be working with people who weren't vaccinated. The fact of the matter is that we have to work very hard to get everyone vaccinated around the world, because this isn't just about our country. Wherever there are low vaccination rates, this virus can continue to live and mutate and create havoc, just like it is right now with Omicron.
And welcome back to Yahoo Finance. Well, oil prices rising for a second day. That is, U.S. inventories slipped more than expected, with crude down by 4.7 million barrels. Here with how it all settled is Yahoo Finance's Inez Ferre back with us. Inez.
And Karina, West Texas Intermediate February future settling at $72.76 a barrel. Brent crude today was also up, and the Energy Information Administration, the EIA report came out today. As you mentioned, U.S. inventories are falling more than expected, the most since July. Crude stocks fell by 4.7 million barrels, and part of that has to do with end of the year tax considerations that encourages companies to store less crude barrels. But we also got numbers about gasoline inventories. Gasoline inventories increasing sharply by 5.5 million barrels. That's much higher than had been expected. That may be an indicator of some last-minute travel plans changing near the end of the year. Now, weekly U.S. crude production, that slipped by 100,000 barrels a day last week, and that's the first decrease in 5 weeks. Karina, Jared?
Okay, Ines Ferre, thank you so much for that report. And it is time now for the ETF report brought to you by Invesco QQQ. 2021 was a landmark year for inflows into ETFs. Here with a look at what some of the biggest winners and losers were is our guest, Tom Lydon, ETF Trends CEO. Tom, thanks so much for being here. So we saw record inflows this year, as I said in the introduction. What was it that brought investors into the game?
Well, the market, I think the market continued to surprise after the devastating correction we had in the first quarter of last year, rebounded handsomely. And then as we got into 21, it continued to move. And the surprising thing is, coming out of the financial crisis, it really was the FANG stocks that moved the markets and the major indicators further and faster. But this year was a little bit different. Although the S&P's up, as we speak, about 25% year to date, we've also seen the equal weight S&P, and there's an ETF RSP that represents that, which is also up about the same amount. So those FANG stocks that really were the firepower behind the major indexes, not just the S&P, but also the NASDAQ 100 and the QQQs, we've seen other participation in the market, and that's gone for growth stocks and for value stocks as well. So very, very healthy as we've seen advancement right across the board in stocks.
And Tom, I want to direct everybody's attention to the Wi-Fi Interactive, where I have the ARK Innovation Fund top ETF holdings, and this is on a year-to-date basis. I'm going to sort by performance, and you can see there's a lot of red here. NVTA, that's Invitae Corporation. The chart doesn't look very constructive here. All of this is just to say it's been a tough year for certain ETFs. I'm wondering if you could comment on that.
Yeah, absolutely. So Kathy Wood and her team at ARK are legendary. They put up triple-digit returns last year. But coming off of February, there was some selling. And maybe part of that was opening up and people feeling like COVID was behind us. Companies like Zoom, for example, that did really well last year, were down 50, 60% this year. But I'd say this. Look, they've got a great long-term outlook. They have very open architecture and communication as far as how they structure their active strategies. If there was ever a buying opportunity for future stocks, I would say it's now, because you're not going to see these types of companies that long-term really are disruptors and innovators at these prices. They may go down a little bit more, but boy, if you're looking, if you're especially a younger investor in your 30s, 40s, 50s, man, you've got some great potential here because they can continue to come out with great products in a variety of areas, not just technology, but also areas like genomics or robotics. But also they have a new ETF, which is a transparency-based ETF, which does a great job of digging down into the underlying companies and making sure not only are they fully transparent in everything that they do, but also it's a very ESG-friendly opportunity too. So I'm a big fan, even though it's had a bit of a hiccup this year.
And then, Tom, you've been tracking, some of the winners and losers in client portfolios. Go through that list for us. I know one of the big winners for you was Invesco DB Commodity Index.
Well, it was. Commodities is an area that's been a little bit unloved, but boy, coming out of the fear about inflation, the fear about rising interest rates, and also the cost of commodities all across the board, whether it's base metals or oil or agriculture. This is one of the winners for 2021 for sure. Some of the other winners were inflation-protected bonds. Bonds in general, as you can see from a loser's bracket with AGG, it's really difficult for that fixed income portion of your portfolio to make money when there's inflation and the potential for higher interest rates, as we've got this signal from the Fed going into 22. So there are a lot of investors, especially those that are older, that are searching for yield, but also searching for safety. So what's happening is those investors are going to be forced to go very, very short duration, and there are many active short duration ETFs that are out there. There's a whole lot of money that's in cash right now, and then people are moving money from the fixed income portion of the balance sheet over to the equity portion of the balance sheet in areas like dividends, where you can actually get a decent income as well. So for the first time in 30 years after declining interest rates, many investors are going to be challenged to fight a rising rate environment.
And Tom, we got less than a minute left, but I want to draw, I want to draw everybody's attention to a brand new ETF that launched today. That would be the BAD ETF, ticker BAD, good ticker, I'd say, probably a meme-ish, maybe at some point, but what's behind this?
Yeah, it is, and it definitely is meme-ish for sure, but it's betting on alcohol, it's betting on drugs, it's also betting on betting and gambling. So it's those areas of the market with this big move that we've had in ESG, these companies tend to get kicked out. But in fact, they really are good companies as well. So there's a little bit tongue-in-cheek. At the same time, as we're talking about naughty and nice, Jared, return on character ETF is all about CEOs that actually do good. So look at that ETF as well. The ticker symbol is CHAR, put out by our friends over at Alpha Architect. So here you have the holidays, a little bit of naughty and a little bit of nice.
And you are all nice and nothing bad about your insight. We will leave it there. Tom Lydon, ETF Trends CEO, thank you so much for your time today and happy holidays to you. Coming up, for all you fashionistas out there, I'm preaching to the choir. You know, the price of Chanel handbags are up 60% since the start of the pandemic. Coming up, we'll tap where you can get the look for less. Welcome back to Yahoo Finance. Well, luxury resale is having its moment in the sun as more fashion savvy look to acquire their perfect it bag without busting their wallet. And here to help us discuss the resale boom is Sarah Davis, Fashion File founder, president, and chief creative officer. Sarah, thanks so much for being with us today. So this astronomical rise in prices of luxury brands, I'm assuming that can only help your cause, right? But what are some of the other driving factors that are attracting people to come to Fashionphile?
Yeah, I think you're right. I mean, obviously, it does help us. We appreciate that they care so much about their brand and really looking at those supply, kind of keeping a really tight watch on their supply and distribution. But today, there's so much thought into really making conscious shopping choices and circularity, sustainability. And so people are really thinking about that before they make investments and make purchases, and that's helping us. And then obviously, supply chain issues in the secondary market and resale. We don't have, our inventory isn't sitting on, containers out in Long Beach Harbor. So I think that all of those kind of tailwinds together are really pushing us forward, and our growth is accelerated even faster than ever, even though we're 22 years into this business. So.
And can you break some of that growth down by, let's say, demographics? In your notes, you're talking about Gen Zers and their affection for luxury goods, how that's risen over the last couple of years. Any details you can share there?
Yeah, it's fascinating because our target market has always been our regular customer. Again, we've been doing this a long time, and so we've got to know her very well. And it's usually 24 to 34-year-old demographic, fairly diverse. But we've found that's super interesting is in the last year, our audience of 18 to 24-year-olds has increased 5 times, grew 5 times as fast. So we're very excited about the orders that they're making, and kind of, I think that what is driving that group is 2 things. Number one, like I said, circularity and sustainability has kind of like brought this to mind and given a lot of awareness to the industry. And then they're honestly looking for a deal. It's a way to get access to a category that maybe they didn't have access to not that long ago. And it's kind of fun. When people are shopping now, they're thinking about the secondary purchase when they buy from the primary market even, or if they buy from the secondary market, kind of like how we used to do with cars, where you're like, okay, I'm looking at 2 cars. This one has better resale value, so I might pay a little more for it because I can sell for more later, especially with that younger group of 18 to 24, but on up. People are thinking, you know what, I could buy this vintage Chanel flap because when I sell it in a couple of years, I'm basically going to sell it for what I bought it for. It's almost like a free bag.
Yeah, and there are certain bags that will just hold their price no matter what. Like, I'm sure a Chanel bag or something like an Hermes Birkin bag, those things never go down in value. They only seem to go up. But I want to, as you say, people are sort of buying these luxury items and they are thinking about reselling them. How does that work on your platform? Can you walk us through really quickly? If someone wants to sell an item, how does it get priced? How much do they get back as a portion of the proceeds?
Yeah, this isn't a consignment business. This is, it's a new model where you're using our app or our website, you're taking photos, maybe you have a Gucci backpack that you bought a couple of years ago and you never really wore it. It's been sitting in your closet. Take some photos, you send it to us, and we're going to say, we'll give you $1,000 for that item. If you like that offer, then we'll send you a free shipping label, and then you're going to stick that in the old Amazon box that you've got sitting out in your garage or something. Put our shipping label on it, send it to our facility here. I'm in our headquarters in Carlsbad, North County, San Diego right now. And as soon as we authenticate that item, then we're going to send you your check, or we could send you a wire. We can pay you. We're bootstrapped for 20 years, but we partnered with Neiman Marcus in 2019 as our first investor. And so we could pay you a Neiman Marcus store credit. There's lots of ways we could do that. But then we sell everything online. The world is our marketplace. And yeah.
And Sarah, something you said a minute ago reminded me of a different situation. So let me just recap. You said some of your customers might be buying luxury goods that they expect to be able to resell in a couple of years, maybe for the same price. And that's based on the high inflation that we're seeing right now. And in the 1970s, there was an analog where people would buy European sports cars. And because of the devaluing US dollar, they would be able to sell them for the same price in a number of years. So I'm just wondering, how much do you think inflation is on the minds of your customers? And is that really one of their biggest considerations?
It's actually interesting because obviously inflation plays a part, but when you've got brands that literally, these brands are raising their prices every year over year since, they made that particular style. If you look at a Chanel flap, since it was introduced, every single year, they produce basically the same style bag. They produce them in limited quantities.
and they raise the price throughout time, and they raise the price in line with inflation again. But this is something we've seen historically over time. And so you might have a bag, a Chanel jumbo flap that you bought for, under $2,000, in 2000, in the early 2000s. And then we're able, over time, as this price has gone up, now that bag is over $7,000 at retail. And so you could see how we would offer you more than you bought it for. The thing that's kind of interesting too, is that you see this behavior in the sneaker world where you buy sneakers and the prices go up. But what's great about the things that we sell in this building is that you actually can wear them. So I'm not talking about buying a Chanel flap and sitting it on your, in your closet and don't touch it. Don't crease the box, or don't, take the tags off. No, you can take that bag, keep good care of it. We always say leather's a skin. So you want to moisturize it, keep it clean or whatever, but just minor, to keep it good care of it. And that's going to continue to go up in price over time.
I protect my bags with my life, but the only problem is I can't resell any of them because my daughters take them all and then they disappear. I don't know where they go. We will have to leave it there. I know you, I know you say that you are expecting much more growth and are planning to open a 60,000 square foot authentication center as well. Thank you so much for your time today. We will leave it there. Sarah Davis, Fashion File founder, president, and chief creative officer. And after a quick break, we take a look at the real estate market, and real estate brokerages are seeing a growing interest in using crypto as a form of payment. Two experts weigh in next.
Major athletes, musicians, and now real estate agents are now getting paid in crypto, underscoring how crypto is becoming more and more part of the part of the payment system. Here with more is Yahoo Finance's Jennifer Schonberger. And Jen, I know you've been looking at this with some interesting personalities here.
Hey, Jared, that's right. A firm called Realty Capital is the first to offer real estate agents the option to get paid their commissions upfront in crypto. And a first in Yahoo Finance exclusive, I spoke with the CEO and founder of Realty, Briggs Elwell, as well as his biggest investor in the company, Ryan Serhant, CEO and founder of real estate brokerage Serhant, about why they're offering real estate agents the opportunity to be paid in crypto. Take a listen.
We're a specialty finance company, and our kind of goal principle is to be able to offer compensation to a variety of different people in the real estate world. And for us, it's really just giving another option to the customer base. Candidly, if a customer said to us they want stability and they wanted to be compensated in gold, we would figure out how can we get them gold. And so for us, this is just providing another layer of access to them.
Ryan, you've invested in this venture. Why support this? And do you see demand from real estate agents to get paid in crypto now?
Yes, a lot. Well, most real estate agents now, if they're in luxury markets like the two that Realty Capital is financing in, like New York and South Florida, are dealing with purchasers who are either buying in or through cryptocurrency. And so it's just kind of that natural progression. The same way real estate agents are dealing with people purchasing in US dollars, they get paid commissions in US dollars. If someone's going to be purchasing in cryptocurrency, it's almost kind of that natural thought process to say, oh, well, if this person who's very successful has figured this out, then maybe I should too, and I'll invest back into myself, which is what I was so drawn to Realty Capital about when we first started conversations. Most commission purchase firms are actual loan firms, right? They're like loan sharks. They give loans to agents. Realty Capital is the opposite of that. Realty Capital purchases commissions directly from agents, does not go through the brokerage, makes it incredibly seamless, very simple, and allows agents to invest back into their business when most 1099 contractors have a really, really hard time doing that. And so it all makes a lot of sense. And I think it's going to be huge for us and the agents that we work with.
Briggs, tell us about how this works and what's the upshot. I mean, Ryan kind of painted a little bit about investing back in yourself, but why not just go to a cryptocurrency exchange and exchange that commission for Bitcoin or what have you?
I think the answer to that is that a lot of our customers might not necessarily have the direct access. I think we all know, in this conversation that it's easy to potentially open up an account and start investing into it. But to Ryan's point about, potentially looking at upside on the capital that you're getting out of your commission, this is just a more seamless transition for that. We could potentially just simply hand off to them, the equivalent in a cryptocurrency at their request.
Ryan, the last time you and I talked a couple of weeks ago, you made a bold assertion. You told me that you think that 50% of real estate deals could be done in crypto in some form or fashion in the next 5 years. And this certainly seems to tie into that narrative. Crypto starting to creep into not just the real estate sector, but it seems to be emblematic of just creeping into our payment system. Your thoughts?
Cryptocurrency is no longer just an alternative asset class. It's now just another asset class. And as more and more institutions come into crypto, whether it's major banks taking Bitcoin on the books or what have you, retail investors, retail purchasers, and the everyman and woman are going to be more and more inundated with crypto in front of them, whether it's going to be using it to make purchases at the grocery store or the deli or through Amazon or putting their Netflix subscription through it. It's only a natural progression. And any fear that is out there will eventually be laid to rest once things become more commonly adopted. And it's important for us with a company like Realty Capital that deals directly with money, as we purchase commissions from agents and give them access to capital within minutes, hours, or days at the most, whereas those agents would otherwise have to wait months sometimes to get paid for their work, and they don't have salaries, and they don't have benefits, that we give them as many choices as possible.
And realty services are available in New York and South Florida with plans to expand nationally in the next 6 to 8 months. Check out the full interview online at finance.yahoo.com. Back to you.
And we thank you for that, Jen, and we're going to send it off to Emily and Adam for the next hour.
Stocks are trading higher to extend yesterday's gains with positive data on consumer confidence and an upward revision to third quarter GDP helping boost risk assets. But is this enough to get us a Santa Claus rally into the new year? We'll discuss. Plus, President Joe Biden met with his supply chain task force and private sector CEOs earlier today. According to Biden, gifts are being delivered, shelves are not empty heading into the holidays. We'll speak with Yield Street's founder and president for a deeper dive into the state of supply chains. And the Peach Bowl must go on. We'll preview the Chick-fil-A sponsored matchup taking place next week in Atlanta between Michigan State and Pittsburgh as top stars from both teams opt out of the game ahead of the 2022 NFL Draft. We've got an hour until the closing bell. I'm Emily McCormick in for Shauna Smith.
And I'm Adam Shapiro. It's good to have you here. No need to tell you, we are green across the board when it comes to the sectors, but the people keeping an eye on all of this for us include Inez Ferre, who's watching what's driving markets higher at this moment, roughly an hour before the closing bell. Inez?
And Adam, taking a look at the sectors, consumer discretionary is the one that is leading day two of this rebound that we're watching with the markets. And consumer discretionary, by the way, for the last month has been the laggard. But today it's leading along with technology stocks as well. Taking a look at the Dow, we're watching Caterpillar up more than 1.5% after an upgrade at Bernstein. On the Nasdaq 100, we've been watching Tesla near the highs of the session for this stock, up almost 7%, trading above the $1,000 level. Also checking out Google, Alphabet, that's up more than 1.5%. Microsoft is also higher, and Amazon is slightly lower after news that the FTC is pushing forward with an antitrust scrutiny about its cloud computing business. Looking also at the RX space, we're watching Pfizer shares today up more than 0.5% after its antiviral pill was approved by the FDA for emergency use, and Moderna down at session lows, down more than 6.5% after that Pfizer news. Finally, I want to mention travel sector because these stocks are seeing gains again today after yesterday's gains. I'm going to pull up a 2-day chart. You can see that the airlines, cruise liners, hotels over the last couple of days have seen gains. Adam, Emily?
Yahoo Finance's Inez Ferre, thank you so much. We're keeping on the topic of the markets with our next guest. Michael Sheldon is RDM Financial Group Chief Investment Officer. Michael, thank you so much for joining us this afternoon. Break down what you think is driving stocks higher today, and how much of this jump do you think is being spurred by the positive economic data that we got out on GDP and consumer confidence earlier this morning?
Well, good afternoon, and thanks for having me. Today's economic data was a little better than expected, for sure. For example, the Conference Board's Consumer Confidence Index got a boost today. It was actually at a 5-month high, and that's something that's been lagging in a while. Consumer confidence has been falling, probably because of rising inflation and gas prices, and today's data was positive. I think overall, the economy is on reasonably solid footing as we head into next year. The big three issues that we're watching, not surprisingly, are the course of the virus. Some of the data we've seen out of South Africa and other data we just got out of Scotland basically indicate that the virus, while spreading more easily, is less virulent, which would actually be a good thing. So it may unfortunately take a few weeks for it to sort of go through the system. The second thing we're watching is inflation, and inflation has certainly been hotter than we've seen in many years. We're watching things, for example, like the Baltic Dry Freight Index, that measures freight rates around the world, and that's starting to come off its highs a little bit. So that's one thing we're watching. Also, the number of tankers, for example, off the coast of California, that's come down. And lastly, we're also watching a Fed policy. We're starting to see a shift in Fed policy for the first time in several years as the Fed is adjusting to the threat of higher inflation. And that's going to be sort of a wild card as we go through the year.
Michael, a lot of us, it boils down to how are we going to make money next year? And something that you're drawing attention to those of us who don't spend every day having to make the kinds of decisions a CIO makes. You've pointed out that 65% of stocks are now trading above their 200-day moving average. Put into context, in a normal, if we had not had a pandemic, where we might be at this time of year and where that metric would fall, and what the fact that we're now at 65% trading above their 200-day moving average, what that sets up for next year.
Sure. So probably about 80% of what we do is based on fundamental analysis. So that's looking at things like sales and profits and Fed policy, GDP, employment, but we also keep an eye on market internals as well. We'd like to see more stocks trading above their 200-day moving average. We'd like to see more stocks in an uptrend than a downtrend. We'd like to see more sort of risk-on stocks, for example, and sectors of the market, for example, consumer discretionary outperforming consumer staples. We'd like to see copper prices going up and the transportation stocks performing well. When you take that all together, that gives us an idea of sort of the risk-on appetite for investors. So in terms of the moving average that you pointed to earlier, coming into 2021, we had about 90 to 95% of stocks trading above their 200-day moving average, and that was a pretty good setup coming into 2021. As we end the year right now, we're looking at about 65% of stocks trading above their 200-day moving average. So that's a little less positive than it was coming into the year. It's certainly not the end of the bull market necessarily, and it will be one thing we're watching to see if there's more participation in the market as we head into the new year.
Michael, speaking about the longevity of the bull market, one of the things that you pointed out in your notes was that bear markets have historically been the result of the Fed raising rates significantly. Do you think this is what is going to happen as the Fed starts to potentially raise interest rates next year? And is 2022 the time frame when investors should start potentially looking for a downturn then in the markets?
Well, there are a couple of moving parts to that. I mean, historically, when the Fed has raised rates aggressively, and they've inverted the yield curve, they've led to a recession, and equity markets typically don't perform well when there's a recession. That typically leads to a bear market. But I think it's premature to sort of go down that road just yet. We're in year 2 of the current economic expansion, and if you look back over the last, say, several decades, economic expansions typically tend to last a number of years as opposed to a number of months or quarters. So I think you want to sort of keep an eye on the Fed as we go through this year. You want to look at the yield curve, and you want to look at the growth forecast and the virus. But I think it's a little, it's certainly, in our mind at least, it's preliminary to think about the Fed driving the proverbial car into the ditch. I think if you look at the consumer right now, the consumer's in pretty healthy shape. Business spending looks to be pretty solid this year. GDP is likely to slow this year from probably about 5.5% last year to maybe 4% or so this year. And corporate profits are definitely have passed their peak, but they too are also likely to grow this year. So I think the outlook, once all is said and done, we could be setting ourselves up for a decent year in 2022. But I think investors may have to sort of anticipate more moderate returns after the returns we've seen over the past year or two.
What you just shared with us is what you're pointing out when you say that 2021 represents peak growth, but not necessarily the economy reaching its peak. And you even pointed to some metrics a few minutes back. The freighters off the coast of California, or the number of those freighters are diminishing. We're getting reads on where we might be with inflation as we head into 2022, that things might be moderating. Could we possibly be setting up for, I'm going to use the term liftoff, not interest rate liftoff, but stronger returns? We're going to have an earnings season right after we celebrate the new year.
Yeah, it's possible. I think investors have been, we've had some very positive returns over the past 2 or 3 years or so. And obviously, we'd love to see another year of double digit, even 20% plus growth this year. But I think to be realistic, given the level of valuations right now in the market, given the fact that corporate profit growth and GDP growth are likely to slow down somewhat from the growth rates we've seen coming out of the downturn in early 2020. I think more moderate returns, but still positive returns are likely for 2022. And from a portfolio perspective, I think you want to be diversified, maybe step up in growth, step up in quality a little bit. In our portfolios right now, where we tend to be overweight in technology, we think investors need to have some growth in their portfolio to reach their long-term investment objectives. We also like healthcare, which we would sort of call our GARP, or growth at a reasonable price sector. We also have exposure to some of the other sectors that may rebound once we get past the virus, assuming we do, and things start to pick up as we get into the spring.
Michael Sheldon, RDM Financial Group Chief Investment Officer, thank you so much for your time this afternoon. Pfizer became the first drug maker to receive authorization from the FDA for its COVID-19 antiviral pill. We'll discuss this and the latest on the pandemic on the other side of this break.
There are always headlines when it comes to COVID-19 and the Omicron variant, but there's some positive news today regarding Pfizer's COVID-19 treatment, a pill, which has been authorized here in the United States. Anjali Kamlani joins us with the latest on that and much more. And Anjali, is this the $4? Is this the cheap pill that we're talking about that is making news?
No, Adam, what we're talking about is a 5-day course of multiple pills that Pfizer is getting authorization for from the FDA. And that is something that the US has paid $530 per course for 10 million courses. That's the purchase agreement that came out in November. Now, Pfizer is the first one to make it to the finish line here, even though they are the company that did not get an advisory committee from the FDA to move forward on this authorization. So that is coming at around the same time. We're waiting to hear as well for another pill from Merck. But let's go over what Pfizer has in stock. They have this 5-day course, like I said, and it's a treatment that is easy to use, can be taken at home. It's multiple pills, largely meant for high-risk individuals, has been authorized for anyone 12 years and older or who weighs over 88 pounds. And it's something that really could shift the trajectory of the pandemic because it's supposed to be taken early on in the symptom phase. So, within 3 days of feeling symptoms and getting tested, someone could take this and potentially avoid hospitalization. So that's where things stand right now. Now, Merck, on the other hand, was supposed to be the other one that we heard about. Reports said that we were going to get both of these authorizations today. We have no word yet on Merck's pill. We do know that France earlier today did cancel their order for Merck's pill on the news, just looking at the results that were much weaker than Pfizer's. Like I said, that 89% for Pfizer. By comparison, Merck had to update its results to show it was 30% effective. So really a stark difference there. And we're still waiting on news on Merck right now. Back to you.
Anjali, thank you very much. We're going to keep talking about this and the way it's impacting the people we rely on for care when we get ill, the doctors, the medics, the nurses. Let's bring in Dr. Ben Weston, Milwaukee County Chief Health Policy Advisor and Associate Professor of Emergency Medicine at the Medical College of Wisconsin. Good to have you back. Let me just ask you very simply, because we know Wisconsin, it's almost 1 million cases of COVID, 300 hospitalizations additional 2 days ago. Want to find out where you stand today in your neck of the woods, but more importantly, how quickly can you get this Pfizer treatment, and do you think it'll have a quick impact on what you're seeing?
Yeah, thanks for having me back. So, in Wisconsin, our hospitalizations, without a doubt, are underwater, and our cases are rising. So right now in Wisconsin, 96% of our ICU beds are full, which means there's entire regions of the state that have 0 ICU beds. And as you mentioned, just in my county, Milwaukee County, the largest in Wisconsin, we're seeing a spike in daily cases and positivity rates, unlike anything we've seen in the last 12 months. And we know what comes shortly after spikes in cases, and that's hospitalization. So we're in a tough spot. I think as far as the Pfizer pill, this can have a major impact on COVID disease, and it comes at a critical time in the pandemic. Without a doubt, prevention through vaccine is better, always better than treatment after you're sick. But nonetheless, these medications, especially this Pfizer pill, promise to really curb the severity of disease from COVID infection, potentially decreasing that burden on hospitals. It has efficacy around 89%, but that's when used in the first 3 to 5 days of infections. This is another reason why early testing options are so important.
Dr. Weston, this is Emily here. Thank you so much for being with us. I want to ask a little bit more about the situation in Wisconsin right now, because media reports in the region are saying that Wisconsin hospitals have been having to cancel procedures and turn away patients because of the influx in COVID-19 cases. I'm wondering, how do you expect the situation to progress as we move through the holidays into the new year and through the winter months, when people are still going to be spending a lot of time indoors and that risk of transmission remains elevated?
Yes, we're in a tough spot right now. We are continuing to see an incline of cases from the previous Delta surge that we were experiencing, and now we're seeing the Omicron surge. Probably we're still sequencing, but likely most of the new cases that we're seeing are Omicron. And so we have more cases to come. And that's at a point when our hospitals are already full. So it is a tenuous situation here in Wisconsin, and we'll keep our eye out on what happens the next 2 weeks, 3 weeks. And try to do as much mitigation measures, get as many people vaccinated and boosted as we possibly can.
I want to shift gears a little bit when it comes to testing. The NFL announced a new testing protocol. It's the NFL along with the Players Association, in which they won't have testing on a regular basis. It'll be more the way I'm going to use the term haphazardly. It's not the right word, but I can't think of the right word, when they drug test. Is that the way, though, to test for COVID-19 exposure? Don't you need to have a consistent daily or weekly regimen for just about everybody?
Yeah, I think their preferred term over haphazard is strategic and targeted. But I mean, nonetheless, the NFL clearly has a problem. They had a record 47 new positive tests on Monday alone. I think that was a new high for the NFL. So, this new policy of cutting back testing for vaccinated players, it's interesting. Is it a policy that may have merit in the future? I think absolutely. But is it also a policy that, number one, relies on players being honest about their symptoms? Number two, it assumes perhaps prematurely less severe disease from Omicron. And number three, it comes at, I think, a curious time when we're seeing a national surge in disease and an overwhelming number of patients hospitalized in many communities. So I'd say it's a gamble for the NFL. Certainly, I hope it works, but it's a gamble.
And Dr. Weston, following up on this point here, the NFL, of course, is such a major institution. It's, of course, just has a ton of public-facing implications here. So do you think other leagues and perhaps other offices, perhaps workplaces, are going to follow suit? And what would this mean in terms of infection rates then going forward?
Well, I think if this was a broad policy, it certainly would mean heightened infection rates. Now, the NFL is highly vaccinated, which gives them some benefit in a policy like this. But it's interesting. We're seeing quite a bit of variation in what different leagues are doing. The NFL, the NBA, the NHL, all have kind of different approaches to what they're doing with COVID right now. I think the NFL's is certainly going in a different direction than the other ones, but we'll see what happens.
I want to get back to this Pfizer pill and testing. And this is a story about just one person I know, and I realize there are 330 million of us in the United States. This individual had a fever, had body aches, tested negative twice for COVID, fever broke, started to come back, then tested positive. Are the tests accurate? What does that tell us? Or could they have had a cold and then got COVID in between?
Yeah, it's a great question. They certainly could have had a cold and had COVID in between. But with Omicron, we're seeing more of this, where the amount of virus in your body can shift pretty quickly. Whether it's the vaccine or the protection from the vaccine kicking in and giving you some symptoms as it starts to fight the infection before your viral load has risen. We're still learning about all that. But I think for me, the take-home point is we have a severe testing problem in this country. And that problem is exposed on days like today, when many people are seeking testing in preparation for gatherings. And across the country, in my community and many communities, testing centers have lines around the block, and shelves are empty of rapid tests at drugstores, which pushes many people to already overcrowded emergency departments to seek out testing. So it's just not a sustainable solution. And even when those rapid home tests are available, when they're on the shelves, they cost around maybe $10 a test. At a minimum, which is a major barrier for millions of vulnerable Americans. So we talk a bit about vaccine equity, but I think we also need to talk more about testing equity. I think President Biden's plan to distribute free rapid testing is great, but I'm hopeful that this policy can integrate equity in considering the needs of vulnerable populations in particular, who've been hit very hard with the pandemic so far.
Yeah, if you want to get a shock, just go to Amazon.com and look at what some of the third-party vendors are charging for some of these tests, which used to cost $24. With that, it almost seems inappropriate, but I'm going to wish you a happy holiday and a healthy, happy new year to you and your entire staff. Dr. Ben Weston, Milwaukee County's Chief Health Policy Advisor. When we come back, we've got to address what happened at Amazon. They had an outage at AWS. What happened to redundancy? Dan Halley's going to join us with the latest after the break.
Amazon Web Services has been having a tough December. The cloud computing provider suffered yet another outage today, in at least its third this month alone, creating additional internet service issues for a number of major companies. For the latest, we have Yahoo Finance tech editor Dan Howley joining us now. Dan, what's been driving all of these issues with AWS, and what has the impact looked like for companies that use the platform?
Yeah, there's been a few different issues going on here, Emily. It's really not just one problem for Amazon and AWS. This was a power outage at a facility in Northern Virginia. That's what took off some platforms like Slack earlier today. They had it back up and running by about 10 a.m. Previously, there was another issue in the West Coast area. Basically, you have to look at Amazon Web Services not as kind of a single large computer that sits in the middle of the country and spits out information. It's different regions that they have these different centers set up in. And basically, that's how we get our internet. The issue here is that while Amazon's AWS has a dispersed setup, if one portion of AWS does go down, it still impacts a lot of services. So while it might not completely take something offline, it really does start to impact its ability, a site's ability to get as much traffic as possible. So a lot of people that I've been talking to have been saying, look, we had this idea of a decentralized internet where we have, different cloud providers, but we're leaning so heavily into Amazon. How come we're not talking about companies relying on multiple cloud providers? And some, believe it or not, do. That's a model that a lot of companies have gone with, and why there's interoperability between things like AWS and Microsoft Azure or Google Cloud Platform. But these kind of issues do crop up, and obviously with Amazon, they've been cropping up more frequently as of late. And so, as far as the businesses that rely rely on it. If we're talking about smaller shops, not necessarily the big massive companies that we usually talk about, they can be really hurt hard because they don't get the traffic that they rely on to drive business. And so that can be a major problem for them. The larger companies, usually they'll be able to deal with an outage for some time. But I think something like a smaller business, small, medium shops, those are the ones that get hit with these outages particularly hard.
Dan, shouldn't, or maybe redundancy doesn't play a role, but shouldn't Amazon have some kind of redundancy so that when something like what happened today happens, we don't notice it on the other end? And would this be possibly something, if there's going to be an investigation into their cloud unit? I mean, what's going on with that?
I do think that, they do have redundancies in place, right? That's how they have these different regions set up. That's why, you would have a northeastern region or a southwest region for Amazon, and why, they have different centers across the world. That's really how cloud providers are set up for redundancy, just so, like I said, one giant computer doesn't sit in the middle of the country and it goes out and the whole internet goes dark. But when there are outages at some of those, they fall back onto the other regions, and that starts to push traffic heavily through them, and that's when we start to see a lot of those types of outages. Now, Amazon, obviously, the incentive for them is to ensure that they have a lot of uptime for their services, because if they become or start to be perceived as unreliable, they're going to start to lose customers. And some of their customers are the likes of, Netflix and Hulu and things like that, Slack. You name it, it's using Amazon more than likely, if not, then Microsoft. So the idea then is that any kind of black eye like this, especially 3 outages in a row, is a big problem for Amazon and its perception among its customers. So they're going to have to work, even more, I would say, harder really to ensure that they can stay up as much as possible. And it's not for obviously in Amazon's way a lack of trying, because that's their incentive, is to stay online. They do not want to see themselves go offline and don't want to have a lack of redundancy on their own part.
And we know, of course, that AWS is a major growth area for Amazon as well. So definitely something to watch on that front. Yahoo Finance's Dan Howley, thank you so much for that update. Coming up, we've got the latest on the supply chain crunch facing the nation during this holiday season. Yieldstreet's founder and president joins us on the other side of this break.
Less than 30 minutes to the closing bell. Time for the 2 and 2, two stocks that Emily's watching, two stocks that I'm paying attention to and that perhaps you want to take a look at. Let's talk right now about Expedia Group. Now, most of us know them as, say, Orbitz or Travelocity, Hotels.com, VRBO, you get it. Shares have been up pretty well today, and right now they're up over 3%. A lot of this has to do with, despite Omicron spreading throughout the United States and the world, people are traveling. If you look at the TSA throughput numbers at airports, the number of people who went through TSA checkpoints yesterday was essentially the exact same as went through airport security in 2019. We have been fluctuating about 400,000 below 2019 levels, but that's business travelers. So domestic travel is strong and holding up, and it's that travel demand that a lot of people think is the reason Expedia is going to benefit. You had Argus last month say that they expect leisure travel to continue to recover in the fourth quarter of 2021, and they expect substantially stronger growth in 2022. Argus gave Expedia a buy rating last month, and they're holding on that. Take a look at Boeing. So Boeing, it's a bit of a different picture. They've put the 737 MAX program back in the air. You've got the 787, still a bit delayed, but shares are up about 1% today. The news yesterday that UPS is buying 767 freighters, 19 of them. They'll take delivery starting in 2023. Boeing still has a way to go, though. Year to date, the stock is down about 6%. It peaked in 2019 before the 737 MAX problems. It peaked at around $440 a share. Emily?
Adam, I'm watching shares of Tesla. Now, those are climbing after CEO Elon Musk said he's done selling stock, at least for now. And in a recent media interview, Musk said that he had sold enough stock to achieve his plan of unloading 10% of his stake in Tesla. Now, over more than the past month now, Musk has been exercising options and selling shares of Tesla. And the total number of shares he's sold since he tweeted in November asking his followers if he should sell some of his stake stood at nearly 14 million. Now, Musk had also tweeted earlier Sunday night that he will pay more than $11 billion in taxes this year. But Musk saying that he is done with unwinding some of his stake in the electric vehicle maker does remove an overhang on the stock, at least for now. And as we can see, those shares are up nearly 7% this afternoon and up by about 41% so far for the year to date. Then there are shares of BlackBerry. Now, this stock has been fluctuating between gains and losses today. As we can see, currently it is up in the intraday session after the company posted mixed results and guidance yesterday evening. Now, BlackBerry reported revenue of $184 million, better than consensus estimates for $177 million, and adjusted losses per share of 5 cents were also slightly narrower than the losses of 7 cents a share anticipated. Now, in terms of fiscal fourth quarter guidance, this did disappoint compared to some Wall Street analyst estimates. BlackBerry executives also said during their earnings call last night that they expect fourth quarter revenue to be in a range of $125 to $135 million. And specifically, the Wall Street firm RBC Capital Markets said in a note that while BlackBerry's third quarter earnings were a modest beat, or third quarter results, I should say, key software KPIs remained weak and fourth quarter guidance was lower than what the firm expected. But at least for now, BlackBerry shares are currently trading higher by about 1.4%. They have risen about 40% so far this year. Adam.
All right. Whether you are an accredited investor or just starting out as a retail investor at the beginning of your earning potential, it's all about creating wealth. But you have to ask the question, especially at this moment in time, how are the supply chain issues and the current inflation picture impacting the decisions you make, whether you're a millionaire or whether you're building your wealth for the first time? Let's get this discussion underway with Michael Weiss. He is the founder and president of Yield Street, and he's joining us once again here on the Yahoo Finance platform. Good to have you here. And when you take a look at the big picture, because you deal with the accredited wealthy investors as well as those just starting out through your Prism fund, what is the question we should be asking as investors about the intersection of inflation and supply chain issues on where we then deploy our capital?
Adam, thanks for having me. That's a great question, and I think is top of mind for all of us today. And essentially, where that drives us is a simple question is, how do I think about asset allocation? How do I think about where I should be investing? What impact does the supply chain challenges have on my portfolio? What impact does it have on my purchasing power when we think about inflation? How long is it going to stick around for? I try to take that all together and understand what investment decisions I could be making and how to protect myself or how to take advantage from the situation. I think that's what people are asking.
Michael, this is Emily here. Thank you so much for joining us. Speaking of supply chain issues, which we've been watching for months now, in terms of some of the latest developments, looking at a company-specific basis, we did have Nike just earlier this week reporting better than expected quarterly earnings and sales results, suggesting that it is effectively navigating some of these supply chain challenges. So are companies like Nike the exception or the rule here? And in other words, are things actually getting better as we move through this holiday season now at this point?
I don't think they are necessarily. I actually feel that there are a number of data points that we're seeing. I'll give you one as an example. We're very close to the shipping markets. We have a shipping business, and we continue to see some of the largest cargo carriers signing multi-year charter agreements at rates that are higher than we've ever thought they would be or could be today. And I think that's showing us that supply chain issues are here to stay for a little while. I think the example of Nike is highlighting something else, which is also really interesting, which is really demand. Consumer demand is through the roof, in part because of QE and stimulus that has come into the market. There is more dollars in people's pockets, and they are spending that money. And so I think the question is, where is the intersection between consumer demand and supply chain? And how do we make sense of that? When you look at things like cars, when you look at things like microchips, we are not seeing those timeframes get better. In fact, today just happens to be, a serendipitous day for this conversation. I sold a car today for the first time, and I sold it for 1/3 higher than I was offered 1 year ago. That's a personal car. That was me today. I got 10,000 miles more than I expected. So no, I don't think the supply chain issues are easing, but I do think that demand is super strong. And in cases like Nike, we're seeing that.
My granddad was a junkyard guy and had used car dealerships in Portland, Maine. I'll talk to you about selling used cars at a profit another time. But want to play a soundbite from President Biden because it gets to something you just pointed out. And on the other side of this, I want to get your thoughts on it.
Top of mind for me is what is top of mind for so many families, the pinch of prices and the cost. Look, addressing these costs has been and will continue to be my top priority the entire administration. And the way to do this is not to slow down our economic turnaround, not to step back from all this progress, but to build on it. We can and we will address prices by expanding productivity capacity in our economy so we move more goods to market, get more Americans working, encouraging more investments in innovation, and making sure American consumers see those benefits at the store and at the pump.
Michael, you just pointed out getting those goods to market, if they're signing long-term deals with the shipping companies, I mean, it used to cost you $2,000 a container. It got as high as $20,000 a container. If we're still going to be paying more than $2,000 a container going forward, the president might be missing something, or are we missing something?
No, I think the president is missing something. I think he's also giving us some mixed messages in the economy. Some of the issues that you're seeing, not to bring Omicron into the discussion, but if we're going to create more mandates, if we're going to keep people from being back in the workforce again, that's clearly not going to go well with what he's just said in that last clip that you've made. And so I think that there are conflicting messages that we're hearing out of Washington and at our local municipalities that are making it difficult to reconcile and understand how we are going to bring costs down for consumers. I think at the end of the day, inflation is the real thief here, and that's what we need to look out for. So being properly invested and understanding where the opportunities may present themselves from the current dynamics in the supply chain and also how to navigate that are going to be critical for the next 12 months.
Michael, we're still seeing the labor force participation rate depressed compared to pre-pandemic levels. Job openings are near record highs. When do you expect the labor supply shortage portion of the supply side constraints to start to ease?
I think if we don't see more support coming from the government, that over the next quarter, we're going to start to see a lot less labor shortages.
If we see fewer labor shortages and the Fed should get its interest rate liftoff wrong, what would you just predict very quickly? Are we headed for inflation? Because a lot of investors make their decisions based on that number, just the inflation number.
I think what the government did, actually what the Fed did with regards to the rate hike was smart because it was modest. It seemed like they were tempering their reaction. A lot of people sort of were jumping on whether they felt that it was a misstep in monetary policy that would have a wider effect. I think, in fact, they made the decision intentionally to ease into a rate hike so as not to create a shock to the system.
We appreciate your being here. Michael Weiss is Yield Street's founder and president, and you should know that they've deployed more than $2.5 billion in capital since 2015. You can check them out at yieldstreet.com. We'll be right back with the latest on crypto when Jody Gunsberg, CoinDesk Indices Managing Director, joins us.
Welcome back. Let's get a check of the cryptocurrency markets now. Bitcoin prices are trading slightly higher this afternoon, currently up just over 1% to just below 49,000. Now for more, we're welcoming in Jody Gunsberg, CoinDesk Indices Managing Director. Jody, it's great having you back on. And cryptocurrency prices have had yet another roller coaster year in 2021. For those investors who have perhaps watched this price action from the sidelines, how would you suggest they break into the space and manage the risks and volatility that have become inherent in the crypto space to date?
Yeah, the volatility has been probably the most challenging things that investors have faced with investing in Bitcoin and crypto in general. So, a lot of these risks are market risk, the technology risk, the geopolitical risk, and they're not unique to crypto. I think they're just magnified since the asset class is emerging. And the major theme going into 2022 will be to manage that volatility. So the three main ways we see that are, one is first by diversifying into broad baskets, so beyond Bitcoin and into other large caps in the space. Second would be across sectors. And we've defined sectors, industry groups, and industries through a recent digital asset classification standard to help investors invest by industry groups that are appropriate. And then another way really will be their ability to pick the managed volatility versions of single coins if they want to do that. So for example, like buy Bitcoin with a target volatility of 15%, which could be really attractive to people that would accept risks similar to equities, but like the diversification.
Jody, I want to bring up something with you that we hear from some respected people repeatedly, that Bitcoin is worse. This was an article in the FT today. That Bitcoin is worse than a Madoff-style Ponzi scheme. And for the record, I sound like the grandpa who starts to forget things. I interviewed Madoff in jail years ago. Here's what, and help us understand, because crypto can be complex, but at the end of the day, this article fails to address the efficiencies in payment processing that blockchain and cryptocurrencies offer. And they don't address that. And is that what the crowd that says Bitcoin is a Ponzi scheme totally misses?
I don't see the similarity between Madoff and Bitcoin, but what I do see is a similar pattern in how investors are behaving. And what I see is that many investors that were caught in Madoff failed to do their homework. So they missed the red flags by following their trusted crowd of wealthy friends and advisors. And what I see in Bitcoin is the same lack of due diligence, where many Bitcoin investors are just failing to understand the fundamental concepts of the cryptography mixed with the blockchain that is, the underlying technology requiring the multiple computers to verify all the transactions on this network to effectively decentralize the ledger. So, the due diligence piece is the similarity I see. And given this lack of knowledge is why precisely we launched our CoinDesk Indices digital asset classification standard, so that investors can understand the industries of digital assets so they can properly utilize them to meet their financial goals.
But isn't the value of a Bitcoin or of a DeFi currency or digital asset the incredible speed and efficiency? You get real-time payment transfer. Whereas in the current system, it can be a 3-day lag, 7-day lag, depending on how you're processing.
Time, cost, transparency, the decentralization are all values that the Bitcoin software is bringing to the world. And again, it's the technology that underlies that software, the combination of cryptography and blockchain that can be applied across so many different industries is where the value lies. So will Bitcoin be the ultimate winner if we look back 10 or 20 years from now? I don't know. You could have asked that same question about AOL versus Apple in the 90s, right? So I think that's why investors are trying to manage their risk by diversifying across many of the cryptos that use this technology rather than trying to pick the single winner itself.
Jody, one of the things you point out in your note is that digital assets like Bitcoin, of course, are priced in USD, so generally move inversely with it. Are investors still using Bitcoin and cryptocurrencies as an inflation hedge in your view? And should they be continuing as we think about the macro landscape in 2022 and beyond?
They are. And for a very small investment, you can get a very big relative inflation hedge, nearly 5 times what you can get with commodities, because the relationship is so solidly inverse between Bitcoin and the US dollar. So not only will the Bitcoin hedge in the US, but it's also helping investors globally, especially in places in South America that have really high inflation. So yes, we are seeing that. We're also seeing it within this rising interest rate. With moderately rising rates, it's obviously not good for growth stocks or bonds. And it happens to be a really favorable environment for Bitcoin. It does well with moderately rising rates.
All right, we'll leave it there for now. Jody Gunsberg, CoinDesk Indices Managing Director, thank you so much for your time. Coming up, we've got the closing bell, or the countdown to the closing bell. Stick with us here on Yahoo Finance Live.
All right, 7 minutes to the closing bell. I don't want to call it a melt up, but we're going in the right direction. Let's check in with Jared Blickery to find out where we might settle. Jared?
That's right. And let's take a look at the Wi-Fi Interactive, where we can see the NASDAQ is the leader. It's up about 1%, followed shortly, close on its heels, by the S&P 500 and then the Dow. And let's take a look inside the NASDAQ 100. We're going to see a lot of green here. And look at that. Tesla up 7% now, should be well above $1,006.70. And I want to change this to a 2-day view so we can really see the gains that have tacked on over the trailing 2 days. You can see Apple and Alphabet each up more than 3%, very close, within 3 or 4% of their record highs. The S&P 500 about 1 or 2 percentage points away from its record high. In fact, only 1 percentage point. This is going to be the sector action also over the last 2 days. And looking at consumer discretionary, that is the leading sector that houses Amazon and others, followed by tech and energy. Those are the 3 outperformers over the last 2 days. And here's a look at what has been going on today. There's consumer discretionary still in the forefront, but healthcare is the number 2, tech and real estate rounding out the top performers. Looking at the travel space, we can see nice gains here. And I'll put this back to a 2-day view, and we can see American Airlines, that's up nearly 6%. Hilton Hotels, that's up nearly 10%. Royal Caribbean up 9%, and the list goes on. Also want to check out the ARC Innovation Funds, because those have been kind of bellwethers. A lot of these names, some of them work from home, are down a little bit. You can see Zoom is off 2% over the trailing 2 days. So is Teladoc and Roku. Arguably, those work from home trades kind of bucking the trend here. But Tesla up 12%, Shopify up 8%, and DraftKings up 6%. Kind of makes you think we might just have the inklings of a Santa Claus rally, which begins next week. But we got a couple sessions left before we can make that claim. Adam?
All right, and we've got to get through the rest of the trading session, which has roughly 5 minutes to go. We're going to take a break, and when we come back, the closing bell. 2 minutes to the closing bell, and helping us explain what we've witnessed today in the trading session, we're going to bring into the stream Bill Northey, U.S. Bank Wealth Management Senior Investment Director. Also, Jordan Kahn, ACM Funds Chief Investment Officer, is here with us as well. And real quick, before I throw my first question to you, I'm going to go to Jordan first. Let's take a look at the markets, because someone's in a buying mood. The S&P 500 today was up about 0.5%, and then in the last 10 minutes, it went up to, it's up about 1%. So again, someone's buying. Jordan, I want to start with you because you point out the technicals. We had a guest in the last hour who said, beware the 200-day moving average. We're seeing only 65% of stocks moving above that 200-day moving average, and that was cause for concern. Does that concern you?
Yeah, I think that's a little bit of a concern. What that person was alluding to is that breadth has been kind of narrow in the market. When we look at some of the more traditional technicals, what we're seeing today is both the S&P and the NASDAQ were retaking their 50-day EMAs, which I think is a positive. And to your point about some people rushing in towards the end to buy, we've seen sentiment very bearish recently, so it wouldn't surprise me to see some short covering ahead of what could be a potential Santa Claus rally developing.
All right, so if we have a Santa Claus rally developing, we're going to get back to the panel in a second, but let's see where the action is right now as we set up for the closing bell. You've got the markets trending higher. You got the Dow up 0.75%, roughly 265 points. The S&P 500 is gaining. It's up 48 points. NASDAQ is up a little over 1%, 184 points. But when you take a look at the sector action today, consumer discretionary up almost 1.5%, followed by healthcare up almost 1.25%. No laggards when you look at the sectors. So it looks as if people, as we said, going into this segment, in a buying mood. But let's hear where we settle for the day, because here is a hot plate of closing bell.
And that's the closing bell this Wednesday, December 22nd, as we take a look at where the major stock indexes are about to settle here on this trading day. We have the Dow up more than 250 points, or about 0.7%. The S&P 500 also higher by about 1%. The NASDAQ composite up about 1.2% as we close out this trading day. Diving a little deeper here into the Dow Jones Industrial Average, we have Caterpillar and United Health Group outperforming in that index, followed by some of the tech leaders, Microsoft, as well as Apple. But turning back to our panel, Bill, I want to turn this next question over to you, because you note that as we look ahead, known risks remain on the horizon with a potential range of economic outcomes larger than typical. We just got an upwardly revised third quarter GDP print out earlier today, with that rising at a 2.3% annualized clip. What's your base case for next year, and what level of monetary and fiscal policy support are you factoring into that outlook?
Yeah, thank you, and great to be with you again on a late December afternoon. So as we look at the contemporary data that's been coming in around economic growth, clearly influenced by the easy comparisons that we've had coming out of the post-pandemic era. And as we transition into 2022, those comparisons get even that much more difficult. So we'll continue to be expanding from a global economy, from a U.S. economy standpoint, as we turn the page into 2022. But that rate of change will indeed begin to slow down. There will be a deceleration. And of course, that's occurring at the same time that the policy impulse, both from a monetary policy standpoint, as well as from a fiscal policy standpoint, begin to wane as we move into 2022. We're well aware that the Federal Reserve has begun their tapering process with their quantitative easing program, and has in fact accelerated that wind down program to set the stage for raising rates early in 2022. But at the same time, we're seeing the fiscal machinations in Washington begin to put a pause on the Build Back Better program. So there's question marks around how much fiscal impulse will be in place for 2022 as well.
Bill, I want to follow up on that, because given those question marks, I don't know who the quote's attributable to, but nobody ever got poor taking their profits early. So Bill, would now be the time? I mean, we've just recovered some of the losses that we've experienced over the last 2 weeks. Would now be the time to maybe park some cash?
Well, it depends on one's time horizon. And at U.S. Bank Wealth Management, we maybe have a little bit longer time horizon for our clients than the next week or 2 weeks. But as we think about what sits in front of us for 2022, we do remain favorably disposed to equities relative to fixed income. We believe it's going to be a challenging environment for fixed income investors over the course of the next 12 months, as base rates are very low at this point in time, and it is expected that the trajectory of rates will move higher. So from a total return perspective for a bondholder, very difficult environment. On the flip side of that, we do continue to expect that corporate earnings growth will be the fuel behind the equity markets in 2022, albeit with somewhat elevated levels of valuation applied to those earnings as we move into the year, and in the face of rising inflation and rising interest rates, which historically have been a support for higher valuations. That trend may be reversing at this point.
Jordan, we've been hearing about a lot of strategists talking about taking a barbell approach when it comes to positioning for next year. We've had that rotation beneath the surface fluctuating between cyclicals and tech and growth stocks for quite some time now. How do you think investors should be balancing these going forward next year?
Yeah, I mean, I think it's always helpful to stay balanced. That rotation between value and growth has been difficult to predict for everybody. So I think that it still makes sense. Values should continue to do well. That's where you find a lot of the lower valuation stocks that could play catch up to the market. But there are still a lot of tried and true growth names that I think could continue to do well, kind of the Apples and the Googles of the world. There are pockets within the growth cohort, such as the cloud stocks and some of the cybersecurity stocks, where I think valuations are a bit stretched, and those might be areas to shy away from as valuations come in. But for the most part, I think the balanced approach should continue to work.
Bill, want to wrap this up with you because we are looking at 2022 and we go back and forth on what kind of earnings we can expect from companies. Are we setting up potentially for a surprise to the upside? Again, I want to go back to what the president said with the supply chain issues seem to be easing. It looks as if we saw the consumer reading earlier that inflation expectations are coming back down. Is this setting us up that we could have even bigger gains than some of the people like you are saying, hey, be cautious?
Well, Adam, it's a great point. And as we've come through 2021, we learned that estimates as you start the year aren't often where you conclude the year. We saw a tremendous growth in earnings estimates through the course of 2021. 8% earnings growth for 2022 right now is the consensus, but there is an opportunity that we could see an upside surprise here if supply chain disruptions begin to abate during the course of the year. But there's also a downside risk that if the Federal Reserve happens to make a policy mistake, tightening too much as we move into what is going to be a natural deceleration, there could be some downside risks as well. So it's important to stay close to your long-term strategic targets, but we think the right approach is leaning a bit more toward the equities as we move into the new calendar year.
And it is because the Federal Reserve can sometimes make mistakes that we appreciate insight from both of you. Bill Northey, U.S. Bank Wealth Management Senior Investment Director, as well as Jordan Kahn, ACM Funds Chief Investment Officer. Have a happy holiday and a healthy, happy new year. We've still got the day to finish out here. Jared Blickery, what's your final thought on all this?
Well, I'm looking at Tesla. We were looking at some of the components of the ARK Innovation Fund. It's a leader on the NASDAQ 100 today. This is a 3-month chart, and we just broke to the upside, this negative trend line here. But more importantly, this is a level that we just hit only yesterday and rejected to the downside. That is pretty favorable. Here's a year-to-date look. And in fact, this is the same level when Tesla had been climbing towards its record high in January and February, and then it dropped off. Well, that is the same level that we just bounced off. So a pretty important technical consideration here. Here's that 3-month look again. And this drop was over 20%. But if all goes well, I think we could say it's probably in the rearview mirror, at least for a while. Adam?
All right, we're going to take a quick break, but are you ready for some football, as they used to say on ABC? When we come back, we've got the Chick-fil-A Peach Bowl CEO and president coming up.
Welcome back. Bowl season is ramping up. Next week, Michigan State faces Pittsburgh at the Peach Bowl in Atlanta. Here to discuss this and more is Gary Stokan, Chick-fil-A Peach Bowl CEO and president, along with Yahoo Finance's own Josh Schaefer, stopping by for this discussion as well. Gary, thank you so much for joining us this afternoon. I first want to get your take on some of the latest developments impacting the sports world right now. Now, of course, there's been a COVID-19 outbreak across professional sports leagues over the past couple of weeks. The Peach Bowl is scheduled for next week. How is this year's matchup going to be different, if at all, against this backdrop of the ongoing pandemic?
Well, we've seen all sides of COVID. We were scheduled to play 3 Chick-fil-A kickoff games last year in a week and had all 3 canceled because of COVID. We were able to have 25% capacity last year in our Chick-fil-A Peach Bowl with Georgia and Cincinnati, number 8 and number 9. And this year, we were able to do our 2 Chick-fil-A kickoff games with 100% capacity, the bands, the cheerleaders, and we're looking forward to doing the same this year with Pitt and Michigan State in our Chick-fil-A Peach Bowl.
Gary, we've seen today that a couple of teams have kind of already started to contract COVID-19. It seems like we're a little bit back in the 2020 era of college football, where you're constantly checking to see which teams have been infected and how teams are testing. How does this work from a bowl perspective? If Pittsburgh or Michigan State were to have too many COVID-19 cases, could you postpone the game at all? Could you move it back a couple days? Or are you just stuck with looking for a different opponent?
No, that's a great point. We've already, matter of fact, we were talking today with the CFP and all the New Year's Six bowl games, and we were comparing notes as we oftentimes do. And we have scheduled, if for whatever reason a team can't participate on December 30th, that we will move the game back a week and find a date that's comfortable for everybody. And obviously in Mercedes-Benz Stadium. And we have agreement with the stadium, with ESPN and the 2 teams to do that should it be necessary.
And you mentioned the college football playoff, and I wanted to ask your opinion on that as well, Gary. Just with potential expansion coming, what have you sort of heard there? How would the Chick-fil-A Peach Bowl play into that? And what are your expectations of potential expansion?
Yeah, another great question. Obviously, the commissioners and Jack Swarbrick of Notre Dame, the AD, they're going to meet in January. They're going through the process of staying at 4 or moving to 8 or possibly 12. We've read a lot about and seen a lot about the 12-team format. I think they're trying to work through, automatic qualifiers, the number of games, and TV partners. Right now, there's a contract that exists through 2025 with ESPN exclusively. If they decide to expand within that time frame, then it has to stay on ESPN. If they do it outside of that, then there's the potential of bringing in another TV partner, which I think has some interest because they would be able to promote the season all year long, along with ESPN, and then also be a part of the playoff broadcast and bring more revenue as well.
Gary, what kind of impact do you think that the new name, image, likeness rules might have, if any, on bowl games and future bowl games?
Yeah, another great question. Some people have asked me, well, why didn't Chick-fil-A step up and, offer $50,000 to, Kenny Pickett and Kenneth Walker, 2 All-Americans that have opted out of our Chick-fil-A Peach Bowl. And, we fully understand the decisions that the kids have to make nowadays with the amount of money available to them in the NFL draft. So they have to sit down with their agent, their coach, their parents, and make those kind of decisions. Those type of decisions, you're talking about millions of dollars. So I don't know that there's any NIL money that would made any kind of difference with respect to the draft's status of the 2 individuals that we're talking about. So I think NIL is something that we have to watch. We certainly need Congress and legislation nationally to have a consistent across all the states, some NIL legislation. And until we get that, it's just going to be like the Wild Wild West, which isn't good for college football, certainly.
Gary, how have you seen those opt-outs? I know last year Georgia had a fair amount in the game as well. Is it impacting your business at all yet, or has it not trickled down to that yet, where you think that there's maybe less people either coming to the game, watching the game, general interest? Have opt-outs become something that's really impacting your bottom line yet?
You know, we're very blessed. College football is the second most favored sport in this country. It's only second to the NFL. And I still think it's a sleeping giant. It has a lot more growth opportunity. To give you an example, last year, number 8 Cincinnati, number 9 Georgia in our Chick-fil-A Peach Bowl, we did 8.8 million viewers, which was more viewers than the first 3 games of the NBA Finals. So college football, especially during that time of the year, it's ESPN's most lucrative time of the year, where they make more money during the 2 weeks of bowl season than any other time of the year. And they broadcast a lot of sports. And it's because people are home, they're watching bowl games, and there's a lot of people that want to advertise in that space in college sports and college football in particular. So college football has a lot of opportunities still moving forward. And I think we'll see it grow with the expansion of the potential of the playoff.
Gary, really quickly here, when you look ahead to the impact of COVID on college football and bowl games overall, do you think there are any changes that have happened over the past couple of years now that are going to stick and potentially change the game going forward?
Well, I think at the end of the day, COVID is going to be around. It's something like influenza. You know, we're just going to have to live with it. And we're probably going to need to get flu shots for the COVID flu virus. And, you know, we'll build up antibodies, we'll build up immunities just like we did with influenza. And I think it's going to be a part of our life moving forward. So I think we have to deal with it, be prepared for it. And obviously, you know, in our case, you don't want anybody to get it, but it's a natural phenomenon that people are going to get it, and we just have to be prepared for that.
All right, we'll leave it there for now. Gary Stokan, Chick-fil-A Peach Bowl CEO and President, and Yahoo Finance's Josh Schaefer, thank you both so much for stopping by. Coming up, we'll have an end of the year restaurant overview and trends to watch in 2022. That's on the other side of this break.
Who doesn't like food? Favorite subject, right? Let's talk about the end of the year with the restaurant overview and how restaurants are making out as we head into 2022. And we're going to do that with Crystal Mobiani, the Bento Box founder and CEO, and our own food lover, Alexandra Canal. In fact, I'm going to let you serve up the first plate and first question, Allie.
Thanks, Adam. And hi, Crystal. Thank you so much for joining us. So I want to first touch on the Omicron variant. We know that restaurants have had to deal with COVID so much this past year. Do you think moving forward with Omicron that restaurants are now at their breaking point, or are there some lessons learned from the past year and a half of the pandemic?
Yeah, it's a great question and very timely. I mean, for restaurants, obviously, their number one priority is the safety of diners and their staff. And we're reading about tons of restaurants closing down, and the ones that stay open, I think they've learned a lot of lessons and are considering how to keep their operations open in the wake of what's going on. And off-premise is so crucial to that. And many restaurants survived by shifting their operations. They were able to pivot quickly to off-premise options and inform their diners through digital channels. And our data is showing that that's picking up again. You know, we've seen a 10% increase in order size week over week. And in the most impacted states like New York and Illinois, we're seeing like 10 to 15% increase in order volume. So, you know, and I think restaurants are getting creative. I know one that had to close last week because someone was exposed, and they took their ingredients so they didn't go to waste and they could make some additional revenue, and they created Christmas meal kits. So we're seeing a lot of creativity like we saw last year. And, you know, restaurants are mobilizing, they're creating support and strategy groups, meeting over Zoom, programs to get workers boosted, and advocating for restaurant relief, which is really important, and getting a bill passed to replenish the restaurant revitalization fund. So yeah, we're seeing them using a lot of the tricks that they learned last year to stay afloat.
Crystal, this is Emily here. Going through some of Bento Box's data, one of the things that stood out for me was a 100% increase in the number of ghost kitchens on Bento Box. I'm wondering, as we think about this rising trend here in using these ghost kitchens, these restaurant fulfillment centers that aren't necessarily meant for in-person dining, what do you think the future looks like for this industry specifically and the opportunity here?
Yeah, I mean, I think this became a lot more prevalent in conjunction with the rising operating costs that restaurants had to, you know, be forced to find new efficiencies, create these ghost kitchens where there was a lot less overhead and they could meet the demand for ordering. And so I do think this is something that is here to stay. And I do think that it has proven to be more successful when it's established brands that already have a following, already have people that maybe have dined there before, ordered there before, opening these ghost kitchens to be able to meet the demand during these like very difficult times with rising costs and supply chain issues.
What about when you want to take the family out or you want to go out with your friends and make a reservation? What do you expect to happen in 2022? Because we've all had the experience where you go through the third-party app and then you get inundated for months later with, what about this restaurant, or try that?
Yeah, well, I do think that there is change happening in consumer behavior where diners are starting to go direct, and they understand the value of that, and they want to have a relationship with the restaurant versus with the app itself. And so I think we've seen that with online ordering, and I think we're starting to see this with reservations too, where diners are starting to go directly to the restaurant's channels and contact the restaurant directly. And I do think that this direct relationship is becoming a much more permanent fixture because it's something that consumers are wanting.
And labor shortages, that's been a big theme this year. Restaurants have had to tackle that and figure out new ways to attract and really keep talent and new staff and workers. When you talk to your clients, what's working in that regard? And do you think the industry can sustain itself if labor participation in the sector never again reaches those pre-pandemic levels?
Yeah, I mean, the jobs report, I think the number of industry jobs for the restaurant industry has plateaued at about 1 million less than pre-pandemic levels, and it's stayed at that consistent level. So it's definitely a problem that is here to stay. And one thing, the very obvious thing is what I've heard that has worked is they've had to pay more. And I think labor costs have gone up for restaurants like 85% in 2021. But I do think that some restaurants are also adopting some technologies, automation technologies to solve staffing issues, so that, allowing technology to handle more tasks so that they can operate with fewer, happier, and higher paid employees. And those employees can focus on actually, serving their customers, delivering great hospitality. And so, it leads to less errors, less keying in, less having to do tedious tasks. And I do think that that's going to be a trend that we're going to see moving forward in 2022.
Crystal, going back to one of the things that you mentioned earlier, restaurants taking ownership of their online guest relationships, you would think that that would be potentially negative here for some of these third-party apps like DoorDash or an Uber Eats or the like. But is this kind of customer relationship building feasible for all types of restaurants? Because if you aren't a nationally or even locally recognized chain, how do you potentially get that exposure in the first place to your customer base, especially if they're staying in place and not going out in person?
Yeah, I think that's a great question. I do think that restaurants are being really creative in leveraging things that are low cost, like social media and promotional email campaigns, and being able to use digital tools in an automated way, because restaurant owners did not open restaurants to become, digital marketers or, best in class marketers. But, if we are helping restaurants get tools to be able to automate email campaigns and build relationships with their guests through social media. And so I think those are the tools that restaurants can leverage. And I do think that it's not just for national brands. Everyone wants to support their local community, and everyone wants to feel like a regular. Everyone wants to, go somewhere where their face is recognized. And so I do think that when you think about communities,
right.
Restaurants are starting to, embrace that more.
Everybody wants to go where they know your name, I think was the line from Cheers. We wish you all the best in the coming year. Crystal Moviani, Bento Box founder and CEO. Ali Canal, see you in a few minutes at the post-show meeting. Always good to see you. Real quick, before we say goodbye, check markets where we ended today. We were up across the board. The Dow up 0.75%, S&P 500 up 1%, and the Nasdaq was up 1%. In 2021, we saw crypto move from the fringe to the mainstream as institutional investors poured their dollars into Bitcoin, blockchain, even NFTs. What do crypto bulls, what do crypto bears expect in the year ahead? Stay tuned to Yahoo Finance's special presentation, The Future of Crypto, right after the commercial break.
Welcome into this Yahoo Finance special, The Future of Crypto. I'm Zach Guzman. Happy afternoon, everybody. From meme coins to the metaverse and everything in between, we're going to be discussing that and the way that crypto culture has dominated the conversation no matter who you're talking to in 2021. Over the next half hour, we're going to explore the massive changes that took place during the last 12 months, what brought a record level of institutional adoption to the space, and what to look ahead to in the year to come. And to kick things off, we want to start with the granddaddy of them all, Bitcoin setting a record high back in the spring, falling all the way back to break even on the year and climbing all the way back just last month to a new all-time high. But just talking about price doesn't even begin to scratch the surface on what we saw this year. And for more on everything going on under the hood, happy to welcome in our first guest. You know him well. Joining me now is entrepreneur and investor Anthony Pompliano. And Pomp, good to be chatting with you again here, man. I mean, just looking back on the year, it's wild as we get ready for 2022. I'm not sure if anything stands out to you as kind of the biggest Bitcoin and crypto story here. You got the Coinbase IPO, you got El Salvador's moves, you got regulators stepping up their game. I mean, what stood out to you as maybe the big moment for you this year?
Bitcoiners are right. I think that's the simple takeaway is you can cut it a bunch of different ways. The halving wasn't priced in. Bitcoin has served as an excellent, probably the best inflation hedge asset. You have a MicroSaylor and MicroStrategy and the Bitcoin on balance sheet kind of bet playing out almost to perfection. You have the Bitcoin backed bonds being the best performing bonds. That continues to work. And you have a nation state, not only making it legal tender, but also going ahead and purchasing Bitcoin multiple times and kind of tweeting about it as they're doing it. And I think ultimately what people are waking up to is that Bitcoin's good for business. And also Bitcoiners have been right. I mean, we'll always be right in the future. But on a number of things over the last 18 months, Bitcoiners have been right. And I think that it's really opened people's eyes to, hey, maybe there's something here and I should start paying attention.
Yeah, Bitcoiners have been right in the fact that they've outperformed the market. Of course, you and I caught up at BTC Miami earlier this year in the summer, and you were right. I mean, you were talking about countries adding Bitcoin to the way that they would be operating. And of course, right after we had that conversation, El Salvador made the move to accept Bitcoin as a legal tender. Just want to play a little bit of what you said back there in the summer and then get your reaction on the other side. Take a listen.
We started with retail. We then moved in and we started to get financial institutions. Then we got corporations. There's one group of people left and they're coming. It's the countries and the central banks. And I think people think that's a 5 or 10 year type conversation. I think that's a 2021 conversation.
And it is a 2021 conversation. I mean, when we're talking about maybe the other pieces of that too, right? I guess maybe companies haven't added crypto to their balance sheet as quickly as a lot of people would have expected after we saw the moves. Of course, MicroStrategy out there has been doing that themselves. But I mean, what are you looking for, maybe the corporate front or more countries to add this and move in that direction, I guess, next year?
Yeah, Zach, I got to tell you, I cheated on the last time because I already knew it was happening. So that was an easy call. No, but in terms of what I expect to happen kind of moving forward, definitely we'll see more and more public companies doing it. Obviously, Lemonade just came out and said they put a very small amount of Bitcoin on the balance sheet. I think that there's some people doing it for marketing purposes. Some people are doing it for financial purposes, but we'll continue to see that trend go. What is really fascinating to me is if all of a sudden the El Salvador example, kind of the nation state adoption, these Bitcoin-backed bonds, if they end up issuing that, there's an oversubscription and it performs well, then you're going to see a lot of nation states, states within the United States, and also municipalities say, wait a second, maybe we should actually start looking at this, because as we've seen, pretty much all of the municipal debt that is held by investors right now, specifically in the United States and elsewhere, it's all negative yielding on a real return basis. Inflation's at 6.8%. It's pretty hard to not be losing money on purchasing power terms. And so if you can basically add a very small percentage of that bond into Bitcoin, and that can go ahead and change the return profile, I think that's going to be a big, big story. It's hard to see right now because there's basically only one or two examples of it. But over time, if Bitcoin can really infiltrate into the bond market, there's a world where Bitcoin ends up saving pension funds, Bitcoin ends up saving foundations, endowments, nation states, et cetera. And it's all because of the return profile is just very different than I think what people have seen with all of this debt that, frankly, right now is just trash and people are dropping it and realizing that if they buy it, they're guaranteed to lose money on a purchasing power basis when there's high inflation.
Yeah, we've talked so much about kind of the institutional investors coming on board here too, right? And obviously the bonds would be an interesting, I guess, build out of some of that in terms of ways to access investment opportunities in crypto. But when we're talking about that, we had Bitcoin futures linked ETFs. We did not have a Bitcoin spot ETF in 2021. I'm not sure if a lot of people were expecting that to come down the pike anyways. But when you continue to look out and see, I guess, how important those two things are when we're talking about what El Salvador is trying to do and really lean into Bitcoin and the Lightning Network to process transactions versus maybe institutional investors looking at it more as a digital asset. I mean, it seems like a lot of people have kind of had shifted away from it being a medium of exchange like El Salvador is trying to pursue. But I mean, which one to you, I guess, matters more, or is it just kind of two sides of the same coin, I guess?
Bitcoin's a lot of different things to a lot of different people. And I think that's part of the beauty of it. Look, if I was evaluating this and let's say that the store of value argument didn't really resonate with me, or I wasn't interested in that, or I said to myself, hey, I need to really find productive assets. I don't want to hold something that is equivalent to just gold or another type of store of value. There's a very strong argument that Bitcoin is actually the fastest growing payment technology in the world. Right? It's got over 150 million users. It's $1 trillion asset. It settles right now about 50% of Visa's transaction volume on chain on an annualized basis. And what we're watching is more and more people are deciding to use this thing. And whether it's on the base level, kind of layer one, or it is on the Lightning Network. The Lightning Network has gone absolutely parabolic in terms of nodes, et cetera. I think that you're watching the entire world realize, why the heck would I use a payment system that's slower, that's more expensive, and also is not resistant to censorship? So when you start to add this up, you may come to Bitcoin because you want censorship resistance. You may come to Bitcoin because you want the protection of the store of value and your purchasing power. Or you may come to Bitcoin because you literally want to be able to transact with anyone in the world instantaneously, completely for free, and do it with almost no issue in terms of the user experience. And I think that's what we're watching is, there's a lot of people talking about a lot of different technologies, but there's only one layer or two that's on board at a country. It seems to be working out pretty well for them. So I think that's going to serve as a great model globally over the coming years.
Yeah, that is one thing that Bitcoin does have over the other cryptos. You and I have discussed before, I guess, kind of Bitcoin's dominance coming down a bit, ending the year at kind of a low point there. As we've seen, a lot of these other crypto projects start to gain some attention. ETH up more than 450% on the year to 66% for Bitcoin. Obviously, it's not all about price returns, but if you're an investor watching this, it might be. I mean, when you look out to 2022, I understand maybe we had some information around El Salvador the next day, but when you're looking at, what are the bold calls here that you're expecting to see in terms of Bitcoin's adoption, or maybe some big things that investors should take heed of if they're planning out and maybe considering dipping a toe or maybe taking a larger position here in Bitcoin? What do you see?
Yeah, I think it's really hard to kind of look at short term and even maybe some medium term price movements. A lot of what was previously true is changing, right? So if you look at something like Bitcoin, is it becoming more financialized because there's more asset managers, more folks on Wall Street, public companies, et cetera, holding it? They're going to go risk on and risk off, similar to how they do stocks. That's one argument. The other argument is Bitcoin doesn't care. It continues to produce block after block after block of transactions. What I do know is that as an investor who sits in a position like I do, where I have a long time horizon, there's simply two rules to follow. Follow the talent and follow the users. And what we're watching is there's immense talent rushing into this entire industry, right? Bitcoin is a big part of that story, probably the biggest part of that story. But there's a ton of things, whether it's equity or other technologies, that are all getting built out by tons and tons of talented people. And then on top of that, the users. We're just watching users flock and go there. And so if you go ask a young person today, do you have more money sitting in your legacy bank account or in a crypto account? There's a lot of people that are going to say they've got more money in the crypto account than in the bank account. Now, that doesn't mean they don't have a bank account. That doesn't mean that they're going to get rid of their bank account. It does mean, though, that this thing is here to stay. There will be coexistence. And the younger you are, the more likely you are to have a higher percent of your kind of net worth or your portfolio in these digital assets. And I think that's a key story, is that over time, that younger generation will become middle-aged and then eventually kind of the older generation. And so at some point, I always say that a Bitcoiner will be president, not because the president of the United States is all of a sudden going to go buy Bitcoin and kind of change their mind about economics or anything like that. It's just that some young person 40 years from now is going to have grown up with Bitcoin or cryptocurrencies as part of their daily life as the default. And then they're going to become the president of the United States. And so a Bitcoiner will be president. It's just not going to happen the way that I think most people think. It's just that an entire generation grows up. And this is the default. This is the standard. Why would they use inferior technology in the legacy system when they can use superior technology to protect their purchasing power, transact, and also do a bunch of other stuff?
Yeah, and that a bunch of other stuff I think is a quickly growing piece of the offering here, and one that we've seen absolutely explode here in 2021, looking ahead to 2022. Hope to have you back, man. Great to have discussed all these things here today and also throughout the year, but Anthony Pompliano, appreciate you coming back on to kick us off today. Be well. Coming up, we're going to dig deeper into the other big discussion here in 2021. That was regulators taking a closer look at crypto. Yahoo Finance's Jennifer Schonberger is going to join us with the latest in terms of how DC is looking at the space right after this. Welcome back to this Yahoo Finance special presentation on the future of crypto. As we were just chatting, Bitcoin, obviously the biggest cryptocurrency out there, but not the one delivering the biggest returns on the year, at least thus far. For more on some of the best performers, though, I want to bring on Yahoo Finance's chart master, Jared Blickery, with his crypto hat on to take a look at some of the best movers on the year. Jared.
Well, let's take it off to the Wi-Fi Interactive here, where we are seeing Dogecoin. This is a limited basket here, but Dogecoin up over 3,000%. And there's a theme to this. And you're going to see Ethereum, Ether is up about 450%, Cardano up 650%. But you take a look at what's happened over the last month and kind of a reversal of fortunes. A lot of these coins that were not able to make relatively new recent highs are faltering. So we see Litecoin, that's down over 40%. So is Neo. And let's just pull up a chart of Litecoin. This goes back to the beginning of the year. And you can see we had this high in May. A lot of cryptocurrencies peaked in either April or May. Bitcoin peaked in April. And then in November, when Bitcoin was making a new high, Litecoin was making a much lower high. And you can see only holding on to gains of 22% year to date. So it's kind of a story, I think, Zach, of have and have nots. You can take a look at a lot of these charts. Here's Neo, very similar formation here. Cardano, Shiba Inu. Well, Cardano, it looks like it did peak in September as well. However, it's off of those highs. So let me change this to an intraday view, and we'll go back to our market capitalization look, and we can see Bitcoin here. So Bitcoin up over 5% over the last 24 hours. This is a year-to-date chart. Now, I said Bitcoin peaked in April, and that was this peak here. It got to a relatively new high, but only a marginally higher high, and then it sold off. And Bitcoin, I've noticed, kind of like that. Lots of fake outs in trading. So a lot of people were hoping for 75,000. No, we topped out at about 63, 64,000. And then after a little bit of a shakeout here, or maybe a bit of a shakeout, coming down to 30,000, we rose to highs again, new highs. However, we have sold off from those highs. And I think the lesson here is, well, we know that Bitcoin and crypto is volatile. However, if coins are not making new highs with Bitcoin, I would be skeptical of their ability to retain their value. So big takeaway for me for this year is crypto has definitely gone mainstream again. We've seen this retail phenomenon before. However, now it has the institutional support, and I think that's what's really making the difference here. Now, let me dial up a Bitcoin chart over the last month, and we are seeing some negative price action. We're down almost 25%, still at the bottom end of the trading range here. Personally, I think Bitcoin's going to chop around. It needs to find a new base, a new trading range before launching higher. That could take months. And if it is the case that it actually takes months to find a new bottom and to lift off and to reach new highs, and maybe 12 months, so maybe a year. If that is the case, I do think that we're in for another wild year here, but I don't see new highs in the immediate horizon, Zach.
Well, we'll see. Obviously, a lot of people were looking at it touching that 200-day moving average just this week and bouncing off of it. So anytime we see that, buckle up. Jared Blickery bringing us the latest there. Appreciate that. Of course, as I said, regulators have been taking a much closer look this year when it comes to crypto as the space has exploded and increasingly setting their targets on stable coins, traditionally one of the more quiet pieces of the crypto market, as their name intends, meant to stay pretty stable, but raising a lot of questions about the risks to the traditional financial system. And for more on that, I want to bring on Yahoo Finance's Jennifer Schonberger, who is always tracking that for us with talks in DC. And Jennifer, you and I have suffered through, I guess would be the right way to use it, the questions lobbied at crypto executives this year in congressional testimony. I mean, we've learned a lot about, I guess, the incremental steps that they're taking to rein this industry in.
Hi, Zach. Indeed, one of the biggest questions facing cryptocurrencies for the new year will be how Washington regulates them. This year saw officials in Washington sketching out new guidelines and recommendations for how to regulate stable coins, and they have tasked Congress with coming up with a brand new regulatory framework. The new year could bring new proposals from lawmakers. The chairman of the Senate Banking Committee, Senator Sherrod Brown, says the committee is seriously looking at new rules for stablecoins.
I am certainly looking seriously. My staff on the Banking Housing Committee is looking seriously at that. We're consulting with the regulators. I know that SEC and the Fed, especially SEC and also the Fed and Treasury, are in this space already looking to write rules and regulations around this. They may recommend that Congress take action too. I think from some private conversations they might. I'm ready and willing to do that. I'm not yet able to do that in the sense of knowing specifically how to do that and which direction. I mean, I know the general direction, but I don't know the specifics yet.
As both parties sift through how to regulate stablecoins, the ranking member on the Senate Banking Committee, Senator Pat Toomey, has put forth some principles on stablecoins to serve as a guideline for future legislation. Toomey does not think that stablecoin issuance should be limited to insured depository institutions, noting that stablecoin issuers have different business models than traditional banks, and that requiring all stablecoin issuers to become banks would stifle innovation. Toomey underscores that all stablecoin issuers would be required to adopt clear redemption policies and disclosure requirements of their reserve backings. This after the Biden administration has recommended that only banks be the ones allowed to issue stablecoins. The Federal Reserve Chairman Jay Powell thinks that stablecoins can be useful, but says they need to be properly regulated.
I, of course, would support the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated. And right now they aren't. And they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist. And you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections.
Investors are also awaiting a paper from the Federal Reserve that could offer clues as to whether they would pursue a central bank digital currency, something that China is already pursuing. At the same time, the Federal Reserve, along with other major financial regulatory agencies, have sketched out a to-do list of what regulations they should pursue for the crypto space. That so-called crypto sprint, as they call it, will focus on oversight of how banks could store crypto assets safely, handling exchanging customers' fiat currency for cryptocurrencies, settling and executing trades, looking at loans backed by crypto assets, and issuing stablecoins, and of course, tax services. Lane Reddig, a former core developer of the cryptocurrency Ethereum, says that new regulations could actually push cryptocurrency prices higher. So these new regulations could create more clarity if we get some next year in the new year. Back to you.
Jennifer Schonberger there for us. Appreciate that. Coming up, the leading edge of crypto. We're going to chat with a leading NFT investor and expert with us, Megan Casper from Magnetic Capital, joining me right after this. Stay with us. Welcome back to this Yahoo Finance special, The Future of Crypto. As we've been discussing, 2021 has been a banner year with the explosion of NFTs, providing a huge boost to Ethereum and prices, their activity on that chain as well. And for more on that, I want to bring on an expert in the area of NFTs. Megan Casper, Magnetic Capital Director, joins us here, as well as a member of the DAO, Red DAO. And Megan, appreciate you coming back on. You're sporting the NFT earrings here, of course, which kind of just goes to show you are indeed an expert in the NFT area. As we've discussed, it's been an explosion in terms of NFTs, wearable NFTs even. But let's back up and talk about Ethereum too, because as we discussed this year, you had some lofty goals obviously based on a lot of upgrades to that network. You saw a potential chance to hit 8 to 10,000 as those upgrades were, I guess, pushed back a bit. So maybe we'll wait a little bit for that. But talk to me about where you see Ethereum going in the short term here.
Well, we did anticipate to see a market cap for Ethereum hitting around $1 trillion, which would put the price point for Ethereum between 8 to 10,000. And that was based on technical analysis and 2 Ethereum network upgrade conditions that were set to trigger over the course of this year, before the end of this year. One of them did, and that was EIP 1559. And that's drastically decreased the gas prices on Ethereum, but it's also burned over 1,100 Ethereum, which is equivalent to about $5 billion. So that's been great for the network, but the one other network upgrade that we anticipated to see is the transition from proof of work to proof of stake, and that's called Ethereum 2.0. And in November, the Ethereum Foundation did an announcement that they'll push that network upgrade to about June 2022. So there's a good outlook next year for Ethereum. But Ethereum did still outperform Bitcoin this year by over 350%. So, it's keeping it the second largest crypto out of all the market cap, the highest market caps for all the cryptocurrencies. And I still foresee there being greater upside potential and Ethereum being a more superior asset to invest in than Bitcoin.
Yeah, it's been interesting. It's been interesting to watch that play out this year, especially as we talked about the explosion of NFTs and options there to kind of reduce some of the loads on Ethereum. We've seen Polygon really take off when it comes to maybe people transacting. Also, these other chains popping up, Avalanche and Solana, to kind of also build out capabilities there in the NFT space. When it comes to, I guess, how investors should look at NFTs, though, I mean, you've obviously been investing in specific projects, but even backing up, if people watching this if they don't even know the specifics or the granular projects themselves, there's still a way to invest around that, right? I mean, Ethereum might still have the most activity, but there are other chains out there that are gaining some now too.
Yeah, there are layer 1 alternatives like Solana Solana and Near. I would say Near is a good layer 1 alternative for Ethereum, but the alternatives still don't have the same ecosystem. Ethereum has the strongest ecosystem. There is more DeFi, total locked value in DeFi, about 96 billion on Ethereum. The NFT sales for this year were over 12 billion on Ethereum. No other chain has anywhere near that amount for NFT sales. Also, all the top NFT collections, like the collections that Red DAO also invest in, Axie, CryptoPunks, Bored Ape Yacht Club, Artifacts. Here is one of the Artifact drops that recently happened a few weeks ago.
Yeah.
And so these were all on Ethereum, and even the metaverse platforms, Sandbox, Decentraland, Somnispace, everything is happening on Ethereum. And that's why really there's the most upside potential there in the ecosystem. But not to say that, we can't discredit the other, the alternatives. These are still good ecosystems to pay attention to. And then I think for 2022, the layer 2 Ethereum solutions like Polygon, pretty much every startup company that I speak to, they're all building on Polygon. So I think that speaks volumes to what the possibilities are for the growth in that ecosystem as well.
Well, if people watching this are new to crypto, they might be kind of blown away by the fact that you're wearing virtual earrings and also those NFTs we just showed on the screen there, CloneX. Obviously, you own them through Red DAO. And when we talk about maybe what's important there is Nike just acquired the company behind them, right? Artifact, that pushed those out. And it's, we've seen Facebook this year change the name to Metaverse, so much attention being placed on that. What makes projects like those stand out? And CloneX and I was looking at the prices in some of these 40 ETH, right? I mean, we're talking about tens of thousands of dollars behind those things, but they're not just art anymore. Talk to me about where that space is going.
Well, CloneX, Artifact did the drop with CloneX, and they also did a collaboration with the artist Murakami. So some of these clones have Murakami DNA in them. The drop itself, people could mint if they had prior items from Artifact for around 0.05 ETH up to 3 Ethereum. And now the floor prices for these clones and the virals have several multiples, up to 4 and 5x. So the project itself has done very well, and it's very nascent. The announcement of Nike acquiring Artifact happened on Monday, but there's a lot of utility that's going to come out of these clones. The functionality that they're offering. If you own a clone, you can have a space pod